Hello everyone, this is CA.Tejeshwini Chiranjeevi. This video is a part 1 and it consists of all the illustrations and all the test your knowledge questions from all the 5 heads of income from salary, house property, PGBP capital gain and other sources. And the next question would be where the material are available, material free resources, whatever the material which I have used, all the material is available in my Telegram channel. The link is available in the description. You can go and get it. The part 2 of the video consists of part 2 will be to be uploaded. It consists of the basic concepts, residential status, and all the illustrations and the TYK questions of all these chapters which are mentioned here will be uploaded in that part 2 of the video. Now comes the question, what is the method of practicing and how to move forward with this marathon questions of the practice sessions. This particular video can be watched in two phases, one during the revision phase and one during the day before the exam. When you're watching during the revision phases, this has to be done in the way which I tell it to be 100% effective and to be 100% utilized for your exam. One, solving each questions one by one. When I'm solving the TYK questions, when I'm solving the illustration questions, if the illustration questions are very simple, it's okay, fine. You can just watch the video and close it off. If some practice is necessary, please pause the video. Watch one entire. Suppose let's consider you're watching income from salary question number 1, Mr. Mohit question. Watch that entire video. You see how the questions and everything and how the solutions are being flowing. Then pause the video before going to the second one. Practice it. Make sure that you're getting the solutions right, and then move forward with the second question. That is how you need to move forward and solve each questions during the revision phase. Okay. And also, it is recommended for you to solve the question some 2 to 3 times for you to be very confident for your exams. Okay. And also try to solve first the TYK questions and then go forward with the illustration question, because as you have already done with the concepts, this TYK questions are more complicated than the illustration. So once you solve TYK, then the illustration questions becomes much more easier. Day before the exam, that is the next phase of you watching this video will be before the exam. Don't underestimate these people. Make sure that you're watching this at 1.25x or 1.5x speed the day before the exam, because you're not absolutely having no time to sit and watch and practice each and every question for that matter. Make sure that you're going through all the questions and understanding the concept and how the questions are flowing, how the things are flowing, because during the revision phase only you have done the majority of the work. Okay, believe me, you have done the majority of the work during the revision phase. Day before the exam is just going to be the go through of all the questions, and whichever question you feel okay, this question is mandatory or it is a full-fledged question which I need to practice, only practice those questions during the exam. Don't waste your time doing all the questions a day before the exam. You will lose out on time. Okay. All the best for the marathon questions. Do well. What's your knowledge? Question number 1 from the chapter Income from Salaries. Mr. Mohit is engaged with XY Limited on a business on a basic salary of rupees 10,000 per month. Okay, and is also entitled to DA at the rate of 100% of the basic salary, 50% of which is included in as per the salary, as per the employment means in terms. The company gives him HRA of 6,000 per month, which was increased to how much? 7,000 per month with effect from this particular date. He also got increment of 1,000 per month in his basic salary with effect from this February. Rent paid by him during the PY 25-26 is as under. April and May nil as he stayed with his parents. June to October 6,000 he paid. He was staying in Gazidabad. November 25 to March 26 he paid 8,000 per month for the accommodation in Delhi. What you are supposed to find is that you are supposed to find the gross salary for AY 26-27, and assuming he has opted out of shift, that is opted out of deferred tax regime, nothing but is opting in for the optional tax regime. Basically, is having taxability under the optional tax regime provided under section 115 BAC. See, basically, if you want to calculate this gross salary, you will take the components of the basic salary HRA, right? HRA is being received. How much? See, basically, how do you calculate the HRA computations? You will take up the HRA received, you will subtract under section 1013A. Lower of the following will be exempted. What is that exemption which is available under section 10 subsection 13A? Would be 3. HRA received HRA received, the rent paid minus 10% of the salary, 40% of the salary. These are three things which are actually received, right? These are the actual exemptions which are available. Lower of the following will be available as exemption under section 10 subsection 13A, right? Now, here if you can observe, the salary component is being changed for certain period, and also the component of HRA is changed, component of rent paid is changed. So wherever the changes happens, there the calculations of HRA changes for certain number of months. Suppose, see, in April and May, he has stayed with his parents. We know the rules, that is, if he is not paying the rent, then can't he get HRA from the company, or it is company's discretion whether he will get HRA or not. But can I say HRA exemption will be available only if you're spending something from your pocket as rent pay. You're not paying any rent only. Then how can you expect an exemption to be received from the income tax, right? So when the rent is not being paid, when he's staying with his parents, when the rent not paid, you will not get any HRA exemption. It means whatever the HRA is which you have received from the employer, the entire HRA is going to be what? Entire HRA is going to be taxable. So can I say April and May month 2025, for the 2 months, there is no rent payment that is coming in picture. So there is no exemption. So whatever you are paying it as whatever you are paying as, whatever you are receiving as HRA, the entire amount is going to be what? Simple. Now, we can see the next basic salary 10,000 per month. Very well. He is getting DA also 100% of the basic salary, and 50% of which is included in terms. If you can consider the definition of salary under HRA, it is going to be basic plus DA in terms only, right? It is going to be DA in terms plus turnover commission. There's no turnover commission, we'll ignore. DA in terms means which are falling in terms of employment. It means 50% of your dearness allowance, that is nothing but 10,000 is your DA which you are getting. Out of that 10,000 rupees, 50% of it, that is 5,000, is what you are going to include in your employment. Very well. The company gives him HRA of 6,000 per month, which was increased to 7,000 per month with effect from 1/1/2026. So can I say now you can divide, you have to divide April to May as one sector, as one point, right? So then apart from that, can I say from June to January as of now, don't look into the solution, just understand June to January how we are dividing it, because April to May you're not paying anything. So the next month comes from June, and here the first division goes with January. So June to Jan is what you can understand as of now, right? June to Jan. And he also got an increment of 1,000 in his basic salary from 1 to 2026. So now the salary definition has been changed. So now the HRA should also be, HRA calculation splitted into months should again be splitted now from Jan to Feb. Basically from June to Jan, where it's effective from this one. No, so it's not June to Jan, sorry. This is going to be June to December, and this is going to be for the month of Jan, because 1st February it is changed. So June to December you were paying in how much you were getting the salary, and this HRA has been increased from 6,000 to 7,000 rupees from June to December. You divided that into a component, and you also got an increment of 1,000 per month in his basic salary with effect from 1/2. It means he was getting the basic salary from June to January as one salary only. The increment got after February. So the changes of HRA comes under February, from the month of February and March, right? So can I say here, I can basically split it into Jan and Feb and March here for our understanding. Understand the splitting that happens. Later on, we can understand exactly what splitting we are speaking about. Rent paid by him during so much. This is fine. So now, if you can see, June to December, you had all the components in common. Now, June to October, you were paying 6,000 in Gazidabad, and November to March, you were paying 8,000 in Delhi. So, can I say this is going to be 40, coming under 40% bracket, non-metro city. and this is going to be 50% bracket, which is coming under Metro City for the purpose of definition of your HR. Right? HR exemption, you need to calculate 40% or 50% of your salary. 40% comes under non-metro city, 50% comes under Delhi. Where else? Right? So now again the splitting goes. Now it is not going to be June to December. It is going to be June to October. And October, it's done with the October. Now it's going to be November to December. Why? Because November to March, you are changing it into 50%. From December to March, you had something else. From June to December, you were having the HRA of 6,000. It was split into 7,000. That is, it was increased to 7,000 with effect from 1/1/2026. It means from June to October, you will making one bifurcation, and from November to December, you are making one bifurcation. And in the month of January, you have another bifurcation, and February and March, you have one more bifurcation. Why are you doing this 5 bifurcation basically? Is that because there is a changes in each component when the splitting is happening. See, first of all, there is no exemption only. June to October, this is non-metro city, it was 40%. From November to December, what happened? From non-metro city to metro city, you increased. That is, you moved to. Because of the changes of metro city, which is coming up to 50%, now it is going to be what? You have to split that HRA points now. Now you are shifting it to what? January, that is your basic salary. Your HRA is now increased. That is there is a basic salary changes, and the HRA is 7,000 only. Basic salary has been changed. That's the reason why you are splitting this. From February to March, there is basic salary changes and also there is an HRA changes. Right? Where is the HRA being changed from 6,000 to 7,000 with effect from 1/1/2026. So there is a HRA change. Excuse me. Excuse me. Okay. There is HRA changes which has been effected. I hope you have understood how we got the splitting. No tax. It was in the metros, non-metro city. You have moved to the metro city. As you have changed one of the component in the HRA calculation, we have taken a separate split. And next, there is changes in the HRA basically. The salary has been changed from increment with effect from 1/2. So this changes you are doing it. This is specifically because of HRA change. And Feb to March, you are making a separate split because there's a basic salary change. There's a component of each component being changed. So we have split it into certain. First point, everyone are clear, right? There is no HRA. HRA has been received, but there is no rent paid. Hence, we are not going to get any exemption. So the entire amount of whatever you have received HRA in this month, how much is it? 6,000, right? So 6,000 into 2 is equal to 12,000 is your taxable HRA, right? This is your taxable HRA. The second point is June to October. All of us know how much is the HRA being received. This is nothing but 6,000, right? 6,000 into how many months? 5 months. So HRA received is 30,000. People, all this information is there in the question only. See here, 6,000 and it has been increased to 7,000. So 6,000 was the base data, right? 6,000 into 5, 30,000. Exemption under section 1013A. HRA received rent paid minus 10% of the salary or 40% of the salary. All of us know that. Rent received is the same. So what is the rent paid minus 10% of the salary? Rent paid is 6,000 for 5 months. It's going to be 30,000. All these data are there in the question, people. So how do you calculate salary? Basic plus DA in terms plus turnover commission. There's no turnover commission. We are ignoring it. Basic plus DA in terms. Basic is 10,000. DA is 50% of whatever. No, sorry. In terms is 50% of whatever the DA is. So it is going to be 5,000. This is for 1 month. If you multiply it by 5 months to keep the equivalent point here. So it's going to be 75,000 and this 75,000 multiplied by 10% is 7,500. So the final effect is 22,500. 40% of the salary is nothing but the salary is the same component, right? So it's going to be 75,000 multiplied by 40% because this is in Gazidabad, non-metro city, 30,000. Each of the following is going to be exempted. That is going to be 22,500, which you have considered here. And then the taxable HRA is so much, right? This is the point. Taxable HRA is 7,500. Now, when I come to the next point, that is November to December, this is going to be 2 months criteria. This is 2 months. HRA received is 12,000. How did he get 6,000 into 2? 12,000. Rent paid minus 10% of the salary. How much is the rent paid as per the question? Now you are moving to Delhi. You are paying 8,000 per month, right? My dear wonderful people, it's there in the question only. You need not worry. What is it? 8,000 into 2, 16,000. And then 10,000 plus 5. What is it? Salary. Multiplied by 2 months. You will get 30,000. That multiplied by 10%. This difference you are taking it as 30,000. 50% of the salary you are getting. Salary is nothing but the same component which you have taken here. Remember, metro city is going to be 50%, not 40%. So 50%, 15,000. HRA is going to be the least of the following is going to be exempted. That is nothing but 12,000 will be exempted here. So it is same 12,000. The taxable HRA is nil. Now the next split which we have done is for January. That is HRA received. We all know that is HRA changed in the month of January from effective from 1/1/2026. So it's going to be 7,000. HRA received is 7. Rent paid minus 10% of the salary. Rent paid is 8,000 into 1, 8,000. 10,000 plus 5, that is 15,000 multiplied by 1 month into 10%, you got 1,500. If you do the final calculation, you'll get 6,500. 50% because it is he's staying in Delhi and is paying here metro city, you are going to get 50%. So list of the following is 6,500. You take that and you will get the taxable HRA is 500. The last component is for again it is for 2 months. So HRA received is going to be 7,000 into 2, 14,000. Then rent paid minus 10% of the salary is going to be 16,000 minus 3,300. The same calculation process you can clearly see over here. 10% of the salary you will get 12,700. 50% of the salary, this component only is the salary. If you can observe, salary definition has been changed from the month of February. Salary definition has been changed from the month of February here. So what you can consider is 33,000, that is in the place of 10,000 there is an effect of plus 1,000. So it is going to be 11,000 and DA is going to be 100% of the basic salary. So DA is also 11,000, but in terms is only 50%. So we are coming up to 5,500. I hope it is clear. So 11,000 plus 5,500 into 2, you are going to get how much? 33,000 multiplied by 50%, 12,700. List of the following would be exempted and you have considered your taxable HRA. You will subtract it and you will get it. Right? I'll just write a point here so that it will be easy for your further understanding. How did you get this? This is 100%. This is nothing but DA, which is 100% of basic salary. Right? Your basic salary was 11,000. Your basic salary was 11,000. So this itself became your DA. Now DA in terms is nothing but 50% of this is this, right? So it's going to be 5,500. Just for your further understanding, I've written it. Yeah. Computation of the gross salary of Mr. Mohit, already know. Basic salary is 10,000 into for 10 months. From the month of February, there is a salary changes, that is 11,000 into 2, 1,22,000. Remember, DA is 100% taxable in the same year, right? But for the purpose of definition of salary, DA shall be taken in terms for the purpose of calculation. So taxability goes with 100% of the basic salary, only 1,22,000. HRA, all of us have seen, if you add this 1,300, please do the calculation, people. So let's look into it. Do the calculation, everyone. 12,000 plus 7,500. I'll just write here. 12,000 plus 7,500 plus Where is it? Nil plus 500 plus 1300. How much did you get? Please do the calculation, everyone. 12,000 plus 7,500 plus 500. We got 21,300. The same thing, right? Great. You guys are fantastic. 1,300. So now whatever is being given, this is there in as per the ICF format. You can follow the ICF format if it comes in your exam, or you can follow the format which I have resolved. So this only requires the bifurcation of the points as and when you're doing it, so that when you're doing the actual HRA calculation, it will become easier, right? So you can do this without any confusion, or if you have practiced it some 4 to 5 times, you'll be able to go along like this. You do the calculation and you make the component as Jan, Feb, March and all, and you can write this format and give multiple months division, and you can write it over there. Or if you feel like I don't want to get into all those things, I don't want to get into confusion, even if it takes another 2 minutes for me to write all this information, it's also fine. You can do it that also. Okay, whichever is convenient to you. Let's move to the test your knowledge question number 2. Miss Raki is an employee in a private company. She receives the following medical benefits from the company during the previous year 25-26. Reimbursement of the following medical expenses incurred by Miss Raki. She has got reimbursement on treatment of her self-employed daughter in private clinic, on the treatment of herself by family doctor, on the treatment of her mother-in-law dependent on her in nursing home. Okay. Now, payment of premium of mediclaim policy taken on her health, medical allowance, medical expenses reimbursed on her son's treatment, expenses incurred by company on her treatment of her minor son studying abroad and staying expenses. Expenses in relation to foreign travel of her medical of her son for medical treatment. Limit prescribed by RBI for expenditure on medical treatment and stay in abroad is 2,50,000 USD for financial year under LRS scheme. So, with regarding to the tax treatment of the medical expenses of Miss Raki here, Miss Raki is an employee, right? Now, she has incurred certain expenses in the questions, and they are expecting us to know whether what is be the taxability of the benefits and the allowances provided to Miss Raki. Okay. See, reimbursement of the following medical expenses incurred by Miss Raki. She has got reimbursement for the medical treatment on self-employed daughter, basically daughter in a private clinic, basically for her uh, family member in a private clinic. Is it allowed? Reimbursements which you are getting, if it is from the government, if you have shown your daughter for the treatment, or if you have taken your daughter for the treatment, family member for the treatment in the government hospital, it is going to be allowed as a tax purpose. But however, this reimbursement is for private clinic, not allowed. This reimbursement is for a family doctor, by a family doctor, not a government hospital. Again, it is a not a taxable purpose. It means a taxable purpose. It is a taxable purpose. On treatment of her mother-in-law dependent in a nursing home. Again, it is not a government hospital. So it is going to be taxable. So all the 3 points over here, 4,000, 8,000 and 5,000, the reimbursements received by Ms. Raki, all the 3 points are going to be taxable. Okay. All the 3 are going to be what? Taxable. Payment of premium on Mediclaim policy taken on her health. Premium for medical insurance policy, the payment which is made by the employer. Here it is going to be what? Tax-free perquisite. It's not a taxable perquisite. It is tax-free perquisite. It's a tax-free perquisite, right? Right. Medical allowance. All of us know medical allowance, which is any fixed medical allowance or any monetary compensation received as in medical allowance over here, it's going to be taxable. So it is going to be a taxable allowance. Medical insurance reimbursements on a son's treatment in government hospital. I told you reimbursement if you're getting for yourself, for employee or for the family member of the employee, it is going to be what? not a taxable perquisite. It is nothing but it is a tax-free perquisite, right? 5,000. Okay. Expenses incurred by the company on the treatment of her minor son abroad, including stay expenses. What is it? Expenses incurred by the company on the treatment of her minor son abroad, including the stay expenses here. This will follow this next point. Foreign travel of Raki and her son for medical treatment over here is 1,20,000. Travel and medical treatment cost is 1,20,000 on the specifically on the treatment for that matter by company on the treatment of minor son abroad including stay expenses. See these two expenses basically whether it would be taxable or whether it would be exempted, it depends on certain conditions, right? See what are the conditions. First of all, your travel expenses can be exempted provided you satisfy certain conditions. The medical expenses which has been reimbursed or whether the expenses if it is paid by the employer directly, it's going to be exempted. See what the condition says is that as per clause 6 of 17.2, just a minute, of 17.2, the following expenditure incurred by the employer would be excluded from the perquisite. That is, it would not be included in the taxable perquisite provided you satisfy certain conditions. First of all, the expenditure on the medical treatment of the employee or the family, and its expenses in this case, it is going to be for Raki 1,05,000, right? Next, expenditure on the travel of employee and the one attendant along with them who accompanies. So total amount is 1,20,000. The conditions which they need to satisfy over here is expenditure on the medical treatment and the stay abroad would be excluded from the perquisite. That is, it's not a taxable perquisite provided it is within the limit specified by the RBI. I told you, no, it's going to be, however, it will not be considered as a taxable perquisite. However, you need to satisfy certain conditions. What are those conditions? For medical treatment and stay particularly, it has to be within the RBI limit. It will be specified by the RBI. If it is within that, yes, it can be considered. And also the expenditure on the travels. Basically, the travel expenses which is incurred, it would be exempted. That is, it's not exempted. It would be considered as tax-free perquisite provided the employee's GTI is within the prescribed limit. This prescribed amount is nothing but 8 lakh as per AY 26-27. It is an amendment. The prescribed amount is how much? Within 8 lakh. If the GTI of the employee is within the 8 lakh, then whatever the travel expenses which they have incurred will be considered as a tax-free perquisite. That is, whose GTI computed before considering the said expenses does not exceed 8 lakh rupees. If the GTI is within 8 lakh, then yes, the travel expenses would not be considered as taxable perquisite. It would be considered as tax-free perquisite. However, the medical treatment and the stay would be going along with the permission, that is the extent to which it is permitted by RBI for that matter. Clear? So now let's get into question 3. Test your knowledge. Question number 3. Mr. X is employed. A simple question but a tricky one. Make sure that you are doing this following adjustments before the exam. It's a tricky situations here. On a monthly salary of 25,000 per month. Very well. Entertainment allowance and commission of 1,000 rupees per month each. See, very, very important point. What students will do is that mistake which done by students commonly is they'll take entertainment allowance and commission as 1 point and they will take 1,000 multiplied by 12, make it as taxable, done and dusted. Array, wrong. That's wrong because here they mentioned it as each, right? Each means 1,000 for allowance and 1,000 for commission. Both are different. And the company provides the following benefits. The company owned accommodation provided to him in Delhi, furniture provided. See, the company has given him the accommodation. That is nothing but the RFA perquisite calculation will do. There is one interest concession perquisite which has been provided. As per SBI, it is 12.75%, but the employee is getting at the rate of 6.75% by the employer side. Whatever the difference of interest that he would have, that is nothing but the interest on the loan, that is the concessional rate of interest which is getting. On that, you are going to multiply 5 lakh multiplied by how many months interest is getting it as benefit. This point is quite tricky. You can mark it as exam oriented adjustments. You can mark it as exam oriented adjustment. That is nothing but his son is allowed to use a motorcycle belonging to the company. The company had purchased the motorcycle for how much? 60,000 on 1/5/2022. Okay, in PY 22-23 only they have done, purchased it. And the company has purchased it. And his son, that is Mr. X's son, family of Mr. X is using this motorcycle from a longer period of time. And the company had purchased this motorcycle for 60,000 on 1/5/2022. And the motorcycle was finally sold to him on 1/8/2025 for 30,000. Professional tax paid by him, paid by employee by Mr. X is 2,000. Based on this, we are going to do the computation. Now, so you can see here 25,000 multiplied by 12 months, you will get the final component 25,000 multiplied by 12. Very well. Commission is 1,000 multiplied by 12 and entertainment allowance is 1,000 multiplied by 12. Remember, entertainment allowance, the deduction is given only and only for government employee, not for anyone else. This is working with employed with AB Limited, which is the private company. So we have considered the entertainment allowance as 100% taxable, commission 100% taxable, and basic salary taxable, right? So when we are taking the calculation of the RFA here, okay, the company owned accommodation in Delhi, furniture costing of 2,40,000. So this is a furnished accommodation which is getting. First, when we are considering the accommodation, we are taking in the salary. That is how much of the percentage in salary? 10% of the salary is what we are considering. Because whenever you are taking the RFA calculation, remember certain points. See, we'll take the provision. Yes, here it is. The RFA calculation, whenever you are doing it, if it is a government employee license fees, what you are taking, it will be prescribed by RBI. For other employees, for poor people, the other employees, employed, owned by employer for that matter, it is going to be 5%, 7.5 and 10%. How are you going to differentiate which percentage is applicable for you? Very simple, depending on the population. That if the population is greater than 40 lakh, right? And if the population is in between 15 lakh to 40 lakh, you are going to take 7.5. Less than 15 lakh, you're going to take 5%. Nothing given in the question, assume it is 10% only. They are staying in the population greater than 40 lakh. Or if they mention some metro cities name, like Delhi, the Chennai, Kolkata, if they mention the metro cities name, all of us know it is going to be population greater than 40 lakh. So it is by default 10%. And assumption also you can take that the population where the person where he's staying, the population over there is going to be around him is going to be more than 40 lakhs. So you can take this assumption and record it as 10%. Right. So I've taken it as 10% of the salary here. Salary for this purpose of RFA includes basic DA and all taxable allowance. It's not just allowance, it's taxable allowance. So 3 lakh is my basic. There is no DA given in the question. You have commission which you need to include. Commission which need to be included. And you have entertainment allowance which you are including. So you're including all these three. Right? See here. What's the definition of salary? Basic plus DA. This is basically in terms. All taxable allowance. Bonus plus commission. It is not specified as whether it is turnover commission or nothing. It's just bonus plus commission. So we are including all this sort of commission. So after including everything, you are going to get how much? 3,24,000. On the 10% is what you are taking for the purpose of calculation. That is 32,400. It's a company owned. So it's going to be 10% of the salary, and the furniture is also being considered. Whenever the furniture is being taken on higher charges will be your perquisite. If it is owned by the company, 10% of the cost of that furniture will be your perquisite. So 2,40,000 into 10%. But when did he actually get the furniture from? The furniture was provided to him on 1/8/2025, but he is working from the beginning of 2025. So it's going to be from August March 2026. That's nothing but 8 months out of 12 months. This 10% is representing for per year, right? Per annum 12. So if 10% is for 12 months, how much is for 8 months? So that is what the simple calculation is. You will get 16,000. You will add both, you will get the total civil RFA, rent-free accommodation. This is furnished accommodation. So we are taking in both 48,400. I hope it is clear. The next point is interest on loan. That is a personal loan. Interest on personal loan of how much? 5 lakh on 1/7/2025. I've told you difference between these two. What is the difference between these two? 12.5% minus 6.75%. What is the difference you will get? You will multiply that with the interest. That's for the entire year. But when so you will take in the personal loan of 5 lakh multiplied by the difference between these two into 8 divided by 12. 9 divided by 12, you will get 22,500. This 22,500 is what you will take in. So the last point, that is, his son is allowed to use a motorcycle belonging to a company. He's using this motorcycle in first instance, and also it is also getting transferred during the relevant period. Two situations are there. One is use of motorcycle and one is transfer of motorcycle. If you can see over here, use of motorcycle, you have the point stating in see, use of mobile assets is going to be laptops and computers, it's going to be nil. And for other assets, what is the taxable perquisite? 10% of the actual cost of the asset will be a taxable perquisite. However, we are speaking about the taxability for the relevant PY, right? So it's going to be how much? You have to take 60,000 specifically, 60,000 into 10%. But you have used it for how many months? You have been transferred on 1/8. But till 31st of July 2025, you were using it, right? So April, May, June, July, 4 months. 60,000 multiplied by 10% into 4 by 12, it's going to be how much? 2,000. The next point is the next point over here is going to be the transfer. How are you going to make the transfer of the motorcycle over here? Transfer of the motorcycle is considered as follows. Now, calculation of the taxable perquisite, so that is the transfer of motorcycle for that matter. If you remember, motorcycle, do we take 20% of depreciation or are we taking 10% on SLM basis? What are we taking? CA. Motor cars, it's going to be depreciation 20% on WDV. On any other asset, it's going to be depreciation at the rate of 10% on SLM. If you can consider, this is motorcycle, this is not motor car for you to take depreciation of 20%. It is motorcycle. So depreciation is at the rate of how much? 10% on straight line method. So it's going to be 60,000 into 10% into 3 years. So how much is it going to be? 18,000. And 60,000 minus 18,000 is going to be 42,000. Out of this 42,000, 30,000 is something which you have paid out of your pockets, right? So 42,000 minus 30,000 is going to be 12,000. And this 12,000 is what you are taking over here as your taxable answer. So the deduction under section 16 and 16 clause 3 is also given. 50,000, however, you are getting the deduction. And PET which is paid by employee, all of us know this is going to be allowed as deduction. So 2,000 from 4 lakh 8,000. If you subtract this, you are going to get 3,56,900. This is your question number. Question number 4. Mr. Balaji, employed a production manager in Beta Limited, furnishes you the following information for the year ended 31st March 2026. Basic salary up to 31/10/2025, 50,000 per month. Basic salary from 1/11/2025 is 60,000. Basically, there's an increment during the period. For first 7 months from April to October, it is 50,000. From November to March, it is 60,000. Salary is due and paid on the last day of every month. Very well. DNS allowance is 40% of the basic salary. Bonus equal to 1 month salary paid in October 2025 on basic salary plus a DA applicable for that particular month. See, bonus is equal to 1 month salary. Very well. paid in October on the basic salary plus DA applicable for that month. Basically, it means whatever the salary which is applicable in the month of October, basic plus DA relating to the month of October, it is given as bonus for, it is given bonus for during the period. Contribution of employer to RPF of the employee is 16% of the basic salary. Basically, employee contribution is 16% and the employer contribution is also 16% of the basic salary. Can you remember what is the employer's contribution to the RPF being exempted up to, it is 12%. Okay, up to 12% is exempted. Beyond 12%, it's going to be taxable. Professional tax paid 2,500, out of which 2,000 is paid by employer. 500 is paid by employee and 2,000 is paid by whom? Employee. Facility of laptop and computers provided to Balaji for both official and the personal use. Cost of laptop and the computers were acquired by the company on 1/12/2025. See, if you can observe something over here, facility of laptop and computer which is given, it can be for personal use also. That's totally fine. Use of laptops and computers, the perquisite would be considered as nil. That is nothing but it is a tax-free perquisite. There is no perquisite considered over there. So motor car in this facility, it is a nil perquisite. There is nothing coming up over here. Clear? Okay. Motor car owned by the employer, cubic capacity of engine exceeds 1.6 liters, provided to employee from 1/11/2025, meant for both official and personal purpose. Repairs and the running expenses of 45,000 from 1/11/2025 to 31/3/2026 were fully met by the employer. The motor car was self-driven by the employer. See, if we can observe something, the cubic capacity is exceeding 1.6 liters and it is from 1/12 to 1/11/2025. So it is for 5 months. Very well. Just 5 months is for calculation purpose. It is exceeding 1.6 cubic capacity. And if you can observe, the motor car was owned by employer. The running and the maintenance expenses were also met by employer. And the car was self-driven by employee. So no worries at all. So can I say, if the car is owned by employer and the running and the maintenance expenses is also paid by employer, is it not 2,400 per month, which is considered as perquisite multiplied by 5 months in this case? Everyone, you can remember the provisions, no? See, if you want any material for that matter, whatever I am referring now, or whatever my full-fledged material, which will be available in the Telegram, you can go and find it. The link will be given in my description. You can go and join and get the free resource. Okay. Leave travel concession given to employee, his wife and 3 children, one daughter aged 7 and twin daughters aged 3. The cost of air tickets, employee economy class, reimbursed by the employer 30,000 and for adults 30,000, 45,000 for the children, is eligible for exemption during this period. See, if you can observe something very closely here, this leave travel concession, there are 3 children. Basically, leave travel concession is available. The expenses with relating to the travel is allowed as exemption, provided it is for 2 children, right? But here it is 3 children and there is an exception to it. If the firstborn is 1 child and the second-born is twin, you will get exemption for all the 3 children for the travel expenses. So 45,000 for all the 3 children is however exempted. That is, it's not taxable at all. And this 30,000 is also tax-free over here. So both of these are tax-free. So this is going to be the taxable perquisite for this point would be nil. You have to compute the income chargeable to tax in the hands of Mr. Balaji. Clear? See people, this is a very simple question. You need to understand certain small crux here. That's it. Okay. Not a difficult question. Basic salary 50,000 for 7 months, right from April to October, and from November to March it is 60,000. 6,50,000. It's there in the question we have already discussed. DA is 40% of the basic salary, 6,50,000 into 40%, 2,60,000. Bonus I told you for the month of October. 50,000 is the salary for the month of October. Till October it is so much, no? 50,000. 40% of 50,000 because DA is 40% of your basic salary. So the total is coming up to how much? 70,000. I told you employer contribution to RPF 16% of the salary is what considered. Basic salary you have taken. However, up to 12% is going to be exempted. No? So up to 12% of so much 78,000, 26,000 becomes your taxable employer contribution. PT paid by employer is 2,000. Whenever the PT is paid by the employer, first of all, it is going to be added in your gross salary, and then you are going to take the deduction of the entire PT paid by employee and employer in total. See, basically, PT should be paid from your pockets. You are not paying it. Employer is paying it. So it's going to be purposed only for you. So I'm going to add it over here. Facility of laptop, I already told you have to write a note. Purpose of motor vehicle, already discussed, 2,400 per month for 5 months. LTC, lift all concession also discussed. So the total is 10,20,000 deduction. However, 50,000 is available as the standard deduction under section 16, clause 1A. 50,000 and 2,500 as the professional taxes. If you subtract these two out of your gross salary, you will get your taxable salary. That is 9,67,500. Clear? Great. Now let's move forward to the next question. That is the test your knowledge TYK question number 5. From the following details, find out the salary chargeable to tax for AY 26-27, assuming he exercises the option of shifting out of the default tax regime under section 115B. Mr. X is a regular employee of Rama and Co. in Gurgaon. He was appointed on 1/1/2025 in the scale of 20, 1,000 and 3,000. He is paid 10% DA and bonus equivalent to 1 month from the month of March. He contributes 15% of his pay and DA towards his recognized provident fund and DA as forming part of his benefit. C is provided house-free facility, that is rent-free accommodation, wherein which has been taken by the company on rent for 10,000 per month. Higher charges is 10,000 per month. Is also provided with certain other facilities. Facility of laptop costing 50,000. Use of laptop. What is the purpose? Nil, right? Company reimbursed the medical treatment bill of his brother 25,000 who's dependent on him. Monthly salary of 1,000 paid to the housekeeper. Gift voucher of 10,000 rupees on the occasion of his marriage anniversary. Conveyance allowance which is given by the company for the actual reimbursement of official duty is providing this medical insurance personal accident cover policy. It is paid by the company only 5,000. Telephone allowance of 500 per month. See, if you can observe something over here is opting out of default tax regime. Okay, is selecting optional tax regime here. Normal provisions for that matter. Try to understand this point. Which point is it? Scale. Try to understand what is meant by this scale. See, whenever I am taking in, let's consider 50,000, 2,000, just an example, 50,000, not 20,000, 2,000, and this is 80,000. Okay, let's try to understand what is this pay scale actually means. Now, see, whenever you are taking in this point, what it means is that right from the date or right from the month which you have started, not from the financial year or not from the previous year, no consideration of anything. Right from the month in which you started, let's consider from you started in the month of Jan 2024. Okay. Your salary, basic salary for that matter is 50,000. Now, every year, that is completion of 12 months, which is fixed. Same. That is in the next year for that matter. After completion of the 12 months, right from the date of you joining it, your salary will be added with how much? 2,000 until it reaches a position wherein your basic salary reaches 80,000. Understood? So, 2024, your basic salary was 50,000. From 1/1/2025, that is for the entire year, you are getting 52,000. And from next 54,000, next 56,000. It is like this. It started with 50. You are adding the same amount, that is 12 months from the date of you joining. After that, 2,000 will be added till it reaches that particular amount. That's what the pay scale is. If you can observe something here, the pay scale here is how much? 20,000, 1,000 and 30,000. When did he join on 1/1/2025? So from 1/1/2025 to 31st December 2025, his salary will be how much? 20,000. From 1/1/26 to 31st March, sorry, 31st 12 2026, how much will be his salary? 21,000. I hope you have understood what we are discussing here, right? So as per the question, from 1/1/2025, the date which he has joined, he was getting the salary of basic salary of 20,000 rupees till 31st December 2025. From 1/1/2026, he started to get 20,000 plus 1,000 rupees. That is total of 21,000. So can I say, for the purpose of our calculation for PY, what is relevant is from 1st April 2025 to 31st December 2025, that is for the period of 9 months, he was getting a salary of 20,000. And from 1/1/2026 to 31st March 2026, that is 3 months, he was getting a salary of 21,000. Okay, this is the interpretation of this pay scale whenever you are considering. Now, so, apart from this, he is paid 10% DA and bonus equivalent to 1 month based on the salary of March every year. He contributes 15% of his pay and DA towards his RPF. See, if you can observe something carefully here, I told you about this basic pay. You can refer this as working note and you can explain the pay scale information over there. If you multiply and with the relevant months, you will get 2,43,000. Now, DA is 10% of the basic pay given in the question. Bonus is equivalent to the month of March. The month of March, how much you're getting paid? 21,000. So that is the basic pay. Employer contribution to RPF. If you can observe something carefully here, 15% is what been given in the question of the basic salary plus DA. See, when something is given in the question that 15% of the basic salary is being paid by the as the RPF, just take it as it is. If nothing is given in the question, suppose in this question you can see 15% of his pay plus DA towards his RPF. So whatever the RPF, whatever the DA plus salary is getting, on that 15% is what the contribution the employer is making. But how much is exempted? Up to 12% is exempted. You will take the 12% of so much amount and taxable employer's contribution will be 8,090. Facility of laptop, I just told you it is going to be nil because use of laptop and computers, the perquisite is nil. There is no taxable perquisite. Medical reimbursement, which is being paid for the treatment of his brother who's dependent on him, medical treatment which is paid who's dependent on him for that matter, it's going to be taxable. Where is it? It is going to be a taxable perquisite because the reimbursement to be taxable, the reimbursement to be his to be exempted, you have to take it in employer's own hospital. Or it has to be in a government hospital. Sorry, it has to be in a government hospital. So 25,000 is going to be taxable here. Reimbursement to salary of housekeeper is 12,000 rupees is taxable. Whatever the reimbursement you are getting in the form of in the form of for the domestic helps and everything, reimbursement is going to be taxable. But if it is directly paid by the employer, it is not going to be taxable. For non-specified employees, again for specified employees, it's going to be taxable. Let's keep the discussion for another question. Reimbursement to salary of a housekeeper for that matter, reimbursement whatever you're getting, that is going to be taxable. Okay. Gift to voucher. If you can see here, the gift voucher of 10,000 on the occasion of his marriage anniversary. See, if it was on the occasion of his marriage, it was not taxable. As per the income from other sources chapter, you can see that. Gift voucher which is given by the employer, which is excess of 5,000 rupees, it's going to be taxable. So the entire 10,000 is taxable here. See, there are two interpretations. Okay. One, the entire excess of 5,000 is going to be taxable, or the entire 10,000. Entire 10,000 can be taxable or 5,000 can be taxable. Whichever interpretations you want to take it, please write the assumption and take it. Okay. Conveyance allowance of 1,000 per month is given by the company towards actual reimbursement of conveyance. See, this is spent on official duty. So whenever there is an allowance which is given for the purpose of office only, why do you want to take that allowance as taxable allowance? It is non-taxable allowance for that matter. So there it is not included in your salary. He's provided the company has provided him personal accident policy premium of 5,000. So it is going to be what? It's going to be non-taxable purpose. He has a telephone allowance of 5,000 per month. Remember, telephone facility is a tax-free purpose. However, telephone allowance, every rupee is going to be a taxable. So 500 multiplied by 12 months, it's 6,000. So for now, if you want to calculate the RFA over here, okay. See, RFA has a salary definition, bonus plus DA in terms plus all taxable allowance, bonus plus commission. So you need to know all the taxable allowances. So always keep RFA calculation at last. Okay. See now, actual rent paid by the employer given in the question is 10,000 per month. We have already seen in the question. Multiplied by how many months? 12 months. So this is the amount. Or 10% of the salary, whichever is lower, will be considered as your RFA. That is taxable RFA. Salary for this purpose is DA plus basic, basic plus DA, all taxable allowance, bonus plus commission. Do you have basic? Yes. Do you have DA? Yes. Do you have all taxable allowances? If you can observe, this is the taxable allowance. This is not there, however. This allowance is there, but it is not taxable. No. Clearly mentioned in the provision, it is a taxable allowance only. So it is going to be 6,000 plus bonus is given in the question. There is no commission. So we'll add it. We'll get 2,93,000. 10% of that is something which you're going to consider in your RFA. So 29,000. Where is it? 29,430. The total gives you the gross salary and deduction under section 16 clause 1A, where the standard deduction is up to 50,000. Subtract how much we are getting. The income from salary as 3,28,749. Okay, this is your question number 5. Now, see here, this question number 6. Test your knowledge question number 6. You are required to compute the income from salary of Mr. Raja under the default tax regime from the following particulars for the year ended 31st March 2026. He retired on 31/12/2025 at the age of 60 after putting in 25 years and 9 months of service from a private company at Delhi. Retirement time. He's paid salary of 25,000 per month and HRA of 6,000 when he was working. He paid rent of 6,500 during his tenure of service. On retirement, he was paid gratuity. He was covered under POGA and he had not received any other gratuity at any point earlier. Okay, he's getting covered under POGA. Payment of Gratuity Act, it is not POGO, please it's POGA. He had accumulated leave of 15 days per annum during the year of his service. This was encashed by him at the time of his return. A sum of 3,15,000 was received by him in this regard. Employer allowed 30 days leave per annum. He is receiving 5,000 as pension. On 1/2/2026, he commuted 60% of his pension and received 3,000 as commuted pension. The company presented him a gift voucher of 4,000 on his retirement. His colleagues also gifted him a mobile phone worth 15,000 for his own contribution. See, if you can observe over here, this fellow got retired at this particular age, that is 25 years. After being in service for 25 years and 9 months from a private company, he retired. What is he getting after retirement is he's getting gratuity, he's getting leave encashment, he's getting pension. Okay, and these are the other points that we need to consider. So what is that they have asked in the question? They have asked income from salary. See, if you can observe something, he has worked from 1st April to 31st of December. So it's going to be 5,000 multiplied by 9 months. This is what he has got during the period. When he's in the service only, he's getting the salary. After the service, he's not getting any salary. So it's only for 9 months. HRA which he has received is 6,000 into 9 months. Are you going to calculate any 1013A over here? Not at all, because you are doing this computation under default tax regime. Under default tax regime, there is no exemption which is given for HRA. So fully taxable, 54. Now, when you're taking in the gratuity computation over here, how much is he getting? 3,50,000 is covered under POGA. So all of us know what is the POGA. steps, exemptions that you're getting. See, whenever you're getting gratuity, this leave encashment, and this pension, all these are not dependent on the old tax regime or new tax regime. It is available under both. Okay. See now, gratuity receipt is 3 lakh 50. List of the following will be exempted under section 1010 clause 2. 15 days salary of every year completed year of service. If you remember, you are going to take in 15 by 26 for POGA and 1 by 2 for non-POGA, right? 15 months salary out of the total number of days as per total number of days computed as per the payment of gratuity act is 26. Out of that, you are taking 15 days salary multiplied by the salary into number of years of completion of service. For POGA, if you remember, fractions, that is excess of 6 months, is also considered as rounded off to 1 year. So 25 years and 9 months is equivalent to 26 years. Do the calculation, you will get 3,75,000 and limit, however, is 20 lakh. List of the following is going to be what? List of the following is allowed as exemption. So 3,50,000 you take it, the entire amount, the gratuity is nil. When you take in leave encashment under section 1010 AA, 25 lakh is the limit. Leave salary which is actually received, which you can see in the question, is 3,15,000. 2,50,000, that is being 10 months salary, that is nothing but 25,000. See, you have to take the average salary in the third point. 2,50,000 divided by 10, that is the average salary is nothing but 25,000. No, 25,000. You will do the average of the salary and then you will end up with multiply it again by 10. I'm sorry. You will do the average salary and then will again multiply it by 10. You will get 2,50,000 in the point. Cash equivalent for the leave allowed minus leave taken. What is leave allowed? 30 days in a per year is what leave allowed. 25 years is what he has worked in for. So 25 years into 30 days per year for that matter. Minus how many days leave he has taken is the information given. See, he had accumulated leave of 15 days per annum during the period of his service. This was encashed by him. Employer allowed 30 days leave. Leave allowed is 750 minus how much is the leaves taken in 25 years, 375. So total number of days for which he can get the leave encashment is 375 days. See, 375 days divided by 30 days in a month will give you number of months, right? Multiplied by whatever is the average salary that you have calculated, that is 25,000, 3,12,500. So out of this, least of the following is going to be considered for the purpose of calculation, that is 2,50,000. 3,15,000 minus 2,50,000, how much would you get? 65,000 is what you would get. See here, for this third point, for those who have not understood what is this, very simple. What does the provision states? Provision states that 10 months salary into average salary of last 10 months. Okay. See, what do you mean by average salary? What's the salary that you're receiving per month is how much? See, is being paid how much? 25,000. Just there was small error in the ICA material. So that is 25,000 instead of 25,000. They've just printed 5,000. So 25,000 into 9 months, it's going to be 2,25,000, right? So 25,000 is the salary that you're taking for 1 month, 25,000 multiplied by, if you want to get the average salary of last 10 months, you have to divide by 10 and multiply it by 10. Again, you will end up with same 25,000, right? This multiplied by 10 months, this is the actual formula. So 25,000 into 10, this is what 2,50,000 which they are speaking about. Don't be confused, right? Okay, this is just the understanding that we can get. So average salary is what you're going to take here also. So 25,000. See, if you want comfort in this, you can do this. Like you can take the material and you can see in my material here. 10 months salary into average salary of last 10 months, unavailed leave multiplied by average salary of last 10 months. Okay, whatever average salary of last 10 months you have taken here, you will take multiply the same year. You will consider the same. This is also 25,000. No, for your understanding then. So 25,000 25,000 into 375 divided by 30, you will get the number of, it will be converted into months. Multiplied by 25,000, it will get number of months equivalent calculation. That is 3,12,500. If you can see here in leave encashment, whichever is least will be allowed as exemption. That is nothing but 2,50,000 is allowed as exemption. Clear? See, all of us know uncommuted pensions are always taxable for government employee, non-government employee, any employees for that matter, it is fully taxable, right? So uncommuted pension received is how much? 5,000. It's given in the question, given in the question, given in the question. Where is it? It's here only, no. It's receiving 5,000 as pension every month from 1 to 2026. He commuted. From this time, he commuted 60% of his pension and received 3 lakh as commuted pension. See, if his commuted pension is how much? 60%. Right? Pensions are of two types, commuted and uncommuted. Commuted means in lump sum, uncommuted means monthly or in a periodic way. 60% if it is representing 3 lakh, how much is 100% representing? Can I say, if you divide 3 lakh by 60%, won't you get how much is 100%? How much? Please do the calculation. 3 lakh divided by 60%. 5 lakh is 100% of the pension, right? So, 1 month he has received the pension as it is. That is, for the month of January, December he retired. Pension started from January. So, 5,000 like a good person is received 5,000 into 1. Completely January month pension is received. He has commuted 60%, but remaining 40% is still uncommuted only, no? So, out of this 5,000 rupees, whatever I was receiving every month, if this is representing 40%, out of this I should take only 40% now because 60% is already commuted. So, out of this 5,000, which I received as 100% of the pension in January, for the month of Feb and March, I will be receiving only 40% of it because 60% is commuted. That 40% is representing 5,000 into 40. How much? 5,000 into 40%. 2,000 multiplied by how much? 2 months. Feb and March. 2 months. So, how much is it going to be? 4,000. So, 4,000 plus 5,000 total is 4,000. Clear? So, commuted pension is 3 lakh. And under section 1010A, the commuted pension you already know that is going to be representing as 5 lakh. You have received gratuity also. Now, only 1/3 of the pension will be allowed as exemption, not 1/2. So 1/3 of this amount is going to be 1,66,667. 3 lakh minus 1,66,667 you have done, you got 1,33,233. Right? This is your uncommuted pension. Why are you taking 1/3, not 1/2? Because 1/2 of the pension, if you have got as exemption amount is higher and your taxable pension will be lower. If you're already getting gratuity, think you're already getting exemption under the gratuity section only. They don't want to give you a higher pension over here. That is the reason they are limiting it to 1/3, not 1/2. Right? Gratuity received, pension, the gratuity received, pension is also received. As you're already getting exemption from gratuity, income tax department doesn't want to give you the more exemption in pension. They want to give less pension. They want to give less exemption in the pension. That's the rule. See, gift voucher, whatever you can see it as, if it is excess of 5,000 rupees only, it is going to be taxable. How much is provided here? He is getting gift voucher of 4,000, less than 5,000. So, it is going to be exempted. It is not taxable. His colleagues also gifted him a mobile phone worth 50,000 from their own contribution. So, if you can see something from this own mobile phone contribution, this doesn't come under your salary concept. It comes under income from other sources. Why is it so? Because colleagues doesn't fall under the definition of employer. Colleagues are friends. You received any gift excess of 50,000 is going to be taxable under section 56. Section 2 clause 10, that is gift provision. But here it is not coming under the gift provision because it is less than the exemption limit. So it is nil. Okay. And all of us know the standard deduction. How much is it? 75,000 is the deduction that we have. 75,000 is the deduction that we have for what? For as a standard deduction for default tax regime. This fellow is opting for default tax regime. Hence, we are giving 75,000 as deduction and we got the net salary as 4,11,330. Clear? Now, test your knowledge. Question number 7. Miss Akanksha, a salaried employee, furnishes the following details for the financial year 2025-26. Basic salary 6,20,000, DNS allowance is 4,20,000, commission is 75,000, entertainment allowance is 9,000, medical expenses reimbursed by the employer is 18, professional tax paid is so much, medical insurance premium paid by employer is so much, life insurance premium of Akanksha paid by employer is 26,000. Laptop provided for use at home. Actual cost of laptop to employer is 45. Children of the SSC are also using the laptop at home. Employer company owns a Maruti Suzuki Swift car which was provided to the SSC both for official and personal use. Driver was also provided. Engine cubic capacity more than 1.6 liters. All the expenses are met by employer. Annual credit card fees paid by the employer is credit card is not exclusively used for official purpose. Details of usage are not available. 7,000. You are required to compute the income under the head if she pays the tax under the default tax regime. See, basic salary is also given in the question. 100% taxable. D is 100% taxable. Commission is taxable. Entertainment allowance is taxable. She is not given any information as she is a government employee or something. So, all these informations are going to be taxable. Medical expenses reimbursed by the employer. If the medical expenses reimbursed by the employer given as government hospital, only then you can take it as tax-free purpose. Otherwise, it's fully taxable. Whatever the professional tax paid by the employer will be taxable. That is included in the income included in your gross salary for that matter. Health insurance premium of 8,000 paid by employer. Health insurance is paid by employer exempted. How about life insurance paid by employer taxable? Remember, very, very important point these two are. Medical insurance paid by employer exempted. Life insurance paid by employer on behalf of employee is taxable. This is tax-free. This is taxable. Right? Laptop which is provided for use at home. I already told you. For the purpose of use, laptop and the computers are nil. There's no taxability over there. Provisions of motor car driven with driver for that matter. Engine cubic capacity is more than 1.6 liter. Owned by employer and it is given to employee. The purpose it would be how much? Yeah, 2,400 per month. No. And the driver is also given. So it is going to be 900 extra. 900 if the driver is also provided by employer. So 2,400 cubic capacity is more than 1.6 liter given by employer and it is expenses are been incurred by the employer. So employee will get 2,400 as a taxable perquisite. Driver is also given. So 900 is the taxable perquisite. 2,000 plus 400 plus 900 into 12. Or you can do a separate multiplication also. That's also totally accepted. You can do it together also as done by IC. No problem. Okay. 39,600. The credit card fees paid by employer on behalf of employee, even though if it is used exclusively for office purpose, obviously it is not going to be taxable. Not used exclusively for office purpose. And what you have used, there is no bifurcation of the same. It is going to be what? 7,000 rupees is considered as your taxable purpose. So the gross salary is so much, 12,16,600. Standard deduction under section 16, as this is under the default tax regime, is going to be 75,000. Income chargeable under the head salaries will be 11,41,600. Clear? The next question from your test your knowledge. Mr. Kunal, age 27 years, is an employee in a private company posted in Delhi. He was appointed on 1 to 2024 in the scale of 60,000, 1,000 and 70,000. Okay, furnishes the following information. DA is given, bonus equivalent to 1 month salary is given, leave encashment for PY 25-26 is given. He also received a motor car on 1/12/2025, cubic capacity more than 1.6, along with the driver for both official and personal purpose. Motor car is owned by employer. All the expenses are made by employer. So it's going to be 2,400 plus 900 as we saw similar to the previous question. Okay. His employer granted him a loan of 2 lakh on 1st June 2025, which is repayable in equal quarterly installments over 2 years, starting from 1st October 2025. The State Bank of India SBI lending rate for such loans is 9.5%, but however, employer has given 5.5%. You have already seen that. You are already smart enough to know that this is concessional rate of interest purposes, 9.5 SBI lending rate minus 5.5%, whatever the interest rate you get as a difference, that multiplied by 2 lakh, right from 1st June. No, so April, May, June. So you have to take it for 10 months. 10 into 12. 10 divided by 12. His employer gave him interest-free RFA, rent-free, not interest-free, rent-free accommodation in Delhi on 1/4/2024. His house is owned by the employer. The perquisite for such rent-free accommodation during the previous year was valued at 92,000. Further, the accommodation is continued to be provided by the employer to the employee in 2025-26 also. The furniture and the appliances provided with the house were bought by the employer at an aggregate cost of 1,50,000 on 1 month 2024. Electricity and the water bills is 5,000 per month for the said house and were paid by the employer. Cost inflation index information is given here. His colleagues gifted him a phone worth 45,000 from their own contribution on account of his marriage. You are required to compute the income chargeable under the head salaries in the hands of Mr. Kunal for AY 26-27, assuming he has paid the tax under default tax regime. So everyone, this is a question which has been added as a new question into your material. It's a latest question only. Here, a very interesting as well. See, Mr. Kunal, this fellow in a private company posted in Delhi for that matter. He was appointed on 1/2/2024 in the scale of 60,000, 1 lakh and 70,000. Just before this question, the question number 6 or 7, some question number had the point of scale understanding over there, right? We have spoken about that scale understanding detail in that question. So, 60,000 from, let's consider from 1/2/2024 to 1/2/2025, how much would be the salary this fellow would be getting? 60,000. We know. From 1/2/2025 to 1/2/2026, how much this fellow would be getting? 60,000. It might be increased by 61,000. And again, from 1/2/2026 to 1/2/2027, how much this fellow would be getting? He would be getting 62,000. Okay. Very, very good question to understand this pay scale application over here. See, this fellow started in 2024. Okay. And this period, whatever you can see, this is irrelevant for the question, but it is irrelevant for us to understand this from 1/2/2025 to 1/2/2026. That is 61,000. Right? This period, we need not understand anything. We need not consider this because we are looking for PY 25-26, which is important in these two brackets, right? From 1/2/2025, for our understanding, from 1st April 2025 to 31st of January 2026, how much is it? 61,000. So can I say for 10 months, you are taking 61,000 and for remaining 2 months, you are taking 62,000. Clear? 10 months, 61,000 and for 2 months, 62,000. Total is 7,32,000. Here, D is 25% of the basic salary. However, 60% is forming part of retirement benefit. We'll take this understanding in later, which is needed in the other stage. But however, 25% of the basic salary is your DA. Fully taxable? Yes, fully taxable. Whatever is your basic salary calculated, 25% of that you are going to get, right? So if you can see here, bonus is equivalent to 1 month's salary which is paid in November. Directly don't jump and say 60,000 is my salary. Array, no, no, no. November is falling within this bracket, right? So it is 61,000. So November salary is 61,000. Leave encashment for PY 25-26 is 10,000. You need to do the calculation. No. People leave encashment received during the service is fully taxable, right? Only received during the retirement, or that is after the retirement for that matter, when you are receiving. There you do the calculation. But however, you are receiving during the service, it's fully taxable, right? I told you with regarding to this motor car, cubic capacity greater than 1.6 liter, driver also given, used for personal official purpose both. This motor car is owned by employer, expenses met by employer. So 2,400 rupees is the perquisite, plus driver is 900. So the total is 3,300. Received the car from which time? 1/12/2025. So it is going to be how many months? 4 months. So 3,300 into 4 months, 13,200. Clear? So the next point is interest on loan. Here you can see these two is the difference. That is the 4% is the concessional rate of interest which you are getting it. For what purpose? Multiplied by 2 lakh from 1st to June. That is for 10 months. However, if you can observe something, you have to make the yearly quarterly. It is repayable in equal quarterly installments over 2 years from 1st October. So can I say quarterly means in 1 year you will get 4 quarters. For 2 years means total within 8 quarters you have to repay this entire 2 lakh. Right? So 2 lakh divided by 8 quarters basically. Can I say 25,000 you have to repay within all the quarter? 25,000 you have to repay in each quarter. So if you can do the computation here, initially till September it will be the same amount. So 2 lakh multiplied by 4% into 1 by 2. If you do into 1 by 12. If you do, how much should you get? You'll get 667 only, no? Please do it, please do it. 2 lakh into 4% divided by 12. You'll get 667 only, right? You'll do the similar calculation. You have made the 25,000 repayment before October. So 1,75,000 into 4% into 1 by 12 if you do, and you do the similar calculation. After October, the next quarter starts with January, right? Again here you will pay 25,000 minus. So whatever calculation you have done, you will get the total of 5,917 as interest on loan. You will take it and close. See, rent-free accommodation, here there is a catch in this question, and that is why I told you this is a very good question for you to practice. This fellow gave you rent-free accommodation very well in Delhi. Okay, Delhi means all of us know the population is greater than 40. This house is owned by the employer, and perquisite for this rent-free accommodation during the month is the total perquisite value. They themselves has given this value. Further, the accommodation continue to be provided in PY 25-26. This accommodation started in the last year. So ideally speaking, as per the rule 3, whatever the value perquisite which persists over there in the previous year, that is in preceding the previous year, if the employer is continued giving you rent-free accommodation for the relevant year also. Last year you were in, this year also you are in. So, whenever you are taking that, whatever RFE calculation you do, okay, now there is a limit that you need to set it to calculate what is that exact value perquisite that you are going to take it. I'll come to this point later. Let's speak about this point. 92,000 is what you are paid in PY 24-25. This year, you can consider the taxable perquisite as something wherein you need to do the cost inflation index for this. 92,000 was the expenses which I made, or which the employer made for the purpose of the rent over there. It means 92,000 divided by, if this is This 92,000 was the expenses for the cost inflation index of 363. How much should be the actual inflation of cost that should have happened is 95,295. If 92,000 is the cost for the CII of 363, how much should have been the actual cost in this relevant year? 376. It should be the maximum of 95,297. That is, your taxable RFA can't exceed this. Understood? Very simple. You have to do this calculation. This amount or whatever you get over this amount, whichever is lower will be your taxable purpose. I hope it is understood. Clear? Now, so whatever rent-free accommodation you are taking, Delhi, so it's going to be 10%, population more than 40. For the purpose of salary calculation, all of us know it is basic plus DA in term plus turnover commission, plus commission bonus plus all taxable purpose. Basic you have DA is 1,83,000. In terms is only 40%. No, sorry, 60% given in the question. 10,000 is the allowance, encashment. 61,000 is the bonus. You take the entire amount, 9,15,100, 10% you do, you will get so much. Value of purpose it all, value of furniture. It's a furnished accommodation. So 1,50,000 is what you are getting. On the 10%, 15,000. Total you will get RFA as 1,06,510. Okay. Now, electricity and water bills of 5,000 per month for the said house was paid by the employer. So, whatever the reimbursement which you are getting as 5,000 over here, what is it going to be? 5,000 per month multiplied by 12. It's going to be fully taxable purpose. Mobile phone which is received as gift from worth 45,000 from their own contribution from the colleague. See, colleague is not employer. So, gift given by colleagues or you receiving any gift from the colleagues will be considered as under income from other sources, not under salary. So, 45,000 you are going to consider it as the income from other sources. However, it is not exceeding the limit. It is within the limit given under section 56 subsection 2 clause 10. So, you are taking it as nil. All of us know the standard deduction is 75,000 for the default tax regime and the net salary is 10,87,912. Illustration 1. Mr. Rajkumar has the following receipts from his employer. He has the basic pay, DNS allowance, commission, motor car for personal use and HRA. We have to find how much is the HRA that is exempt in the hands of Mr. Rajkumar and we have to make an assumption that he has been paid 16,000 for his accommodation at Kanpur and DA forms part of his salary for retirement benefits, that is whatever DA he has, the entire DA forms part of the benefits, that is DA it is in terms. Mr. Rajkumar exercises the option out of to shift out of default tax regime. That is, you are supposed to prepare the solution with normal provisions in picture. Okay. So, what have they asked you? They have asked you to prepare how much is the HRA exempted, not the total income computation question. This is illustration 1. So, it's a concept based question. How much is the HRA received? House rent allowance received is 15,000 into 12. That is 1,80,000, right? And now you have exemption under section 10 subsection 13A. That is lower of the following. Actual amount received 1,80,000. Excess of the amount paid, that is nothing but can I say rent paid minus 10% of the salary. Salary definition, that is basic plus DA interns plus turnover commission. Do you have the basic? Yes, basic is there. That is the 40,000 rupees per month. Multiplied by 12, you will get the basic. DA, the entire DA forms part of your salary definition. And then, do you have the commission? Yes. But is it turnover commission? Only turnover commission is included in HRA exemption, not anything else. So 10 subsection 13A states about turnover commission. I repeat, turnover commission, not a normal commission. This is a fixed commission which is given, not a turnover commission. If in the question, if they would have stated it as turnover commission directly and given 50,000, please do take it in your solution. If nothing is given and they have stated a fixed amount, please don't take it. If they give commission on profits, please don't take it. Only turnover commission should be considered. Suppose how it would be given. If they give the commission and they give you 1% on sales, right? 1% on sales and they give you sales is 50 lakh rupees, right? 50 lakh into 1% leads to 50,000 you would have considered. So that is the commission that you will take. Only the commission which is given in percentage of sale, only that is called as turnover commission. All this fixed commission you will not take. In the question, they have given directly as turnover commission. Please do take it because they are expecting you to take the same in your calculation. And after that, if you do, how much is the rent paid given in the question? 16,000 rupees per month. So 16,000 into 12, 1,92,000 and minus 10% of the pay. That is nothing but the total multiplied by 12. You will get the so much. Then where is this fellow staying? This fellow staying in Kanpur or this fellow is staying in metro cities? This fellow is staying in Kanpur. It means it is a non-metro city. Non-metro city means 40%. How do you identify metro city and non-metro city for? A metro city, you consider four. Apart from those four, whatever you have, those will be considered as non-metro cities. Okay. 40% of the salary, you take the same and you close it off. So this is then lower of the following will be considered as your HRA. That is 1,36,800 will be your HRA. And the taxable HRA is 43,200. How did you get this? This minus this, you will get 43,200. Right? This is your illustration 1. Illustration 2. Mr. Shrikant has two sons. He is in receipt of children education allowance of 150 rupees per month for his elder son and 70 rupees per month for his younger son. For both of his sons are going to school. He also receives the following allowances. That is transport allowance is also received and tribal area allowance is also received. Computers, taxable allowance. All of us know how much is the children education allowance, right? So children education allowance is 100 rupees per month. Hostel allowance is 300 rupees per month. So out of 150 rupees every month, subtract 100. So the difference of 50 will be taxable. That multiplied by 12 will be so much. Right? Younger son, maximum for how many children can you get this children education allowance? Maximum for 2 children. It can be for own children. In the question they give you as adopted child. Please do consider that because children includes both. Younger son, 70 rupees is what they've given, and up to 100 rupees you have the exemption that you can take. So, minus 70, you will take the entire amount. Nothing is taxable in the children education allowance for your younger son. Transport allowance is already given. Is your exemption available or not? Not available because exemption, that is transport allowance is exempted for handicap, deaf, dumb employees, not for the regular employees. So transport allowance 1,800 multiplied by 12 months, you will get so much. Tribal area allowance, so 500 into 20, sorry, 200. 500 minus 200. 200 is the tribal area allowance which is allowed, and 500 is what you have received. So 500 minus 200 every month, 300 multiplied by 12, you will get so much. So how much is going to be taxable? 25,800 is the taxable amount. And they've just told you compute the taxable allowance. So we are doing it shifting out of default tax regime, and also we are doing it opting in for 150 BSA default tax regime. So children education allowance, however, whatever might be the situation, any allowance for that matter is not available for your 150 BAC, right? Children education allowance is not there. So 150 plus 70, the entire amount multiplied by 12, whatever the allowance which you have received is going to be taxable. Transport allowance, as usual, taxable. Tribal area allowance, there is no exemption that is available in the normal situation, whatever was available. The same thing is not available for 115 BAC. Only limited deductions are available, 100, 115 BAC. Exemptions are totally not allowed. So you will take the total taxable allowance. Illustration 3. Mr. Sagar, who retired on 1/10/2025, is receiving 5,000 per month as pension. On 1/2/2026, he commuted 60% of his pension and received 3 lakh as commuted pension. You are required to compute his taxable pension, assuming he's a government employee, is a private sector employee, and received a gratuity of 5 lakh at the time of retirement. Is a private sector employee and did not receive any gratuity at the time of retirement. So, what is the question speaking about? Question is speaking about the pension, and you have to compute the pension. First situation, government employee. All of us know these are lucky people in life. Commuted pension, for that matter, whatever you have received as commuted pension, you being a government employee, it's going to be exempted under section 1010A, right? It is going to be exempted. Government employee, uncommuted pension is going to be exempted. Nothing will be taxable. However, uncommuted pension will always be taxable for government employee and non-government employee. That is a private employee for that matter. See, how much is the uncommuted pension this fellow has received? This fellow retired on 1/10/2025. Ideally speaking, from October month, he would be receiving the pension. He received 5,000 rupees pension, 5,000 rupees as pension, and 1/2/2026, he commuted 60%. So, can I say this 5,000 rupees till 31st of January 2026, this fellow would have received the entire amount as his, that is 5,000 rupees, he would have received as his pension every month. That is from October, November, December, January. 4 months he would have received the entire 5,000, and 60% of his pension is received as commuted pension. What does it mean? This 60%, 3 lakh is representing 60% of his total pension. How much is this? 100%. If you do a simple cross multiplication, won't you get it? Right? So how much would you get? So if you do that, I guess you will get 5 lakh rupees. Do calculation from your end, you will get 5 lakh rupees. So this 5 lakh rupees, you are going to get the, your total pension would be 5 lakh rupees, right? So can I say in other term, this 5,000 rupees, whatever you have received as pension, this out of this 5,000, can I say this is representing 100% of your pension for 1 month, right? The total pension which you have received, on that equivalent portion of 100% for 1 month, how much you would have divided, this would represent 100%. If 60% is withdrawn, it means remaining 40% of his whatever every month the pension he would be receiving, he would receive the same for 2 months, that is for February and that is for March. If you do the calculation, you will get 24,000, right? Now, he is a private sector employee. So, to keep it in short, 24,000 rupees, and there is no commuted pension that would be taxable. The entire 24,000 would be taxable for government employee close. He is a private sector employee and received gratuity of how much? 5 lakh rupees at the time of retirement. This fellow has received the gratuity on one side and he has not received the gratuity at another side. So there is only one changes which you need to consider over here. Uncommuted pension, we have already done the calculation here. Same thing goes for the calculation here. When you have received the gratuity, you will get the exemption of how much? 1/3. When you have not received the gratuity, how much is the exemption that you will get? That is 1/2. That is the only difference that you have between point B and point C. Commuted pension received is 3 lakh. Exempted under section 1010A is so much, right? That is 1,66,667. This would be subtracted and you will get so much. And taxable pension would be so much, right? And commuted pension would be 3 lakh. And if it is exempted under section 1010A, it is 2,50,000. Taxable pension would be how much? 74,000. You subtract this 2,50,000 from this 3 lakh, you'll get 50,000. The total of 74,000 is taxable here. 1/3 is 1,66,000. So much is taxable here, right? Okay. Illustration 4. Mr. Ravi retired on 15/6/2025 after completion of 26 years and 8 months of service, received gratuity of 15 lakh at the time of retirement. If salary was basic salary 50, DNS allowance 10,000. However, only 60% forms part of his retirement benefits. Commission is how much? 1% of the turnover. Turnover in the last 12 months was 1 crore 20 lakh. This is something called as turnover commission, people remember. 1% of turnover, 1% of sale value, 1% of sale. They can give multiple terms. But turnover commission means this. Bonus is 25,000 per annum. Compute is taxable gratuity, assuming he is a private sector employee covered under the payment of gratuity. He is a private sector employee not covered under payment of gratuity. It means this is under POGA, this is not under POGA. He is a government employee for that matter. See, all of us know the gratuity calculation which is coming under POGA and which is not coming under POGA. POGA, that is not POGO, that is POGA, Payment of Gratuity Act. So first is, if is getting covered under the Payment of Gratuity Act 1972. So now, gratuity received, how much he has received? Everyone, gratuity received how much? 15 lakh rupees close. Exemption which is available under section 1010A. Least of the following will be available as the exemption under section 1010A, that is gratuity received is so much. Statutory limit, all of us know it's already 20 lakh. And 15 days salary divided by 26. See, total number of days in a month is considered as 26 as per POGA, and it is considered as 30. 15 by 30 is the short form for this, right? So 30 for non-POGA. Hence, for POGA, we have 26 days. Out of the 26 days, we are taking 15 days salary and we are multiplying it with the last drawn salary. How much is the last drawn salary here? 50,000 plus 10,000. Remember, for payment of gratuity act, DA is not in terms. DA is the entire DA will be considered for the purpose of salary calculation. What is it? This is DA. Salary definition is DA total basic plus DA total, right? It is not just in terms, it is the total of 10,000. And number of years of service. We have benefit that is 26 years and 8 months if we have. We can consider it as 27. That is, we can take out the fractions and we can include the fractions. 26 years and 8 months, we can consider it as excess of 6 months will be considered rounded off to the higher number. That is 27. 27 you have. You do the calculation, we'll get this. What is the difference between POGA and non-POGA is just at this point, right? We have already seen we are going to consider 15 by 30. If you simplify, it will be 1 by 2. Average salary of last 10 months. If you want to take this average salary of last 10 months, 50,000 into 10, I've already told you DA for POGA is in total, but DA for non-POGA is equal to basic plus DA in terms. This is in terms, right? And also, here there is no turnover commission included. Here we are going to include turnover commission also, right? How much is the turnover? 1 crore 20 lakh. 1% is the turnover commission, right? But we have to take it for the average, right? If you do this, won't you get 1.2 lakh? Yes. Out of this 1.2 lakh, whatever you're considering, this is for 12 months. But we need it only for 10 months, no? Only then we will get 10 months equivalent of your commission. So you will do the calculation, you will get everything, you will multiply here by 10, 10 months, 10 months and 10 months. This you will get for 10 months total. And then again, if you divide it by 10, you are going to get the average salary, which is nothing but the average salary of last 10 months, right? If you want a detailed notes, what you are seeing here or my summary material, the full-fledged material, you can find that in my Telegram channel. You can get it over there. Okay. So much into 26 months. Why are you considering 26, not 27? Because fractions, part of excess of 6 months privilege is available only for POGA, not for non-POGA. So 8,58,000. Least of the following is going to be exempted. However, 8,58,000 is the exemption and the taxable gratuity 6,42,000. Clear? Now, he is a government employee. Government gratuity received 15 lakh. Exemption under section. Government employee, no, I told you, is a lucky person in this lifetime. Entire amount is going to be exempted. So, taxable gratuity is nil. Illustration 5. Mr. Gupta retired on 1/12/2020 after 20 years of service and received a leave salary of 5 lakh. Other details are as follows. Basic DA, commission, bonus. Leave availed is so much and he was entitled to a leave of 30 days leave. And you are required to compute his taxable leave salary, assuming he's a government employee and a non-government employee. See, this is a very good question for you to practice. So how you're moving forward with question, I'm assuming that whichever question I'm solving in, you're watching that question, going back, solving those questions by yourself, and then coming back to the next question. That is how you're supposed to do. Otherwise, you can consider some 4 to 5 questions or some 10 questions in a sequence. If you find it easy or you've already done it once, and if you just want to go through, you can watch it in 1.5x or 1.25 or 2, whatever you're comfortable with. Watch and move forward. Otherwise, if you're doing it for the first time, watch the video, pause it, go solve it, then come back to the next question. Clear? This is how you're supposed to do. Is a government employee, leave salary received at the time is 5 lakh. How much is the exemption that is available? For that matter is going to be for leave for government employee, the entire amount received during the that is after retirement for that matter, it is going to be exempted. However, remember, if it is received, gratuity received, pension received, or the leave encashment received during the service, it is going to be taxable. During service are taxable, Retirement only exemption is available. Is a non-government employee and the salary, leave salary received is 5 lakh. How much is the exemption available? Is going to be leave salary received 5 lakh. Statutory limit for this is going to be 25 lakh. 10 months of the salary, that is average salary of last 10 months multiplied by 10 months is what they are stating. Right? First, you have to take average salary of last 10 months. Okay. First, to do this calculation. And then give the multiplication of 10 months equivalent salary. Right? If you do that, 5,000 into 8, then plus DA 4,000 into 2. And then if you take 60% of it, where is it? See, 3,000, 60% only you have to take. This is the DA. And you can see here 5,000 rupees was your salary. 1,000 was increased with effect from 1/4/2025. When did this fellow get retired? On 1/12. So if you consider, if you go backward for last 10 months, can I say he will go backwards and count November, October, what is it? September, then August, July, June, May, April, March. How many months? 1, 2, 3, 4, 5, 6, 7, 8, 9. Then take February. So you have to go backward from November to February, right? If you can see, this 1,000 was increased with effect from 1/4. That is with effect from this date, which you can see there was a increase. That is 5,000 rupees was the salary which you have received from November to April. 1,000 rupees is the increase, means 4,000 is what you would have received for last 2 months, no, for March and Feb. Leave salary, definition of salary you are going to consider prior to your retirement date. Last 10 months you will take. How much is it? 8 months into 5,000, 4,000 into 2 months. So you are going to take the same and close. DA in terms only. If you do the calculation divided by 10, you will get average salary of last 10 months. And then as per the provisions, you have to take 10 months equivalent. Again multiplied by 10, you will get 6,600. This answer, you will get 6,600 multiplied by 10, you will get 66,000. And the fourth point shall be, whatever the leave which is been due, leave allowed minus leave taken, that is nothing but unavailed leave. Unavailed leave multiplied by average salary of last 10 months is what you need to take it. Right? Average salary of last 10 months. Average salary of last 10 months is 6,600. This calculation speaks about average salary of last 10 months. So it is going to be 6,600. Right? And now you need to convert the number of days into months, because months only, no, the salary is equivalent to. So 120 days is what the leave is supposed to be, is unavailed. How much is leave availed given in the question? How much? 30 days leave every year. 30 days leave per year multiplied by how many years? Multiplied by 20 years. So 30 days leave per year multiplied by 20 years minus 480 days. How much is it? Minus 480 days. 30 days leave into 20 years. You will take total leave allowed. How many days leave this fellow has already taken? 480 days leave. You will subtract that. You will get the unavailed leave that you are multiplying with months divided by 30. And then you are multiplying with 6,600 every month. How much is the average salary that you're getting? If you do this calculation, you'll get 26,400. How much is the least of the following? Is 26,400, which is going to be exempted. That itself is your taxable leave salary. Illustration 6. Mr. A retires from the service on 31st December 2025 after 25 years of service. Following are the particulars of his income investments for the previous year, for the PY 25-26. What is the information they have given about? They have given about the basic pay 16,000 rupees per month for 9 months. DA 50%, which forms part of the retirement benefit, 8,000 rupees per month for 9 months. Lump sum payment received from an unrecognized provident fund is 6 lakh. Deposits in the PPF is 40,000. See, out of the total amount received from this unrecognized provident fund, the employer's contribution was 2 lakh 20, and the interest thereon was rupees 50,000. The employee's contribution was 2 lakh 70,000, and interest thereon was 60,000. What is the taxable portion of the amount received from the unrecognized provident fund in the hands of Mr. A for the assessment year 26-27? Okay, see, what is that they've asked in the question? They've asked about what is the amount of unrecognized provident fund that would become taxable. Whenever you are dividing some information into this unrecognized provident fund, remember, unrecognized provident fund, basically you have employees contribution and employers contribution, right? And in this employees contribution, you have interest on employees contribution and interest on employees contribution. So there will be total four portions that would be coming under unrecognized. What are those? Employees contribution, interest on employees contribution, employers contribution, interest on employers contribution. So whatever the contribution which the employee has made, all of us know ATC deduction is available. Array not available. ATC deduction is not available for unrecognized provident fund. What does it mean? It will be taxable. Well, like uh, whenever this contribution was made, you wouldn't have deducted, so that would have automatically got tax in that particular year, right? See, in order to understand this, I'll explain a small point over here. Here only I'll explain. Let's consider this is recognized and this is unrecognized. Okay. Let's consider your total salary. I'm just considering basic here is 1 lakh and 1 lakh. What happens in recognized provident fund? Let's consider the PF which you have. The PF deductions which you have is 20,000. Okay. Employees contribution. So how much would be your taxable salary here? 80,000, right? But in case of unrecognized provident fund, the employee's contribution is not allowed as deduction. Hence, entire 1 lakh is taxable in the year in which you received that amount, right? So it means to state unrecognized provident fund, you will not get any ATC deduction, and employees' contribution to this extent of 20,000 rupees, whatever you had, it was taxable in the same year. Hence, the employees' contribution of the unrecognized provident fund at the time of you receiving that amount, at the time of you receiving the amount, will not become taxable because it's already a tax in the year in which it is in the year in which it is received as your salary. I hope it is clear. Now, hence we are not considering that there is no deduction. However, you have interest on employees' contribution, employers' contribution, and interest on employers' contribution. Remember, interest on employees' contribution, it is categorized under income from other sources. Employer contribution and interest on employer's contribution, employer's portion of RPF and interest on employer's share will be taxable under the head salaries. However, interest on employees will be taxable under the head income from other sources. It's just that whatever amount you have received, they've just asked you the unrecognized provident fund information. You're going to record the same. 2,20,000 is the employer's contribution taxable under the head salary. Interest on that taxable under the head salary. Employer's contribution, I told you this is going to be taxable in that respective year only. So whenever you receive the amount, it is not going to be taxable. Interest, however, it is going to be taxed on the income from other sources. So the total amount which would be taxable is 3,30,000. Clear? Will your answer be different if the fund mentioned above was a recognized provident fund? Definitely my answer would have differed. See, since the fund is recognized one, the maturity is taking place after the service of 25 years. So the entire amount received on the maturity will be fully exempted from your tax because it is RPF, recognized provident fund. Okay, next. Mr. B, working in XYZ Limited, he has given this following information. You have to compute the gross salary. Basic salary 10,000 per month. DA 50% of 50% is for the retirement benefit, 8,000 per month. Commission as a percentage of turnover 0.1%. Turnover during the year 50 lakh. Bonus, gratuity. Own contribution to RPF. Employees contribution to RPF 20% of his salary. Interest accrued in RPF 13%, that is 30,000. Now, what are you supposed to do? Very simple. You have to supposed to calculate the gross salary. Basic salary is 100% taxable. DA 8,000 fully taxable. Commission as a percentage of turnover 0.1% on this turnover of 50 lakh rupees. How much should you get? 5,000 rupees. Then bonus will be fully taxable. Gratuity Did he receive during the service or after retirement? Yes, received during the service, hence it is going to be fully taxable. Employer's contribution to RPF 20% of his basic salary, up to how much it's going to be exempted? Up to 12% it's going to be exempted. Excess of 12%, that is 8% of whatever you calculate here becomes taxable. Say 20% of 1,20,000 of the basic salary is 24,000. However, you have exemption up to 12%. 12% of what? See, basically, these people have contributed 20% of basic salary. But whenever you are taking in or calculating the exemption, this exemption will combine basic plus DA in terms. Okay, of that amount, 12% of basic plus DA in terms. What they have mentioned is that in RPF, 12% of the salary is the definition. Salary for the purpose of provident fund is basic plus DA in terms. Basic plus DA in terms plus turnover commission, right? So that is the definition of salary. Of that salary, 12% is going to be exempted. That is what the calculation is about. This is basic. This is DA, 50% is falling in terms, and 5,000 is the turnover commission. Total is 1,73,000. Of that 12%, 20,760. See, you have to be very, very careful at this point. Listen, everyone, listen. 20% of the basic salary is the calculation for RPF contribution which the employer has made. He paid out of his pocket, keeping this 1,20,000 in base, 20%, fine. But for the purpose of exemption, we have 12% of the salary. Salary for the purpose of RPF or the salary for the purpose of PF would be basic plus DA in terms plus turnover commission. See, how much is the basic here? How much is the DA in terms? So much. How much is the commission? So much. You get so much of that 12%, you calculate and you will get it. Right? Interest accrued is how much given in the question? It's 13%. That is 13,000 is given in the question. However, the exemption is available for RPF under RPF. And how much is the percentage which is exempted? 9.5% per annum is exempted. How much is it? 9.5% per annum. So 13,000 minus 9,500, how much is it going to be? 3,500. This becomes your, you add everything after doing the calculation, you will get 2,92,740. This is your gross salary. Clear? Illustration 9. Mr. Dutta received voluntary retirement compensation of how much? 7 lakh after 30 years, 4 months of service. He still has 6 years of service left. At the time of voluntary retirement, he was drawing basic salary of 20,000 per month. Dearness allowance, which forms part of his pay, is 5,000 per month. Compute is taxable. Voluntary retirement scheme for this point. See, voluntary compensation which is received is 7 lakh after 30 years and 4 months of service, right? So, how much is the compensation that is exemption that you can get under section 1010C will be least of the following. That is actual compensation received 7 lakh in this case. Statutory limit is 5 lakh. You are going to get 3 months equivalent salary for the number of years of completion of service, right? Salary for this purpose would be basic plus DA. How much is the basic? Basic is 20,000 and DA is 5,000 forming part of the salary. Into number of completed year of service, 3 months salary equivalent. Number of completed year of service is 3 months. See, proportion basis higher you have to take. It should be more than 6 months. No. But here it is not the case. It is 30 years is the what you need to consider over here. So 30 years, 22 lakh 50,000 you will get. And then the last point will be last drawn salary into remaining months of service left. What have they told? After 30 years and 4 months of salary, he still has 6 years of service left. Before the 6 years of service only, he has taken VRS and he told that done for this life, done for this employment life, I'll go take voluntary retirement and I will settle in my life. So he has told 6 years of service has been left, right? So 6 years into 12 months, so many months of service left multiplied by salary. How much you would get? 18 lakh. So this list of the following would be allowed as exemption. That is 5 lakh is allowed as exemption, and the taxable voluntary retirement compensation is 2 lakh. Clear? Mr. D went on illustration 11. Mr. D went on holidays on 25/12/2025 to Delhi with his wife and 3 children. One son aged 5 years, twin daughter aged 3 years. They went by flight economy class and the total cost of the flight reimbursed by his employer was 60,000. 45,000 for adults and 15,000 for 3 minor children. Compute the LTC which is available. He did not opt for, that is default tax regime. He opted for optional tax regime. If you can observe one thing, he has 3 children, one son aged 5 years and twin daughter aged 3 years. As per this, particular provisions, you can get exemption up to two children. That is the leave travel concession. You can get up to two children, right? Three children is possible when the first born is the one child and the second born is twins. In this case, you can see the son's age is more than twins' daughter age. It means to state the first born is one child and the second born is twin. You will get exemption for all these three children. And also they went by flight economy class. So 60,000 rupees, 45 for adults and 15,000. Entire amount will be exempted in his hand. None of them, not even a single rupee would be taxable under this section. See, the holiday is being in India and the journey being performed by economy class. The entire reimbursement is fully exempt in the hands of Mr. D. See, in the illustration 12, in the above illustration 11, if there is any difference, if among his three children, the first born were 5 years and the second, the son was 3 years old, yes, it would have been a difference. Because the first child is now twin daughter, the exemption is available only to two children in this case. First case, reverse. Now, the firstborn is two children, no, only two children, up to only two children, the exemption is given. It is not given for the third child. So now, whatever the 15,000 rupees they are taking in for the children, for the three minor children, 15,000. 15,000 into 1 by 3, 5,000. 5,000 would be the leave travel concession that would not, that would be taxable. It means to state the exemption is given out of 60,000 only to 55,000. This 5,000 would become taxable, right? So, illustration 13. Compute the taxable perquisite for the medical facilities received by Mr. G from his employer during the FY 25-26. Medical premium paid for ensuring health of Mr. G 7,000. Treatment of Mr. G by his family doctor 5,000. Mr. G government hospital 25. Treatment of Mr. G private. Okay, let's do one thing. Let's go one by one. Okay. So now, if you can see in this particular point, medical premium paid for the ensuring health of Mr. G, whatever is paid by the employer. Basically, these perquisites are given by the employer to Mr. G, right? So, medical insurance premium paid for ensuring the health of Mr. G 7,000 is going to be exempted. Medical insurance paid by employer in on behalf of employees exempted. We know this from before, right? So, this is not a taxable perquisite. Can I say it is exempted? Not a taxable perquisite, basically, for that matter, right? Treatment of Mr. G by his family doctors, a treatment, reimbursements which you have received by a government hospital, that is going to be exempted. In this case, it's a family doctor, so it is going to be what? It's going to be taxable. Just give me a moment. Just a minute. It's going to be what? Taxable. Treatment of Mrs. G in a government hospital, family. Mrs. G comes under the definition of family spouse. So now it is in a government hospital, so it is going to be what? Exempted. Treatment of Mr. G in a private clinic, not in a government hospital. It's in a private clinic, so it's going to be taxable. Treatment of Mr. G's mother by a family doctor, again it is taxable. G sister in a nursing home, not in a government hospital, taxable. Treatment of Mr. G's brother, independent, right, is again going to be taxable. Treatment of Mr. G's father, 75 years and dependent, abroad, for that matter. See here, in this case, you have to look into that condition wherein how much is the limit specified by RBI. Expenses of staying abroad by the patient is 30,000. So the total 80,000 is the expenses which is incurred for the medical treatment abroad. How much is the limit specified by RBI? 75,000. So 5,000 is going to be what? Taxable. 75,000 would be exempted. So you can see the same point here, right? Now, so the next topic, the question is illustration 14. This is with regarding to the RFA. Very simple, easy, plain vanilla question, not a complicated one. Basic salary is 8,500. DNS allowance is 2,000. 30% of his retirement benefit. 1,500 rupees is the bonus. So even though the company allocated the house to him on 1/4, he occupied the same only on 1/11. So how many months he has stayed? Basically, right from November, December, Jan, Feb, March. So it is going to be 5 months. Calculate the taxable perquisite. Right, basic salary multiplied by 5. You have to consider 10% of your salary, sorry, 10% of your salary would be considered as your taxable perquisite, taxable RFA basically. Or the salary definition for RFA: basic plus DA incomes plus bonus plus all taxable allowances, right? Plus commission. So here you have basic salary into 5 months you multiply 2000, but how much is forming part of the retirement benefit in terms is going to be only 30%. So multiplied by 5 and 1500 per month into 5. So the total amount is 53,000 into 10% is going to be 5,000 through 5,300. A very simple question. Illustration 15. Consider whatever the data which is there in illustration 14 and assume Mr. C is required to pay rent of 1,000. Okay. So whatever the RFE calculation which you have done earlier, same calculation you will do, but you will subtract already you have paid something out of your pocket as 5,000. No? So how can they call it as your perquisite? Not possible. So only the remaining amount will be called as your perquisite. Using the given data, same. Whatever the data which is given in illustration 14, compute the same thing and consider if ABC Limited is paying out the rent of how much? 1,025 per month, and Mr. C is required to pay 1,000 per month. How much would you consider? Say when the employer is already paying out the rent over here, you have to consider how much is the rent paid by employer in this case is 1,025 into 5. How much is the 10% of the salary? Lower of these two would be considered for the purpose of calculation. That is, lower of your salary is 5,300, 5,125, whichever is lower, 1,000, 5,125, whichever is lower will be your taxable purpose. Provided you subtract whatever is already received by employee, now only the remaining 125 becomes your taxable purpose. Right? Now, consider whatever the information is there in illustration 14. Compute the value of perquisite if the ABC Limited has provided a television. WDV is 10,000 and the cost is 25,000, and they have provided two air conditioner. The rent paid by the company for the air conditioner is 400 per month each. The television was provided on 1/1/2026. However, Mr. C is required to pay the rent of 1,000 to the company for his furnished accommodation. So now whatever the information which is there in illustration 14 will carry forward the same thing. But that was in case of unfurnished accommodation. Okay. But now whatever we are looking into is the furnished accommodation. Earlier question was unfurnished. Now what we are looking into is furnished. So again, what you're considering is we have it as per illustration 14, we have 10% of whatever RFE which you have paid is 5,300 calculation already seen. What is the value of the furnitures which you can consider? Value of the furniture. See, the cost is 25,000 and two air conditioner. How much is the rent paid? If the furniture is being owned by the company, we are going to take 10% of that value of the cost as our perquisite. If it is hired by the company where they are paying rent for that matter, we are going to consider 400 rupees per month, right? 400 rupees per month. Now, so we were looking into this illustration 17 wherein there are certain information which is provided. Point which you need to consider is very simple: RFA calculation. Here in this case, you have furnished accommodation coming in picture. So for the assets which are already owned by the organization, so it is going to be 10% of the cost will be your perquisite. And for the assets which has been rented by the employer, whatever is the rent cost incurred by the employer, that itself will become your perquisite. And one important thing you need to look into this question is that, see, they are given the television was provided on 1/1/2026. It means television was there with him only for 3 months. However, they did not speak anything about the air conditioner. It means air conditioner was given right from the date he had joined. That is 1/1/2025, right? So now two air conditioner which was rented by the employer at 400 rupees per month each. So the calculation goes something like this: 400 rupees for one air conditioner. For two air conditioners, it will be 800 rupees per month. For how many months? 5 months. But however, television they have told it has been provided only on 1/1/2026. Can I say? It means to say 25,000 is the cost, 10% of the cost multiplied by 3 months. Didn't you get the value of the total furnished accommodation for that matter, for the furniture for that matter? That is 4,625, right? Great. And value of accommodation we have already computed in the earlier point. So now, if you take these two and consider the value of the furnished accommodation, and then whatever subtract whatever you paid out of your pocket is not going to be considered as your, it's whatever you have paid, that is going to be considered as your, you have paid out of the pockets. No. So can I say you have to subtract that from my value per visit? So 9,925 minus 5,000, the total is 4,925. That is what year the concessional rent year means. Clear? Okay. If you look into illustration 18, it is a similar one, but here the value of furnished accommodation, that is accommodation for that matter, this fellow is a government employee. So you have to calculate the license fee, which is determined by the government, that is by the basically from the government. So it is 700 rupees per month. 700 into 5 months he has stayed, so 3,500 will be value of accommodation. And the value of furniture is however already given in the question, and we have already calculated here in a very detailed manner. So we are just going to consider the same. You are going to add it, and whatever you have paid out of your pocket, that will not be a perquisite. So minus 5,000, so remaining 3,125 will be your perquisite here. Clear? Now, see illustration 19. Mr. X and Mr. Y are working for Gamma Limited as per salary fixation. The following perquisites were offered. Mr. X, who engaged a domestic servant for 500 rupees per month, his employer reimbursed the entire salary paid to the domestic servant of rupees 500 per month. Mr. Y, he was provided with a domestic servant of rupees 500 per month as part of remuneration package. You are required to comment on the taxability in the hands of Mr. X and Mr. Y, who are not specified employees. See, if they were specified employees, this facilities provided would have been taxable. These people are not specified employees. See, in the case of Mr. X, what has happened in case of Mr. X, he engaged a domestic servant. His employer reimbursed the whatever the amount paid to the domestic servant. So, which employee would have discharged even if the employer did not reimburse the same. Hence, the perquisite will be covered and it will be taxable in the hands of Mr. X. See, the employee would have paid this amount even though the employer didn't discharge. Hence, it is going to be taxable considered as perquisite. So, hence it is going to be taxable. However, in case of Mr. Y, he was provided domestic servant of 500 as a part of remuneration package. So, can I say if the employer did not provide that remuneration, they did not provide this amount, he wouldn't have got that amount. That is, he wouldn't have paid. So, in Mr. Y, he cannot be considered as an obligation which the employee would met. The employee might choose not to have a domestic servant in this case also, and this is taxable only in case of specified employees covered. Hence, there is no perquisite in the elements in the hands of Mr. Y. First situation, even though the employer didn't reimburse, I would have paid him at any cost. In this case, if the employer did not provide the domestic servant, I would have said no for domestic servant. Employer himself is providing it. Only for specified employees, it would have been covered as a taxable perquisite. This is a non-specified employees, hence it is not taxable in the hands of Mr. Y. Illustration 20. Mr. X retired off from the services of Y Limited on 31/1/2026. After completing the service of 30 years and 1 month, he had joined the company on 1/1/1996 at the age of 30 years and received on the following date. These are the things which he has received during his retirement. Okay. Gratuity is 6 lakh and he was covered under POCA. Leave and cashment is 3,30,000. For 330 days, leave balance in his account. Still leave unavailed during the services is 330. Right? He was credited 30 days leave for each completed year of service. As per the scheme of the company, he was offered a car which was purchased on 30th 1 2023 by the company for 5 lakh. Company has recovered 2 lakh from him for the car. Company depreciates the vehicle at the rate of 15% of state and method. Amount of 3 lakh received as commutation of pension for 2/3 of his pension. See, 2/3 of his pension is representing 3 lakh. If you do the reciprocal of that, you are going to get the entire pension, total pension amount. Company presented him a gift voucher worth 6,000 on his retirement. His colleagues also gifted him the television worth rupees 50,000 from their own contribution. Following are the other particulars. He was drawn salary 20,000 and 50% of the DA per month for the period 1/4/2025 to 31/1/2026. And after his retirement, see, you can see the date of retirement, it is on 31/1/2026. So after his retirement, he was successfully receiving the pension, right? Pension of rupees 5,000 rupees per month for the period he was receiving the pension. Okay. So compute is GTI provided he has exercises the option of shifting out of default tax regime, that is under the normal provision. They are asking you the point of normal provision here, right? Okay. See here, the basic salary and the DA part, all of us know you have worked only for this fellow has worked only for 10 months. So he would be receiving the salary of only 10 months. Okay. DA is 50% of his salary, 2 lakh rupees. On that 50%, will get 1 lakh. Now, if you speak about the gift voucher over here, see, the gift voucher worth rupees 6,000 on retirement. See, company has given, that is employer has given gift voucher of worth 6,000. If the gift voucher is received excess of 5,000 rupees, then it is going to be taxable. You can take two interpretation. One, you can take the excess of 5,000, that is 1,000 in this case, as taxable, or you can make the entire amount of 6,000 rupees as taxable. Any assumption for that matter is considered. You can make the 6,000 rupees is liable to tax as a perquisite, or you can just make that 1,000 rupees liable for perquisite. You can write any one. Please don't write both. Write any one. Take any one assumption and you can close your solution. Here, they have taken the entire amount becomes taxable. Now, see, if I'm speaking about the next, the transfer of car over here. If you can look into this point of transfer of car, as per the schemes of the company, was offered a car which was purchased on 30th 1 2023 for 5 lakh. Now, the depreciation for the purpose of calculating the WDV value and to find what is the value of that asset and calculate the perquisite. For car, you have 20, you have to depreciate 20%. The straight line method of whatever the value you have, that will not be considered. You have to consider depreciation at the rate of 20% only for the purpose of calculation of perquisite. Don't confuse this with the PGBP. It is only for perquisite salary calculation, right? So now, how much is as on 30th 1 2023? 5 lakh. On that 20%, it's going to be 1%, 1%. 1%. Sorry, on that it's going to be 20%. It's nothing but 1 lakh in this case. Nothing but 20% on WDV people, not on SLM basis. 20% on WDV basis, right? 20% on WDV. That is what you're taking the solution for. 1 lakh 80,000, etc. Here also you're doing the same thing. And after that, you're going to get how much? 2 lakh 56,000. And this, how much is the amount which is received by the employee? 2 lakh is what you have been received. No. So, the WDV value of the car, when you are getting it, is 2 lakh 56,000. On that, you have already paid 2 lakh from your pocket. So, that will not be your cost. That will not be your benefit, obvious. So, 56,000 becomes your benefit, and this 56,000 becomes your value of perquisite transfer of car, 56,000. Okay. So, now if you can go one by one, gratuity. Gratuity was covered under FOGA. So now when you're doing the calculation, gratuity received is 6 lakh. Least of the following would be exempted, obvious. Notified limit, statutory limit already given in the question is 20 lakh. Actual gratuity is how much? 6 lakh. And you have to take 15 by 26 into 30,000. What is this 30,000? This 30,000 is nothing but the salary definition covered. Basic plus DA total. Covered under POGA doesn't consider in terms or not in terms. It takes total DA. So 20,000 plus 10,000, 30,000 total DA into number of months of completion of service or excess in the part of 6 months. So when he has completed 30 years and 1 month, so it is not excess of 6 months. No, so it is ignored. So it is now we are going to consider 30 years only for the purpose of our calculation. So 30 years. You do this math, you will get the amount. Least of the following would be exempted, 5,19,000. All of us know why it is 15 by 16, 26, right? 26 is the number of days in a month which has been considered by gratuity. Same they have taken in income tax also. 15 days salary equivalent they are giving in 1 month for the purpose of your exemption calculation. So tax, this is your exemption. Out of these three, list of the following, this is your exemption you have considered here. Taxable gratuity is 20,000, sorry, 80,769. That is what you're taking in the above point. So now the next point is leave encashment. See, 3,30,000 is there, 330 days leave. and 30 days leave is what being considered in each year. Always remember, leave encashment whenever you are doing the calculation, maximum number of leaves that you can take allowed in an 1 year as per the income tax is 30 days leave only. Even though the company gives 60 days, but leave allowed should be considered always 30 days. Okay. Leave salary received is 3,30,000. The notified limit is 25 lakh. Actual leave salary is 3,30,000. You have to take 10 months equivalent of average salary of last 10 months. If you remember, last 10 months salary, however, there is no changes. So, if you take 20,000 rupees multiplied by 10 months and take it as an average of 10 months, or you are going to get 20,000 only. That is what they are recording. Okay. Average salary means whatever the salary you got for 10 months you will do. Again, you will divide by 10. You will get the average salary of 1 month. So, here you need not do all such calculation because there is no changes in the salary terms. So directly you're taking 20,000 multiplied by 10 months equivalent you're considering, it is going to be 2 lakh. Cash equivalent of the fourth point would be cash equivalent point. How many days leave you still have unavailed? 330 days. This is number of days. But this 20,000 whatever you have taken is for 1 month. So what you're supposed to do is that this 330 divided by 30 you do. You will get number of months. That number of months multiplied by average salary of that one particular month. You will get 2,20,000. Each of the following is going to be exempted. 2 lakh is exempted. Remaining 1,30,000 becomes taxable. Right? Now, so now you are going to write the leave encashment also, gratuity also you have written. Now consider the pension. Okay. This 5,000 rupees, whatever is receiving, 5,000 rupees per month for the period 1 to 2026 to 31/3/2026 after commutation of pension. This point becomes important because in certain question, you do the calculation, then you take the proportionate amount outside, that computed amount outside, and only consider the remaining as your uncommuted pension. But after the commutation of pension, that is, you have one bulk amount. Out of that one bulk amount, you have removed, and that remaining portion, out of that remaining portion only, is receiving his uncommuted pension. That is 5,000. After commutation of his pension, after receiving the lump sum, whatever is remaining, on that remaining only is receiving 5,000. So you need not do the proportionate calculation here. It's going to be the common calculation. 5,000 per month multiplied by 2. Close. This is uncommuted pension. Now, if you see the commuted pension, he has also received gratuity. If he has received the gratuity, the compensation, that is the exemption that is available, will be 1 by 3. Right? 3 lakh is the total pension, commuted pension. Simpler, this 3 lakh is representing how much? 2 by 3 portion. If you want to know how much is the total portion, that is 100% of the point, you have to just reciprocate it and do it. Or you can do one more thing also. Just do 2 divided by 3. How much you'll get? You'll get somewhere 67 or something. 2 divided by 3, if you do, how much you'll get? If this 3 lakh is representing 67%, 66.66%, how much is 100% representing? If you do this calculation also, you'll get the answer. You need not worry. So, you do 3 lakh divided by 66.66 percentage. If you do, you'll get 4 lakh 50,045. Okay, please round it off to 4 lakh 50,000 because that is 66,667 you will get. No, so that's the reason. 4 lakh 50,000 is your total pension. Out of this 4 lakh 50,000 being a total pension, 1 by 3rd is going to be allowed as exemption. Remember, whenever you are calculating exemption calculation for pension, 1 by 3 or 1 by 2 is done on total pension, not just on commuted pension. This amount on which you are multiplying here, the amount on which you are multiplying here, this will be on the total pension, total pension, total pension. I repeat, total pension, not on the commuted pension. Okay, I hope you remember. So it's going to be 1,50,000. You will subtract and you will get 1,30,000 as your taxable. Now, after doing all the calculation, we'll get your gross salary. And then you are going to subtract your standard deduction of 50,000. You'll get the gross salary taxable. That is 6,82,769. Now, let's move to the next question. Illustration 21. Illustration 21. That is, Shri Bala employed ABC Coal Limited as a finance manager. He gives you the list of the perquisites. Okay, this is a very simple question. It looks lengthy, but it's a very simple question. Okay, domestic servant was provided at the residence of Bala. Salary of the domestic servant is 1,500. Understand one thing. The domestic servant was provided to the employee, and how much was the payment, how much was the salary given to the domestic servant? 1,500. Servant was engaged by him and the salary is reimbursed by the company. He has asked for the domestic servant to come and work in his place, and the company is reimbursing the amount to him. Okay, in this case the company has employed the domestic servant. What is the value of the perquisite over here? Very simple. See, here it comes to 2 points. One, specified employees and non-specified employees. Nothing mentioned in the question. So we can write in both the terms specified employee and non-specified employee, or you can just write it is assumed that is a specified employee. It is assumed that is a non-specified employee. We'll understand in both the terms. If this fellow is a non-specified employee for that matter. Okay. Let's consider first situation. This fellow is what? Non-specified employee. Domestic servant was employed by the employee and it is reimbursed by the employer. Now it becomes a taxable perquisite. The reason behind that is very simple. If the employer wouldn't have reimbursed also, you would have incurred from your pockets. So now the employer is giving out of from his pocket. It means it's a benefit to you. We are going to make it as taxable perquisite. However, if it is in case of a specified employee, what happens is that if the employer is only giving the facility, not reimbursement, facility to the specified employee, now the employee can say, yes, I will accept it, or no, I don't want any domestic servant. In this case, the perquisite is taxable only in case of specified employee. If it is a non-specified employee, wherein the company only state that I'll give you the facility of this domestic servant, it becomes non-taxable. But however, it is for the specified employees only it is going to be taxable. That's the value of perquisite is 18,000, 1,500 into 12 months. Easy calculation, right? Now, free education was provided to his two children, Aarti and Ashok, in a school maintained by and owned by the company. See, now the employer's place, now the employer is only owning this particular education, that is this particular school, and he is only providing that education. The cost of such education for Aarti is 900 and Ashok is 1,200. No amount was recovered from such employee from for such education from Bala. See, the value of education will be a tax-free perquisite provided. The education should be provided by employer and the cost of that such education should be up to 1,000. But here, in this case, Aarti it is 900. So, however, it is going to be a tax-free perquisite, not taxable. However, in case of Ashok, it is 1,200. That is excess of 1,000. So, 1,200 into 12 can become taxable. Or you can take another assumption. Excess of 1,000. That is 200 into 12 can become taxable. Both the situations, both the understanding is also correct. See, one case, 14,400 is taxable, or in another case, only 2,400 can be taxable. Both are possible. Right? Great. Now, the employer has provided movable assets such as television, refrigerator, and air conditioner at the residence of Bala. The actual cost of such asset provided to the employee is how much? 1,10,000. See, however, you can see the actual cost of such asset provided to the employee is 1,10,000. Employer has provided the asset like television, mobile asset, refrigerator, etc. to employee for utilization. So the value of such will be 10% of this 1,10,000 will be considered as taxable perquisite for Bala. See, how much is it? 10% of 1,10,000 will be considered as 11,000 will be considered as taxable. Right? Gift voucher worth 10,000 was given on the occasion of his marriage. Anniversary. It's not just marriage. Continue reading it. Anniversary. It is given by the company to all employees above certain grade. But it is given for marriage anniversary. So this doesn't come under the point of income from other sources. It comes under salary only. And it is excess of 5,000. So it becomes fully taxable in one assumption, or excess of 5,000 can be taxable in another assumption. Both are right. Both are correct. You can consider both. Where is it? This point gives the understanding of both. See, telephone provided at the residence of Shri Bala and the bill aggregating 25,000 paid by the employer. Telephone allowance is 100% taxable, but however, telephone facility is tax-free perquisite. Used for residence, used for official purpose, anything for that matter, it is going to be what? Exempted, right? Housing loan at the rate of 6%, amount outstanding on 31/3/2025 is 6 lakh. Sri Bala pays rupees 12,000 per month towards principal of one first of each month. Now consider the calculation. See, he is paying principal of how much? He pays 12,000 per month towards the principal. Now we have to do certain calculation. However, we know housing loan of 6% was being provided. However, the SBI lending rate was 10%. So in concessional rate of interest is 10% minus 6%, 4%. On that 4%, you will do the calculation now. Very simple. See, 4% is what you will take. April 2025 is how much is the outstanding? Outstanding is 6 lakh as amount outstanding as on 31/3/2024. First of each month, the amount of 12,000 is been deducted. So on 1st of April, ideally speaking, out of 6 lakh, 12,000 is deducted. 5 lakh 58,000 will be there, no? On that 5 lakh 58,000, 4% you do into for only 1 month. So it is going to be 1 by 12. 1,960 will be the interest. You will do the similar calculation, that is 5,88,000 minus 12,000 you do. You will get so much multiplied by 4% into 1 by 12. You will get 1,920. Right? So this is your calculation. You do the solution, you will get the amount and then you write the points. Done with this question. What was difficult in this question? A very simple one. Okay. Illustration 22. AB and Co allotted 1,000 sweat equity shares to Sri Chand in June 2025. The shares were allotted at rupees 200 per share as against the fair market value of rupees 300 per share on the date of exercise of option by the allottee. The fair market value was computed in accordance with the method. What is the perquisite value of sweat equity shares allotted to Sri Chand? In case of the subsequent sale of those shares by Sri Chand, what would be the cost of acquisition of those sweat equity shares? Now we are speaking about the sweat equity shares. Okay. See, the value of the sweat equity shares, which is chargeable to tax, excess of that, what would be considered as my perquisite is that the fair market value as on the date on which the option is excised by the assessee, it has to be reduced by whatever the amount which is paid or recovered, right? So what is the fair market value when he has received? He has been allotted with 1,000 shares. And the shares allotted at how much? He paid only at 200 rupees. But the fair market value was 300. If I would have gone out, I being an employee, I went out and I would have purchased the share, I should have paid 300 rupees per share, but I'm getting only a 200. So the difference of this 100 multiplied by 1,000 shares is my benefit, right? That is what that 1 lakh will be my taxable purpose. In the case of subsequent sale of those shares by Sri Chand, what would be the cost of acquisition of those sweat equity shares? See, where the capital gain arises from the transfer of sweat equity shares, the cost of acquisition shall be the fair market value which has been taken into consideration for the purpose of purpose. I'll tell you the reason why. See, when you're doing the capital gain calculation, you will take the cost for the sweat equity shares not as 200, you will take as 300. The one reason is up to 200, however, you have paid, the money moved out of your pocket. But can I say the difference of whatever the 100 which you have taken here? For this, you've already paid a tax. So at the time of capital gain, you need not pay the tax again for that extra amount which you got of that 100 when if you take this 200, right? Let's take a simple example. In the capital gain, you have sold one share. Now that particular share value is 450. Okay. This is your sale value. Now you have to consider the cost of acquisition. Oh, the cost of acquisition for this is, let's consider in this case, this is 300. You will subtract 300 and you will make 150 as your capital gain and charge to tax. What will happen if you do this? That is 450 minus 200. Can I say your now capital gain will become 250? See, out of this 250, can I say to the extent of 100, you've already paid the tax for. Where? In the year in which you have calculated it as perquisite only. So the difference of 150, whatever you have, only for this you will have, you need to pay what? Tax for. So, is it fair if the organization or if the income tax department comes and asks you, "Arey, you got this at fair market value of 200, no, you uh, consider this as a cost of 200, you will start crying. Why? Because you've already paid the tax for this 100 and you have considered this as cost. Ideally speaking, 300 should be your cost. Only the difference of 150, which is supposed to be taxed, this becomes very fair amount. I hope you have understood this calculation. Why we are not considering 200 here? Why we are considering 300? Clear? No. X Limited provided the following perquisites to its employees, Mr. X, for the PY 25-26. See, accommodation taken on lease, 15,000, 5,000 paid is recovered from the salary. A very simple RFA perquisite calculation. How much is the rent paid? That is 15,000 rupees per month into 12, right? And how much is the 10% of the salary? 10% of the salary for this purpose would be, where is C? Salary for the purpose of the perquisite calculation shall be 10 lakh. So 10 lakh into 10, the 10% is 1 lakh. Lower of the following will be considered as your perquisite, right? And he has already paid some portion of the amount. 5,000 into 12 he has already paid. That is nothing but 60,000. So remaining 40,000 becomes a taxable perquisite for accommodation. But he has also received a furniture for which the higher charges paid by X Limited is 3,000 per month. No amount is recovered from the employee in respect of the same. So can I say 3,000 rupees is the higher charges? So 3,000 multiplied by 12 becomes my value of furniture perquisite, that is 36,000. The total is how much? 76,000. Now, the car of 1200 cc. How much is it? The car of 1200 cc, which is owned by X Limited and given to Y Limited to be used both for official and personal purpose. All running and the maintenance expenses are fully met by the employer. He is also provided with a chauffeur. See, it is owned by X Limited, employer, given to employee, used for both official and personal purpose. Running and maintenance maintained by the employer. If all the conditions are satisfied, it is going to be 2,400 per month, plus a driver is also given. This is some fancy term, that's it, nothing but driver only. So 2,400 per month plus 900 is being given to him. So it's going to be, wait, it's not 2,400, just okay. This is 1,200 cc, my mistake. It is not excess of 1.6 liter. That is not, it is 1,600 cc. It is less than 1,600 cc. That is 1,200 cc. So make sure this is 1,800 plus 900 is being provided. Sorry, it's not 2,400. It is 1,800. Okay. 1,800 plus 900 into 12. You will get this so much. Next, the gift voucher of 10,000 rupees on his birthday. On his birthday, if he's receiving anything, whatever the gift voucher it might be, it will become fully taxable. Excess of 50,000 provisions will come under income from other sources. But this gift voucher has been received by employer. So it is going to be 5,000 only becomes the provision. So excess of 5,000 made it fully taxable. You can take another view, that is excess of 5,000, 5,000 can be taxable, or excess of 5,000, entire 10,000 can be taxable. Both the conditions are accepted. Clear? Now, illustration 24. Mr. Goyal receives the following emoluments during the previous year ending 31st March 2026. Basic pay is given, DA is given, commission is given, entertainment allowance, medical expenses reimbursed is given, professional tax paid, that is 2,000, 1,000 was paid by his employer. Mr. Goyal contributes 5,000 towards his RPF. He has no other income. Determine the income chargeable. And what are you supposed to do? You have to supposed to do the income from salary. This is a cakewalk for you people, I know, because this is a very simple provision. You are supposed to do under both the provision, that is under the normal provision also, and you have to do it as per the default tax regime as well. A simple question. Basic salary under default tax regime fully taxable, DA fully taxable, commission fully taxable, entertainment allowance fully taxable, medical expenses reimbursed. Until and unless it is reimbursed for a government hospital, it is fully taxable. Professional tax paid by the employer, fully taxable. Paid by employee, there is no deduction which is available. Correct? Correct. RPF, whatever the employer has contributed, he contributed 5,000, and whatever the employee has contributed over here, they have not given any information about employer. So we'll stick in with employee 5,000 rupees. This 5,000 is not allowed as deduction under section 80C for default tax regime. There is no such deduction which is available, right? So it's just 75,000, which is the standard deduction which is available. You'll put in all the amount of simple basic question. Nothing is there in this question. Okay, 75,000, you will deduct it and you will get. However, under the normal provision, basic salary, DA, commission, entertainment allowance, you'll consider as it is. But employee contribution, just give me a moment. Okay, this is some extra. This is additional point, I guess. Just a moment. Okay, so now it looks clear. See, under the normal provisions of the Act, that is under shifting out of the default tax regime over here, basic salary considered, DA considered, a commission considered, entertainment allowance considered, whatever is the employee contribution for that matter, it is eligible for deduction under section 80C, no? That will come under the deduction chapter. But however, you have to write a note, mandatory note about it. Okay, nothing is there. Medical expenses reimbursed would be how much? 25,000 fully taxable, professional tax paid 1,000. Okay. Now, whatever it is paid by employer 1,000, you will add it to your income. And when you're doing the gross salary calculation, you will consider it and then you are going to give that as a deduction. That is entire amount of professional tax paid by employer and employee. Both you are going to take it as deduction. Right? And you will get the standard deduction of up to 50,000. See here, they have given a point. Mr. Goyal is a state government employee. If he is a state government employee, then this entertainment allowance is subject to certain deduction under section 16, right? So now, how much is the deduction which is allowed? Allowance received is 40,000. 1/5 of the basic salary is 4 lakh multiplied by 1 by 5. 80,000 is get. Standard amount is 5,000. Least of the following is considered as a deduction. See, however, they are going to give only 5,000. They are very intelligent people, okay? They're not going to give much. So 5,000 they have given it as deduction, list of the following. And then see, however, entertainment allowance, entire amount you have put here. You can't take the deduction right here. It is not exemption which is given. It is deduction which is given from your gross salary. So you have to write here only. You have to write this here only. Okay. Don't do that. Don't do that adjustment of writing 5,000 here. It will not be correct. Your final answer might be right, but the way of presenting will not be right. Okay. So you will get 6,59,000. So this was your illustration 24. Now let's go to your last illustration of this chapter. Illustration 25. Illustration 25. See, in the case of Mr. Hari, who turned 68 years on 28/3/2026, you are informed that the salary computed for PY 25/26 is rupees 10,20,000. The arrears of salary received is 3,45,000. Further, you are given the following details relating to the earlier years to which the arrears of salary received is attributable to. Okay, basically this fellow is 68 years. He's a senior citizen on this particular date. On this particular PY 25/26, the relevant PY 25/26 is having a salary of how much? 10,20,000. And he got some arrears also. That is from the preceding the previous year. From last to last year's total amount he got 3,45,000. That 3,45,000 how we got this total is provided here. And for which years is also given here. 16, 17, 17, 18, 18, 19. This is the salary which he has received during that particular period for which the tax is already paid. This is the salary, this is the amount which he was supposed to receive in this particular years for which he haven't paid any tax. That is the crux of the question. So now you have to calculate the relief which is given under section 89 for this particular year is opting out of default tax regime, that is normal proportion. See, 1718, 1819 and 1920 they have given the tax rates for. Okay. They have given the tax rate calculation for 3 years. Up to 3 lakh is so much, and this is for the person who are below the age 60 years, and this is for other resident individuals for of 60 years or more. This is for senior citizens and this is for non-senior citizens. Okay. Education cess was 2% and the secondary and the higher education cess was 1% was attracted for AY 1718 and 1819. Now, so how we are supposed to do the relief calculation is very simple. For the step number 1, okay. See, how are you going to calculate the arrears of salary relief calculation under section 89A? Step number 1 will be you take the two portion. Okay, one including arrears, 10 lakh 20,000 total you have received given in the question. One excluding arrears. Okay, so 10 lakh 20,000 total PY 25-26 you have earned 10 lakh 20,000. 3 lakh 45,000 extra you have received, and total 13 lakh 65,000 is the total amount received including arrears, and excluding arrears is 10 lakh 20,000. You calculate the income tax for PY 25-26, whatever the rate which is applicable, which you guys already know. Calculate this for PY 25-26, that is AY 26-27 applicable tax rate. Okay, add cess of 4% to both the sales. And can I say the difference between these two, which you can see, is nothing but the tax calculation or the taxability that could have happened with and without arrears. Why is there increase from this figure to this figure from 2,28,000 to 1,20,000? Because of increase in arrears. 3,45,000 income increased, the tax also increased over here, right? Now, this is the first step you need to do. What is the first step? I'll repeat again. You take the total salary, including arrears on one side. Do the tax calculation, close. Excluding arrears, do the tax calculation, close. Both calculations should be as per PY 25-26, AY 26-27, close. Okay. Now, step 2 will be calculation of the TP if arrear was charged to the tax in respective years. Now you have to think in a retrospective way. See, I'm ending up paying so much of tax between this. Reason behind that is arrears. If I would have taken that arrears and calculated, if I would have got that arrear amount in that respective PY of 1617, 1718 and 1819 only, how much would have been the tax that I would have paid? See, 1,03,000 if I would have received along with this 7,10,000 only, how much is the tax I would have paid? That calculation you will do for all these 3 years. PY 1617 means PY 1718. 1617 PY means 1819 AY. Similarly for the last one, you will do the calculation. Okay. AY 1718. Again, including arrears, excluding arrears. A very simple calculation. If my arrear was included, my income would have been 8,03,000. And we already know what is the tax calculation that we are supposed to do. And how are you going to determine the tax slab, whether this is applicable or this is applicable? You have to do the backward calculation. He has turned 28 years, right? So go backwards for this particular month. He has turned 68 years, means go backward to this respective PY and calculate whether what rate of tax would be applicable. Okay, that calculation, that understanding you should do. Now, you will do the calculation. Based on that, including arrears, he was supposed to pay 90,228 if the income was received on that respective PY, that is 1718 only, but he did not receive. So, how much he actually paid? So, can I just write it as this is actually paid, and this was tax payable, right? This is what he was supposed to pay, and this is what tax which is being paid. Right? Similar calculation you will do for 1819 and 1920. And now, can I say, now you got something called as what is actually paid and what was supposed to be paid. And you have the difference there. See, step number 3 is the calculation of the tax on arrears for PY 24-25 and AY 25-26. That is this, this. This is for respective PY people. This is for PY 25-26 and AY 26-27. What is the tax you have calculated on arrears here? 2,28,000. Step number 1, whatever you have calculated, take including arrears minus excluding arrears. That itself becomes your answer for step number 3. See, tax on step 1 including arrears, tax in step 1 excluding the arrears. So 1,07,000. What is your step number 4? Whatever you have done for this respective PYs, no? In step number 2, do the same thing. Tax including arrears in step number 2. I'll just write it as in step 2 minus tax including excluding arrears in step 2. Okay. You do that calculation as it is, you will get 79,120. Now, calculation of relief under section 89 would be step 3 minus step 4. What is your step 3? What is the tax that you are supposed to pay because of in the respective PY? Because there is some changes in the rates. No. Earlier, the rates were different. Now the rates are different. That is the reason why you are doing the relief. Okay. The slabs were different. The rates were different. That is why you are doing the calculation, relief calculation now. Okay. Great. Where is it? Step 3, you were asked to pay in that respective PY 1,07,000. But step 4 states that array, you were supposed to pay only 79,120 as per the earlier calculation. Why should I pay something extra more than this? That is 25,000 rupees. Why should I pay? You are asking me to pay so much. The department is asking me to pay 1,07,000. But I was supposed to receive this amount on that respective year. If that fellow employer would have paid to me correctly, I would have paid 79,000 only. Why should I pay 28,000 rupees extra? This is his question. So the department is telling that, okay, we'll do one thing. Whatever is the tax supposed to be paid in step number 1, 2,28,000 is there. No, out of that, this amount, whatever we calculated in step number 5, subtract. That is step 1, tax payable including arrears in step 1 minus step. You will get this amount. This is the amount which you're supposed to pay the tax. Okay. All this material, whatever you could see, this material is available in my Telegram channel. You can find over there. Test your knowledge. Question number 1 from the chapter Income from House Property. Mr. Raman is a co-worker of house property along with his brother holding equal share in the property. Okay. Basically, municipal value is given, fair rent is given, standard rent is given, rent received information is also given, that is per month. The loan for the construction is jointly taken and the interest is charged by bank is for 25,000. See, out of which 21,000 has been paid and interest on unpaid interest. So, whatever the amount which has not been paid, on that there is an unpaid interest of rupees 450. To repay this loan, Raman and his brother took a fresh loan and charged interest on that loan as 5,000. Municipal tax is 5,100 paid by tenant. So compute the income from house property in the hands of Mr. Raman for AY 25-26. See, what is it? They have asked in the information is calculate what is the income from house property. So it's a very simple question. Nothing is there. All of us know what is the municipal value, fair rent, whichever is. Which one will you consider? Municipal value or fair rent, whichever is higher, right? See, municipal value is something which is determined by the municipality. So we will be given with that information. Fair rent is something which you can see in the locality. In the if you have constructed a house and you are stating that 20,000 is the rent which I'll give it for, the locality will also be giving somewhere around 18,000, 19, 20, 21, somewhere like that. So fair rent is what is there in the locality. You can't say 6,000 is my fair rent because in your locality 20,000 is the rent which people are paying and affording. So fair rent comes into locality. Standard rent is something which is as per the Rent Control Act. All this information will be given in the question. Need not worry, just for your understanding. Rent received is 15,000 rupees per month. Okay. Loan for the construction of this property is jointly taken and interest charges 25,000. Basically, they have taken loan for the house property construction. Yes, under section 24B, you will get deduction. But how much is the question here? Out of which 21,000 has been paid. See, under section 24B, they have stated, the act states or the provision states that the loan which is payable will be allowed as deduction. It is not necessary to be paid. It can be payable. So entire 25,000 is allowed as deduction. Yes. What about the interest of unpaid interest? Remember, interest on that unpaid interest is not allowed as deduction under section 24B, because interest you are paying for the loan which is taken for house property construction, very well, you have done some good thing in life. You did not pay the interest correctly on time, and because of which you are paying interest, unpaid interest. So now for this mistake which you have done from your end, we are not going to give any deductions for that matter. So they are like, we will not give this. To repay this loan, Raman and his brother has taken fresh loan, and interest charged on this loan is how much? 5,000. Can you get the deduction of interest for from the loan which has been taken as fresh loan, wherein you have taken the old loan for the purpose of house property construction? See, understand one thing. Okay, we'll take in simple sense. Imagine you have imagine you have only two things that you need to imagine that you have taken a loan of some 10 lakh rupees for the purpose of house construction. Okay, you have paid interest of how much here? 25,000. Just an example, 25,000 you have been interest is payable. Now what you're doing, now the government now the bank person is coming and telling you, you do one thing, you take a fresh loan. It might be for a reason that the fresh loan is available at some 15%. The older loan you were taking at 18%. Okay, just think like that. Now, what you will do, you will take out this 25, you will take out this a fresh loan of 10 lakh rupees, and you will repay the earlier loan. If earlier loan, original loan was taken for the purpose of house property construction, no? Yes. And if the fresh loan is taken to repay the earlier loan for that matter, then you need not worry. Then the fresh loan also, whatever interest you have paid will be allowed as deduction along with the earlier interest which is payable for the original loan. Clear? Okay. Municipal taxes of 5,100 has been paid by tenant. See, this would have been allowed if it is paid by the owner, but it is paid by whom? Tenant, no? So, this is not, money should move out of my pocket to get the deduction. Yeah. Money is not moving out of my pocket, it is moving out of tenant's pocket. So, it is not going to be allowed as deduction. So, now what you will do? You will calculate the GAV. How will you calculate this or this, whichever is higher, 1,60,000. This or the standard rent, whichever is lower, 1,60,000. And then this 1,60,000 or 1,80,000 of rent receipt, whichever is higher, 1,80,000. Okay, all the substantiation, this is very easier part. As municipal tax is paid by the tenant, you're not considering it. 30% of deduction, however, is available. Interest on borrowing loan, I told you, income from home loan from bank 25,000, fresh loan that you have taken 5,000, both are available. Income from house property, you are going to subtract these two out of the NAV, and then you are going to get, these are for two brothers, no? So it is going to be 50% will be considered as your share in hands for both the brothers. 50% you divide it later. Question number 2. Test your knowledge. Mr. X owns one residential unit house in Mumbai, and it is having two identical units basically. First unit is SOP and another unit is let out property. Okay, for 8,000 rupees per month. The rented unit was vacant for 2 months during the year. That is, there is a vacancy which is created. Now you need to apply the special provisions. The particulars of the house for the previous year 2025-26 are also given in the question. Standard rent, municipal valuation, fair rent, municipal tax, light and the water charges, interest on borrowed capital, lease money, insurance money, repairs. All these informations are given. You have to calculate the income from house property. That is shifting out of default tax regime. That is basically the normal provisions being in picture. Okay. So now, if we can observe something carefully, standard rent is given, municipal valuation is given, and fair rent is given, municipal tax, light charges, all these informations are given. These are whatever the calculation you do, that has to be divided divided under 2 points now. One is SOP and one is LOP. They have told two identical units, so it is going to be 1/2 units, or you can consider it as 50% also. If it is not nothing given in the question, please consider it as identical units. If they have given in the question already stating that 2/3 or 1/3, please consider the SOP as 2/3 or 1/3 as given in the question. Okay. See, what is it that you're going to find is that Fair rent is given in the question, and municipal rent is municipal rent, that is municipal valuation rent, is given in the question. If you can observe, for SOP, all of us know there is no GAV that is considered. So you are calculating GAV for only LOP property now. Then how do you calculate it? Fair rent or the municipal rent, whichever is higher. 1 by 2 is nothing but the identical unit, or you can consider it as 50% also, it's fine. That is 95,000. Second step is whatever the answer which you got in your step number 1 or the standard rent, whichever is lower. So in this case, it is 81,000. And step 3, expected rent or the actual rent, normally speaking, it is going to be whichever is higher. But here, if you can observe something, your actual rent is now less than the vacancy. See, whenever there is a concept of vacancy coming into picture, try to understand one thing. You have to apply some special provisions which is mentioned over here. Okay. If your actual rent is less than the expected rent, what is your actual rent? 80,000 is your actual rent. See how much is it for per month? Per month 8,000. 8,000 into 10 months, because 2 months have been vacant. No. So it is going to be actual rent is 80,000. 80,000. Expected rent which has been come, which you have recorded based on the follow up is, based on the earlier step is 81,000, that you already know it is expected rent. Okay. When your actual rent is less than the expected rent, and it is due to what? Due to vacancy for that matter. What you're going to do is that you are going to consider GAV is equal to actual rent only. Remember my point. Actual rent is less than the expected rent. See, just think, okay. Consider there was no vacancy situation. So your whatever the rent that you would have collected would have been 96,000 now, if there was no vacancy. So here it would be 96,000. So obviously, based on the normal provisions, whichever is higher, 96,000 actual rent is what you would have provided for your taxability, right? But here in this case, your actual rent is less than the expected rent, and it is due to what? And it is due to vacancy. Hence, your GAV will be equal to your actual rent. If your actual rent is less than the expected rent only. What if your actual rent is greater than the expected rent? In spite of vacancy also, you were able to recover amount more than the expected rent. In this situation, let's consider it is 85,000 and it is 81,000. Your actual rent is greater than this expected rent. So your GAV would have been your actual rent only. You need not worry about it. You would have just considered it as actual rent and closed. What if your actual rent is less than the expected rent due to some other reasons other than the vacancy? Then you're going to consider whichever is higher only. That is your expected rent only you will consider. Clear? So this you would have considered. Okay, try to remember this provision, this point you can highlight and keep it somewhere. And whatever the material you can see, all the material is available in your Telegram channel. You can get it in the get it over there. Okay. So as per this, I hope you've understood why actual rent is less than the expected rent. You are due to vacancy, you're considering this because this is the provision. Your simple logic behind that is, I'll repeat, simple logic behind this is, if your actual rent, suppose if there was no vacancy, you would have recorded as per the actual rent only. No, then you would have charged your actual rent only for the purpose of taxability. You would have done some genuine point over there, genuine things over there. Because of vacancy only, you are not able to get your because of vacancy only the amount whatever the actual rent is less than the expected rent. Hence, the department is like, we will do one thing, we'll make actual rent only as your tax payable. That is nothing but, sorry, not tax payable. That's your taxable income. Actual rent you will consider whichever is not higher. This provision you will apply. 80,000 rupees is due to vacancy. Now you will apply here. Municipal tax, if you can observe, it's already given in the question. Municipal tax, 5% of the municipal valuation. How much is the municipal valuation? 1,90,000. 1,90,000, 5% you will get total municipal valuation for the entire building. But we are going to consider only for the LOP property, right? So into 50%, you will take it and close. And NAV, you will record the same. Deduction under section 24, 24A, 30% of the NAV you will record. However, 75,250 into 20 into 30%, you will get so much. Interest on capital is already given in the question, if you can observe. Whereas interest on borrowed amount is 1,500 per month. This 1,500 into 12 months you will get for 1 year. And for 50%, if you do, you'll get for LOP property. Don't forget to do this 50%, okay? Simple question, but you need to remember small points here. That is 50%, you will get 9,000. Income from let out provision, sorry, income from let out portion, LOP property is going to be 43,675. Clear? This is what your calculation looks like. If you can observe here, SOP property, all of us know there is only section 24B which is provided. A similar calculation to LOP you will give, and you will get loss from this SOP property. You will set off this gain minus loss, internal adjustment you will do, and you will get one income from house property. See here, there is light and the water charges, lease money, insurance pays and repairs. All these points will not be given as deduction under your income from house property, because you have only two deduction under section 24, that is 24A standard deduction, and 24B your interest deduction. See, this standard deduction, whatever they are giving, they are thinking that we are giving it as a whole. We are giving one standard deduction no matter what. It includes all these points. So separately we are not giving it. That is the concept behind. Okay. See, question number 3. Mr. Vikas owns a house property whose municipal value, fair rent, standard rent are given in the question. During financial year 25-26, one third of the portion was let out. That is for LOP, and remaining two third is SOP for 5,000. The remaining two third was SOP. Municipal valuation 11% of municipal valuation of 96,000. 11% you will do. See here, construction of the house began in June 2018 and was completed in 31/5/2021. Mr. Vikas took loan of 1 lakh on 1/7/2028. Commencement of construction is June 2018, and uh, date of taking the loan is 1/7/2018 for the construction of the building. He paid interest on loan of 12%, and every month such interest was paid. So now we are supposed to calculate income from house property of Mr. Vikas. Okay. See, all these points, I know you guys will be pretty well able to do it, 96,000 or 1,26,000, but make sure that you're doing it in one third portion, okay? Because however, in SOP property, you will not be having any GAV calculations at all, no municipal tax. So NAV will be nil. And then you're going to take 30%, that will also be nil. Only point you will get in your SOP is that this interest on loan calculation. However, we are going to do that now. Okay. So first, let's take the calculation directly from interest. The date of commencement of construction is as on 1/6/2018. Date of borrowing of loan is so much, and date of commencement, that is construction, is been completed on 31/5/2021. If you can observe something closely here, what do we consider as the pre-construction starting period for you to calculate interest is that date of commencement of construction or the date of loan borrowed, whichever is later. So if you can notice a point over here, whichever is later is given, not earlier. See, suppose let's consider they have given the loan, a 10 lakh rupees loan they have given to you. The loan interest starts right from the date it was sanctioned, right? The interest calculation starts. You have taken the loan, you have kept with you, and you are thinking of investing in some stock market or somewhere apart from putting the money into the house property construction. So what happens? You are holding the money, you did not start the construction. So what the department thought is that we'll do one thing. We'll consider the date of commencement of construction. First you start the construction, then you take the loan. Whichever is later, however, interest gets accumulated after the loan is borrowed. Okay. We'll give the loan first, and then you start the commencement of construction. The intention behind taking the loan was for construction. No. When you started the construction, that is the time where the actual money utilization starts. So we'll keep whichever is later for that. Okay, so date of commencement or date of loan, whichever is later, we'll consider date of loan borrowed. That is your construction. Pre-construction period interest started from 1/7/2018. And date of completion of construction is 31/5/2021. This is normally when the, as per the question, when the construction has been completed, right? If you can see here, we have written a date of 31st March 2021. That is nothing but, remember, for the calculation of pre-construction period interest, it starts from date of commencement of construction or the date of loan borrowed, whichever is later. When does it end is that whichever year you are going to complete the construction. The year in which the construction is completed. Okay. catch that 31st March, which has been immediately prior to the date of completion. Suppose if the completion was 31st May 2022, the completed 31st March is 31st March 2021, right? Sorry, 22, right? In this case, 31 May 2021, the immediately completed 31st March is 31st March 2021, right? So your period commencement starts from these two dates, whichever is earlier, and it ends on 31st March 2021 in this situation. The reason behind that is very simple. The year in which you complete the construction, you start showing your rental income. You start showing your income. So the year in which the construction is completed, you will start getting the entire interest as deduction from that particular year. From this period, whichever is later to this period, whatever the period which is concerned till this is called as pre-construction period. And whatever the interest which is involved over there, whatever the interest we get within this period, we are going to divide it by 1 by 5, apportion it for 5 assessment year, right from the year in which your construction is completed. Correct? So now if you can calculate from 1/5/2018 to 31st March 2019, that is for 1 year completion, 1 lakh is the loan, 12% is the interest, 9 months is what the loan taken for, 9,000. So it has been completed on 31st March 2025. So 1920, 2021, you will do the similar calculation, you will get the total interest. And 1 by 5 you will do, that is because you can take it as a deduction for 5 years, 5 equal installments, right from the year in which the construction is completed. So construction is completed in the year 21-22. So you start taking this also from 21-22. 21-22, 22-23, 23-24, 24-25 and 25-26. Clear? So now you have 2025-26 is also falling under that for one particular year for which you need to provide it. You need to provide this interest for. So for the relevant period, section 24B for 24 for 25-26, whatever the loan which you have taken, you have not made any repayment. So 1 lakh into 12%, this is for PY 25-26 exclusively payable. And what is the pre-construction period interest which you have already calculated is 6,600. So 18,600 is the total interest which is allowed as deduction under section 24B. But now you have to divide it under SOP and LOP. SOP is 2 by 3rd property and LOP is 1 by 3rd property. Based on that, you do the calculation and you got it. So now what you will do for SOP property, you just have interest deduction. So you will get loss. For LOP property, we have 5,000 rupees per month as the rent. So 5,000 into, where is it? See here. Parent or the municipal valuation, whichever is higher, 1,26,000. Step of answer 1 or the standard rent, whichever is lower, like 8,000. You can do one thing, okay? You can start doing 1 by 3rd from here. However, you will get the similar answer. Not similar answer, you will get same answer, only 1 by 3rd. Or you do these two steps as in full. But the last step, however, has to be taken in 1 by 3rd because the rent which is provided is only for 1 by 3rd of the property. So you record this, you will get whichever is higher, that is 60,000. You will take it and you will charge it to income under the head income from house property 60,000. Municipal taxes 96,000 I told you into 11% and to LOP property you got it. Deduction under section 24, 24A, 24B. This calculation we have already done. Please refer the working note for this. And this is the income from LOP 33,330C. Okay. So this is the question number 3rd. Fourth question, test your knowledge, question number 4. Mrs. Rohini Ravi, a citizen of the USA, is a resident and ordinary resident in India for financial year 25-26. Okay. She owns a house property at Los Angeles, USA, which is used as a residence. The annual value of the house is 20,000 and the value of the one said USD may be taken as 75. See, she is using it for her own purpose. So this is going to be SOP property. She took the ownership and the possession of flat in Chennai, which is also for self-occupation. Up to 2 properties, you can use it for self-occupied property. No, so you need not worry. The flat was used by her for 7 months during the year ended 31st March 2026. Municipal valuation is 3,84,000 and the fair rent is 4,20,000 per annum. She said she paid the following corporation tax. Whatever the information which is contained, it will go again under the SOP property. Okay. See, she has taken a loan from Standard Chartered Bank in June 2023 for purchasing this particular flat. Interest on that loan is June 2023. So, a period prior to 1/4/2025, she purchased it on 1/7/2000. The ownership has transferred on this particular date. No. So, whatever the as per the calculation of pre-construction period interest, we are going to catch the 31st March immediately prior to the construction completion or the purchase of that flat, purchase of that flat. Prior to that, 31st March is 31st March 2025 only. Till that particular period, we'll consider. Okay. We need not calculate the pre-construction period interest here because they have already calculated and given. On 1/4/2025 to 30th 6/2025, they have given the current period in two different tranches they have given. Okay, this becomes the current period interest. This becomes the pre-construction period interest into 1/5. If you do, you will get for the relevant period. She had a house property in Bangalore which was sold in March 22. She sold that property. However, she got the arrears of 60,000 in March 2026. So whatever the arrears which you get, that will be taxable in the year in which you receive it, even though you're not the owner of that property, remember. However, you will get 30% standard deduction as usual. You need to compute the whatever the income from house property is. Would your thinking that she is applying for the normal provision, would your answer change if she is applying for default tax regime? See, the first situation, here it is a SOP property, and here for LOP, for this SOP property, both are SOP property. Arrears, I told you 60,000 minus 30%, you will get so much. And if you can observe or understand the pre-construction period interest, I told you 1/5 is considered and remaining amount will be added to the interest which is allowable under section 24B. The total is 1,91,940. However, this amount, whatever you can take in, this is available for this particular property. Up to 2 lakh rupees it is allowed. So you are going to take it. Would your answer change if she pays tax under default tax regime? It's 100% it would have been changed. Here your calculation would have been nil. So you wouldn't get any loss from house property because interest under section 24B for SOP property is not available if she is opting for 115 BAC. However, this point would remain same. Okay. This would have become nil. That's it. There would be no loss, no gain from your income from house property. Everything would have been nil. Okay. That's a question number 4. Question number 5. Two brothers, Arun and Bimal, are the co-owners of the house property with equal share. The property was constructed during the financial year 2017-18. The property consists of 8 identical units and it is situated at Kochi. Okay, there are 8 identical units. And during the financial year 2025-26, each co-owner occupied 1 unit for residence and the balance 6 units were let out at a rent of 12,000. Basically, there are 8 identical units, okay. Out of that, each co-owner is occupying 1 and 1. So, 2 is a self-occupied property out of 8 property and 6/8 is LOP. Can I give it a short form of 75% and this is equivalent to 25% for simple understanding? Okay. Balance unit, this is 6 units have been letted out at 12,000 rupees per month per unit. The municipal value of the house property is 9 lakh and the municipal taxes are 20% of the municipal value which were paid during the year. The other expenses were as follows. Repairs is 40,000. Insurance premium paid is 50. Interest payable on loan taken for house property construction is 3. One of the let out units remained vacant. Very well, no problem. Will not take the actual rent into point over there. Arun could not occupy his unit for 6 months. That would not be having any impact in our question because if it doesn't stay also, it is going to be considered as SOP property, so no problem. Other income of Mr. Arun and Bimal is given. Compute the income under the head house property under default tax regime and under normal provisions also. Okay, first if you consider under default tax regime, I told you SOP property is 2/8, so it is going to be 25%. All of us know under your default tax regime, there is no interest on loan section which is provided, so it is completely nil here. Everything is nil. For LOP property, let's look into the calculation. Okay. See, fair rent or the municipal rent, whichever is higher. There is no fair rent information given, so I'll take directly municipal rent. answer of whatever you got in step number 1 or the standard rent, whichever is lower. There is no standard rent given, so I'll take whatever is as it is. I'll take the same figure as it is. Actual rent or the expected rent, whichever is higher. See, if you can see here, expected rent is 6,75,000. However, your actual rent is 12,000 per flat, okay, per unit. Into 6 flats into 12 months, you'll get for total flats for entire 12 months. Now you can subtract those one flat for which 4 months rent is not being, 4 month it was being vacant. Or instead of doing this, you can do this also. Calculation remains the same. It's a method of different calculation. That's it. 12,000 into 5 units into 12. You have received it completely, no? And for the last one, 12,000 into 1 unit into 8 months only you have received the rent. So you do this calculation, you will get 8,16,000. Whichever is higher, you will get 8,16,000. So now you got the calculation for your LOP property. Municipal taxes is 9 lakh. Municipal valuation on that it is 20%. On that 75% means it is nothing but LOP property value. You are not going to take any municipal tax as a deduction for SOP property. No. So you have to take only for LOP property. So 9 lakh into 20% into 75%, you will get 1,35,000. That is NAV. Okay. Deduction under section 24, 30% of NAV you have. Interest on loan. That is nothing but whatever the loan amount which is given in the question, 3 lakh. Okay. Sorry, that is not 3 lakh is not the loan amount. 3 lakh is your interest payable. Okay. Interest payable is how much? 3 lakh. Total interest payable is 3 lakh. Out of this, SOP property is 25% and LOP is only 75. No. So I'll take 75. You got one income from LOP separately. And for each co-owner, it is going to be the income of 1,25,850, which you're going to record here. Okay. Income. This is for SOP property and LOP property. You can refer the working note. Income from house property is going to be so much. Wait, there is no proper alignment for this. This is the LOP property. And this income from house property is fine. Individual persons, you are going to get 1,25,850. That is the total amount you have got here. Other income already given in the question. This is the total income as per your 115 BSE. Okay. But now if you take it under the optional, that is shifting out of default tax regime, that is under the normal provisions for that matter. SOP, however, you will have 3 lakh is the total interest payable. Out of that, out of that, 2 by 8 is your SOP related property interest that you will get. 3 lakh into 25% you do. You will get SOP related interest payable. Out of that, each brother is having 50% as the share. No? Each co-owner is having 50%. So they are dividing 50% and you got 37,500, 37,500. Loss from SOP is 35,500, 37,500. We have already calculated LOP income. So now if you do the total, you will get income from house property. Other income given in the question, total income is so much. Okay. So this is your question number 5. Now question number 6. Lengthy question. It looks very lengthy, but it's actually very, very simple. Okay. Mr. Rocks, a citizen of a country Y, is a resident but not ordinary resident in India. Very well. He owns 2 house properties in country Y. One is used as his residence and the other house is rented for the monthly rent of 18,000. Fair rent $20,000 and for one YCD it may be taken as 17. He took the ownership and the possession of a flat in Delhi on 1/10/2025, which is used for self-occupation in India. The flat was used by him for 2 months and he visited during the period. Municipal valuation is given, fair value is given, and he paid the property tax of 13,800 and 2,800 as sewerage tax to municipal corporation. He had taken a loan of 18 lakh into 9.5% from HDFC Bank on 1st August 2023 to purchase this flat, which is no amount is repaid till this period. He also had a house property in Bangalore, which is let out for a monthly rent of 40,000. The fair rent is so much, municipal is so much, standard rent is so much. He has also taken loan of 25 lakh into 10% from one of his friends residing in Countrywide for his house. Municipal value, municipal tax of 5,400 is paid by him in respect of his house during the previous year. You are supposed to calculate the normal provisions of the tax over here. Okay. If you can observe something, say this fellow is not for that is R and OR for that matter, and only the income in respect of property situated in India would be taxable. The outside India would, however, be taxable as in that respective country as per the respective provision, but it is not taxable in India. Okay, that's the rental income which accrues or arises in country Y from let out, and the annual SOP property would not be taxable in his hands. Accordingly, he has a property in Bangalore and Delhi, two prime location, rich fellow. Okay, in Delhi, he is keeping it as self-occupied property, so it's recording. Interest on borrowed capital is there. So let's look into the calculation. If you can observe something, he has taken loan over year, that is 18 lakh into 9.5% on 1st August. He took the possession on 1/10/2025. That is nearest time, nearest 31st March is 31st March 2025. Till that period, it is going to be considered as pre-construction period. During the period, it is going to be considered as the normal interest which is allowable during the period. So 18 lakh into 9.5% from August till 31st March 2024. 18 lakh into 9.5 into 8 months divided by 12, you will get 1 lakh 14. 1 lakh, 1 point from one entire year, PY 24 to 25, you will get 1 lakh 71. Total you do 2 lakh 85,000 into 1 by 5 is what the pre-construction period allowed for, 57,000. During the relevant period of PY 25-26, AY 26-27, he has 18 lakh into 9.5%, that is 1 lakh 71,000. You'll consider the total is 2,28,000 is the total interest allowable. However, the interest deduction allowed under section 24 is 2 lakh only, restricted to 2 lakh. So I'm going to restrict here till 2 lakh rupees. Okay. This is exclusively for SOP property. This is not for LOP property. Okay. So now if you can observe something here, you have to do the calculation of whichever is higher, whichever is lower. Fair rent or the municipal rent, whichever is higher. So 4 lakh 58. This or standard rent, whichever is lower, 4 lakh 20,000. This or the actual rent, whatever you have calculated, 40,000 per month into 12. That is 4 lakh 80,000, whichever is higher. 4 lakh 80,000 becomes your taxable GAV. That becomes your GAV. Municipal taxes is already given in the question. How much is the municipal tax paid? 5,400. Would you take the municipal taxes paid over here? Absolutely no. That's because it is SOP property. You will not get any municipal taxes deduction. You will get only 5,400. Okay, annual value is given. Deduction under section 24 is done. 30% of the NAV is also, you have also calculated that. Interest on borrowed money, whatever is your actual, the entire amount will be allowed as your deduction as per the question. Where is the interest point they are speaking about? See here, he had taken a loan of 25 lakh into 10% from his friends in country Y. So the entire interest is allowed, that is 2 lakh 50,000. You have got it. And then loss from under the head income from house property is given. NAV, you will get this 82,000 minus this, you will get the net loss of 1 lakh 17,780. That is your income from house property. Sorry, loss from house property. Okay. You have one last test your knowledge question, that is Mr. Roy. This fellow owns a house in Kolkata during the PY 25-26. 3/4 is self-occupied and 1/4 is LOP. 12,000 is the rent. This fellow tenant vacated the property on 28th of February. The property was vacant during March. So there is no rent, there is no tenant who has come. So it is vacant during March. And for the month of January and February, it could not realize the rent in spite of owner making the efforts for. So what happened here? January, February, so he did not get any amount over there. March was vacant. So 3 months out of 12 months, he did not receive any rent. So 12,000 into 9 is what you will consider for actual rent. Okay, all the conditions satisfied. Municipal valuation, fair rent, standard rent is given. He paid the municipal taxes of 10% of the municipal value. A loan of 30 lakh was taken by him during the year 2018 for acquiring the property. Interest on loan paid during the PY 25-26 was 1 lakh 51,000. Compute Roy's income from the property. See, this is 1/4 is LOP and 3/4 is SOP. So when you're doing the calculation, please be careful. SOP property annual value will be nil. You will do the calculation. Will understand the interest calculation here. 1,51,000 is the interest on loan given in the question. So 1,51,000 into 3 by 4, you will get the interest calculation directly here. For LOP property, you will do municipal valuation or the fair rent, whichever is higher, 4 lakh 70. 4 lakh 70 or 5 lakh, whichever is lower, 4 lakh 70. 4 lakh 70 or your actual rent, 12,000 into 9, whichever I told you, whichever is, you will consider now whether if your actual rent is greater than your expected rent or less than your expected rent because of vacancy. What is the situation that has happened? See here. Your actual rent is 1,08,000. Okay. This would have been is lower than the expected rent and it is because of the vacancy. If your vacancy was not there at all, see, forget this unrealized rent, okay? We are already subtracting it. If this vacancy was not there, you would have got 12,000 into 10 months, that is nothing but 1,20,000 is what you would have been your income. Then you would have stated 1,20,000 rupees as your taxability. But here what's happening? Your actual rent of 1,08,000 is less than your expected rent of how much? Expected rent of 1,17,500. The reason behind that is purely because of vacancy. Hence, we are going to consider GAV as your actual rent only. Okay, similar to the earlier question which we have done. And municipal valuation, 10% of municipal value, then into 1 by 4, that is nothing but your LOP value into 1 by 4. So the net annual value is so much. Deduction under section 24, that is 30% of whatever is your NAV. And then interest paid, we know 1,51,000 given in the question into 1 by 4. You got it. And this is the total. So now what you will do is that you will take the income from unit 1, income from unit 2, you will set off and you will say loss from house property is so much. Uh, Illustration 1. Jaishree owns 5 houses in India, all of which are let out. Compute the GAV, a very simple question, nothing is there here. Fair municipal value or fair rent, whichever is higher. Fair rent or the, whatever the answer which you got, or the standard rent, whichever is lower. The answer which you got is the expected rent or the actual rent, whichever is higher. You do this and you will get the solution. It's a very simple question, I need not do it. Illustration 2. Rajesh, a British national, is an resident and ordinary resident. He owns a house in London which has been let out for £10,000 per month, and municipal taxes has been paid during the value of £1 in India is taken as 95. Compute the Rajesh net annual value. They've just asked the net annual value here. So as he is an ROR, resident but ordinary resident, so whatever the rent which is being receiving is included in his total income, universal income, that is global income will be taxable for him. Hence the GAV will be £10,000 per month multiplied by 12 months into what is 1 rupee equivalent is 95. You'll get that, and then you will subtract the municipal taxes paid. You'll get the NAV value. A simple question, nothing is there. Illustration 3. Mr. Manav owns 2 house properties, one at Bombay, wherein his family resides, and the other in Delhi, which is unoccupied. For acquisition of the house property at Delhi, he had taken a loan of 30 lakh into 10% on 1/4/2024. He has not repaid any amount, fine. In respect of house property at Delhi, he has also taken loan of 5 lakh into 11% on 1/10/2024 towards repairs. Compute the income, the amount which is allowable as deduction under section 24B. Okay, here, see, interest on loan taken for acquisition of residential house is 30 lakh is what he has taken. For 10% is the interest rate. So 3 lakh rupees will be there. However, it is going to be restricted to 2 lakh rupees only. The maximum interest allowed under the SOP is going to be 2 lakh. However, under the LOP property, he has taken 5 lakh into 11%, 55,000. This is taken for the purpose of repair, not for the purpose of house property construction. Hence, that limit is restricted to 30,000. So total is 30,000. However, the total interest which he has got is 2,30,000. This is restricted as he is staying in self-occupied property, that is under section 24B, 2 lakh rupees. Illustration 4. Anirudh has a property whose municipal valuation is 1,30,000. Fair rent is given, standard rent is given, and the property was let out for 11,000 per month. 11,000 per month throughout the previous year. Unrealized rent is given. All conditions satisfied. Municipal valuation given. A very, very simple, plain question. You have municipal valuation or the rent or the fair rent, whichever is higher, that is 1,30,000. This or the standard rent, whichever is lower, 1,20,000. 11,000 per month multiplied by 12. If you do, you will get the answer. From that, you subtract 11,000 because your actual rent receivable minus the unrealized rent will be the actual rent that you're going to take in the computation. So, how much is it going to be? Your actual rent, expected rent is 1,20,000. Actual rent is going to be 1,21,000 as per the calculation. So, you will take 1,21,000. You have the municipal valuation, 30% standard deduction you'll give. Interest is already given in the question, 40,000. So, you will take the 40,000 rupees as your the interest under section 24B, and yes, it's done. And income from house property is 35,600. People, there is nothing in this question. If you have already done the test your knowledge questions, so it will be very easy for you to solve. So it is always recommended for you to start with the test your knowledge, do all the difficult questions first, and then go to the illustration so that your solution becomes easier. Okay, so you can look into this point later on. Next, illustration 5. Ganesh has house property whose municipal valuation is 2,50,000, fair rent is given, standard rent is given. Property from let out is also given. The tenant vacated the property. There's a vacancy which has been created. And if you have seen in the earlier questions which I've done in test your knowledge, I've taught you this concept. That is, how do you calculate the GAV, calculation of income from house property? I'll call this as how do you compute GAV? When there is a LOP, that is because of the vacancy for few months in a year. When the actual rent is less than the expected rent due to vacancy, then your GAV will be equal to your actual rent. If your actual rent is less than the expected rents, not because of vacancy, because of some other reason, you'll consider your expected rent only. If your actual rent is already higher than the expected rent, even in case of vacancy, consider GAV as your actual rent. Okay. Now, use the similar situations over here. You will get the solution for it. See, here it is vacant for 2 months. That is for Feb and March. And there is unrealized rent also. That is 20,000. You will take it for the purpose of calculation. Now, municipal valuation or the fair rent, whichever is higher, 2,50,000, 2 lakh, 2,50,000, 2,50,000, or the standard rent 2,10,000, whichever is lower, 2,10,000. And now comes the actual rent. That is how much? 20,000 rupees per month multiplied by 10 months you will do first. Okay. How much will you get? 2 lakh rupees. Out of that, you will subtract the realized rent, unrealized rent. So 1,80,000 is your actual rent receivable. Okay. Actual rent. This 1,80,000 rupees you will take in one comparison, and you will take what is your expected rent. 1,80,000, and what is your expected rent? Suppose if there was no vacancy that would be created, your actual rent, because okay, let me put it in this way, because of the vacancy, there's a vacancy during 2 periods. This is the reason why actual rent is less than your expected rent. Hence, consider actual rent only as your GAV. Okay, the more explanation I've already given in the test your knowledge question. So if you have not watched up, first solve the test your knowledge questions and then move forward. Okay, 1,80,000. And then you have 8% of your municipal valuation as your municipal taxes. You take that and you will get the standard deduction. And then interest, it's already given in the question. You subtract that and close. Income from house property you will get. Okay, illustration 6. Purna has house property in Indira Nagar in Bangalore. She stays with her family in the house. The rent of the similar house in the neighborhood is 25,000. Municipal valuation is 2,80,000. Municipal taxes paid is 8,000. And the house property construction began in April 2019 with a loan of 20 lakh rupees, fine, 9% on 1/4/2019. Construction completed on 30th 11 2021, and the accommodation accumulated interest is also they themselves has given. You need not calculate here. Okay, to 3,60,000 on 31/3/2026. Purna paid 2,40,000, which included 1,80,000 as interest. There was no principal repayment prior to this date. Compute Purna's income from house property. See if you can observe something over here. This is a self-occupied property which she is staying, has one house property, and she stays with her in that family. So it is your entire GAV NAV will be nil. Here the only concept comes here is interest on borrowed capital. See here, the total interest which they themselves are given in the question is the total accumulated interest, that is pre-construction interest, is 3,60,000. 3,60,000 into 1 by 5 if you do, won't you get the interest 72,000 being the interest of pre-construction period, and 1,80,000 is during the period. See, 2,40,000 she repaid. Out of 1,80,000 was interest. So that is the for the relevant period interest. 1,80,000 plus 72,000 you do it. You will get the total 2,52,000. The interest deduction is restricted to 2 lakh rupees. No? So you are going to restrict it to 2 lakh over here. Okay. Now, Srimati Rajalakshmi, illustration 7. Srimati Rajalakshmi owns a house property at Adiyar in Chennai. The municipal value of the house property is 5 lakh and the fair rent is 4 lakh 20,000 and the standard rent is 4 lakh 80,000. The property was let out for 50,000 per month up to December 2025. Therefore, the tenant vacated the property and Srimati Rajalakshmi used the house for self-occupation. Rent of the house for month of November and December could not be realized. This is unrealized rent. All the conditions satisfied. Okay. Municipal valuation 12% is municipal taxes is 12% of the municipal valuation. She has paid interest of 25,000 during the period. It is also a very simple question provided you do the calculations correctly. Simple question here. Nothing is there. It is just that actual rent and the expected rent. If you are able to find this GAV properly, all your half solution for this particular question is done. Okay. So municipal valuation of this property is 5 lakh or 4 lakh 20,000, whichever is higher, 5 lakh. 5 lakh or 4 lakh 80,000, whichever is lower, that is 4 lakh 80,000. Property was 50,000 rupees per month. So 50,000 rupees per month. So for how many months it was occupied? Up to December only, for 9 months. Out of this 2 months, rent you did not receive, November and December. So actual rent receivable is only 4 lakh 50,000. Your expected rent is how much? Expected rent is 4 lakh 80,000. Actual rent received is only 3 lakh 50,000. And because your actual rent, whatever you got 3 lakh 50,000, suppose consider how much would have been your actual rent that you would have actual income that you would have charged for the taxes, provided your what do you say, your actual rent that you're supposed to pay the taxes for. If there was no vacancy, if the vacancy was not there, everything was fine, how much you would have paid? 50,000 rupees per month into how many months? 2 months, so you did not receive here, so it is going to be 7 plus 2, again 9 months. You would have received only 4 lakh 50,000 rupees, if you can observe. Okay, I'll repeat again. 50,000 rupees per month is what the rent that you would have received. If there was no vacancy, leave this unrealized rent for that matter. If there was no vacancy that was created, you would have actually received for how many months? 9 months, right? Yes, you would have received for 9 months. However, even though your actual rent, if there was no vacancy created, you would have just your actual rent was, however, less than your expected rent. Hence, what they are doing in this question is that they are taking whichever is higher the portion here. That is your GAV is 4 lakh 80,000. See, GAV is higher than the expected rent. Higher of expected rent computed the whole year or the actual rent, whichever is considered. So if you want to look over here, just consider 4 lakh 80,000 or 3 lakh 50,000, whichever is higher, 4 lakh 80,000. The reason behind that is, even though there was no vacancy, your actual rent was, however, less than your expected rent. Unrealized rent concept is different. Vacancy is different. Unrealized rent is always subtracted from your actual rent receivable. Okay. From that, out of that amount, whatever you have, if you would have not had the vacancy, what is the rent that you would have added to it? That you add and see. If that is the case, 4 lakh, if your actual rent was, however, less than your 4 lakh 80,000, so what you will do? You'll just consider your GAV point over here. Okay. GAV is 4 lakh 80,000. Municipal taxes paid by the owner during the period is 60,000 rupees. Standard deduction, interest on borrowed capital you'll do. Income from house property you will get. Okay. See this illustration 8, this is something different. Ganesh has 3 houses, all are self-occupied. Very well, municipal value, fair rent, standard rent. Date of completion of this purchase is given. Municipal taxes paid during the year. Interest on money borrowed for repair of the property during the current year. Interest on current year on money borrowed in April 2018 for purchase of property is given. Compute Ganesh's income from house property for AY 26-27 and suggest which houses should be opted by Ganesh as self-occupied. Now they are asking you for the suggestion, only then please suggest. Okay. If they don't ask for suggestion, please yourself don't go and suggest. Okay. Answer them only when they ask. Answer them only. Answer. Give the suggestion only then. Only when they are asking for. Now you have three options here. One, you can consider house property 1 as SOP, house property 2 as SOP, or house property 3 as DLOP. Because out of the three houses, you have the option to consider any two houses as SOP and one as DLOP. So what you will do, you will take all the three combination wherein you'll consider the DLOP as 1, DLOP as 2 and DLOP as 3. Others are SOP. Okay. Whenever you're doing the computation, try to do it something like this. Not exactly like this. If you want to do it in a different format or something, if you want to write in a different clean way or something, you can write, but this is better, I feel. Okay. See, GAV in all the three situations, you can find this whichever is higher, whatever the answer which you get, whichever is lower. From this, you don't have the actual rent. So in this case, you are taking the DLOP, that is expected rent itself as your GAV. Okay. You are calculation of house property 1 and 2 and 3 as DLOP. Three different perspective you need. So the calculation becomes easier. Okay. Municipal taxes is already given in the question. You will put the same 30% standard deduction you will take. Interest on borrowed capital, whatever the interest which you have, that is completely allowed when it is under LOP. No, same LOP provisions are applicable for DLOP provisions. So now you have income from house property completely over here. Now calculation of 1, 2 and 3 as SOP under normal provisions. Default tax regime is separate. Normal provisions you're doing. Okay. So now under normal provisions if you're doing, however, all of us know till here it is going to be nil only. In the second situation, for the second house, here interest on money borrowed for repairs of the property, all of us know for SOP property under normal provision, if it is for repairs, it is going to be 30,000. 30,000 is the deduction which is allowed. If it is more than, if it is for the purpose of purchase, maximum of 2 lakh will be allowed. So that is what we are recording, maximum 30,000, entire 1,75,000 is allowed. So if you are considering under normal provision, this is what it's going to be. Calculation of 1, 2 and 3 as SOP under the default tax regime. Everything is nil, easy marks, because 24B under SOP for default tax regime, it is nil. It is not allowed. Not even a single rupee is allowed. Now you have the option 1, option 2 and option 3 coming in picture. So let's do the solution as it is. Option 1 as 1 as SOP, 2 as SOP and 3 as DLOP. You already have the solution which is given in the question, sorry, which we have already done. That is the reason I told you if this sort of question is given, please do it as per the format which you can see here. It will become 5 times easier than you would have done in each situation separately. That is going to consume a lot of time. First of all, this question is lengthy. Okay, under normal provisions, whatever you can see, this DLOP provisions, wherever you have assigned it as DLOP, wherever you have assigned it as LOP. Okay, so consider this 1, 2 and 3, and final your income from house property is so much. Second situation wherein your house property 1 is so much, loss SOP, second is SOP, 3 is SOP, both included you will have 2,05,000, right? But however, the deduction which is allowed is only 2 lakh. So out of these two, you will do the internal set off and you will consider only 2 lakh. 90,800 is your income from house property. Option 3 under normal provision, one is SOP, second is DLOP. You will put this figure right from the calculation which you have done and you will put it SOP, you will record. You will get income from house property 1,008. Similarly, you will do for 115 BAC, same. SOP, 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 DLOP, but under your the default tax regime. All of us know what is the difference. Under DLOP, you will not get any difference. Only for SOP property, everything will be there. So after you do initialize that, option 1 you will get 73,600. Option 2 you will get 2,19,800. Option 3 you will get so much as income. So as they are asking you for this suggestion, what you will do is that for Mr. Ganesh, which is the most affordable one, or which will you consider the most good and a proper combination, is that you will consider the option 3 under the normal provision, that is option 3 under normal provision, as the best suitable, for Mr. Ganesh. Why is it so? What is the reason? Because you can see this is the area in which there is a least or less income from house property which has been present. Say it is 43, it is 19, and here though it is more. So this is the least one. So option 3. In this situation, you can't just write option 3. You have to write this 1 SOP, 2 DLOP and 3 SOP. This would be the best option which is available for it. Okay. These are the questions of income from house property. Test your knowledge. Question number 1 of the PGBP chapter. Mr. Venus, engaged in the manufacture of pesticides, furnishes the following information relating to the manufacturing unit at Chennai for the year ending 31st March 2026. Okay. What does it provide? WDV of the plant and machinery. As on 31st March 2025, remember this is for the preceding the previous year, that is for PY 24-25. As of 31st March 2025, the closing balance they have given. Closing balance of the previous last year is the opening balance for the current year. Depreciation including the additional depreciation for the last year, that is for PY 24-25. New machinery purchase information given. New machinery purchase on 1/12/25 information is given. Computer purchase on 1/3/1/2026 information is also given. Additional information: all assets were purchased by account paid check. All assets were put to use immediately. New machinery purchased on 1/12/2025 and the computer have been installed in the office. During the year ended 31st March 2025, a new machinery has been purchased on 31/10/2024 for 10 lakhs. Additional depreciation besides the normal depreciation has been claimed thereon. Depreciation rate for machinery may be taken at 15%. The SSE has no brought forward losses or unabsorbed depreciation. Very well. What you need to compute here is compute the additional depreciation available as per the provisions of the Income Tax Act and the WDV of the different block of assets as on 31st March 2026. If E exercises the option of shifting out of default tax regime and E pays the tax under the default tax regime under section 115 BAC. Okay. So the question is very simple provided you understand certain things. The depreciation, if the machinery has been used for a period more than 180 days, then you have to consider the depreciation, the full rate of depreciation. 20% is allowed, entire 20 is allowed. If 15 is allowed, entire 15 is allowed. If it is used for a period less than 180 days, then you have to provide only 50% of the allowable depreciation. If 20% is allowed, you can allow only 10. If 15 is allowed, only 7.5% of depreciation is allowed for the purpose of calculation. Right? Great. Now, what have they asked you? They have asked you to calculate depreciation available. Very well. He exercises the option to shift out of default tax regime and he pays under default tax regime under both the provision. What is the difference that you will get in majority in this two part is only one difference, that is the additional depreciation. If you are opting in for default tax regime, you will not get any additional depreciation. However, you will get the normal rate of depreciation. Here you will get the normal depreciation and additional depreciation. So first, let's compute the depreciation calculation because it is common for both the normal rate of normal depreciation, sorry, the normal provisions or the default tax regime. For both the situation, it is going to be the common point. Computation of the WDV for AY 26-27. It is going to be WDV as on 31st March 2025. Closing balance of the last year. And this is the WDV before depreciation is what the information given. How can we know about it? In the question only they have given both the information. It means they want you to subtract this additional depreciation and then only take the solution. That is what they're expecting you to do. That is why they have given the depreciation for PY 24-25 year. Right? So 30 and depreciation. Depreciation for PY 24-25 is going to be 4.75. It's already given in the question. And depreciation, WDV as on 1/4/2025 is 25.25. How did you get this? You're going to subtract it. Why did you do it? Because it's given in the question. So they are expecting you to do it. They have done it in the ICA material. So please do it in your exam also if they provide the similar question. Now, actual cost of machinery acquired during the period more than 180 days, less than 180 days. More than 180 days, you have purchased this, and less than 180 days, you have purchased actually two. But if you can see in the solution, we have divided it into plant and machinery, two different blocks. That is for two different rates, we have divided plant and machinery 15% block, computers it is 40% block. 40% block. Okay, 10, 8. So we have divided the value of asset. Depreciation is not yet calculated. We are just calculating what is the WDV as on 31st March 2026 before depreciation. Depreciation, we will do it moving forward. This is the WDV, right? So now we are going to calculate the depreciation under the normal provisions. See, under normal depreciation, how would you calculate? You already have the opening balance. How much is the opening balance that you already have? 25.25. Out of that, can I say this entire 15% will be allowed as depreciation? You are going to record it. Great. More than 180 days, you have 10. And what is this? This is plant and machinery only. This is new plant and machinery. So 15% is the rate of depreciation. You will provide the entire amount full. Less than 180 days, it is going to be 8. This is nothing but this is also a plant and machinery. But however, if you can see one thing here, new plant and machinery, it is bought on 1/12/2025, used for a period less than 180 days. Only 50% of the allowable depreciation, that is 8 into 15% into 50%, or you can directly provide it as 7.5%. Okay, give it in a note. It is only 50% is allowed, so we have considered 7.5%. That would also be fine. Okay, you have done this. And for computers, here it is 4, and this 4 into 40% into 50%. This 4 into 40% is the depreciation rate. Into 50% is this has been purchased with less than 180 days. So you are considering the same depreciation here. Okay. Now, if you are considering the additional depreciation, 2 points to be considered here. Additional depreciation is provided only for new plant and machinery only. It is not provided for computers. So this is out of scope for additional depreciation. Okay. Now, new plant and machinery purchased on 1/9/2025, 1/4/2025. You can see new machinery purchased on 1/12/2025 and computers have been installed in the office. What does it mean? It is installed in the office. There is no additional depreciation provided if plant and machinery is being installed in office. It should be installed in factory, because the intention behind giving them the income tax department or act giving you the depreciation, additional depreciation, is that you use that machinery for doing some production in the factory, not to keep it in the office. Hence, you will not have any additional depreciation for this. However, not for this, and you will have additional depreciation only for this. 1/9/2025. Will you get the full rate of depreciation? Obvious, we'll get the, where is it? We'll get the full rate of depreciation, full rate of additional depreciation. That is how much? 20%. And if you can see a point here, during the year ended 31st March 2025, that is the last year, in PY 24/25, you have purchased a new machinery on 31/10/2024 for 10 lakh, right? If you can observe something carefully, last year you would have purchased this and you have used it in the business. Additional depreciation only 50% you would have taken, because it is used for a period less than 180 days, right? This 10 lakh worth of machinery, additional depreciation you have taken only 50%, because it has been used for a period less than 180 days. Now, can you claim the remaining in the next year, that is in the year which you are doing this PY 25/26? Yes. I will take the remaining additional depreciation. Will I take it on WDV or will I take it on actual cost? Remember, additional depreciation 50% this year, 50% next year if you're taking. Next year should be calculated on the actual cost only. So 10 lakh into 10%, you will take 1 in the point, right? So now if you can calculate, you will get the total depreciation and you will get the total depreciation. This is as per the point 1, that is under the default tax, sorry, under the normal provision. Under default tax regime, see, you have to just copy paste the things which is there in the normal depreciation, write the total depreciation. That's it. Why? Because there is no concept of additional depreciation that you can get in your default tax regime. Clear? You add so much, where is it? You add so much, you get the solution. Right? Okay. Mr. Test your knowledge. Question number 2. Mr. Abhimanyu. This fellow is engaged in the generation of electric power. He opts to claim depreciation on WDB value very well. Compute the depreciation under Income Tax Act, assuming he is opting in for the new provision, that is shifting out of default tax provision. WDV of the block as on 31st March 2025. Again, last year balance they have given 50. Depreciation for last year they have given. Similar calculation you will do. That is 50 minus 7.5. New machinery has been purchased and new machinery imported from Colombo on 12/4/2025 9. This machine has been used only in Colombo earlier and the SSE is the first user in India, right? New computer installed in generation wing unit on 15/7/2025. How much is it? 2. All the assets were purchased by account payee. Check. If you can see very carefully here, very simple question. Opening balance they have given 50 and depreciation for the year they have given 7.5. If you subtract this, you will get the opening balance. This minus this will give you the opening balance. Understand very slowly. And new machinery has been purchased on 12/10/2025. Okay. This, whatever you have purchased on 12/10/2025, this is used for a period less than 180 days. So this new machinery 7.5% is the depreciation charge. Close. Correct. Now, where is it? And whatever the new machinery which you have purchased that is imported, you are going to take the same thing and you are going to record the depreciation. You can do one more thing, okay? It's just that 50 lakh minus 7 lakh 50,000, you can do it separately, the calculation, and then take 9 lakh into 15%. That is also fine. However, we just did it together as it is done in the ICA material. You can do it separately, this and this separately also, 15% and 50%. Okay, clear. This is done. These two are done and this is also done. Let's look into this. Computer installed in generation wing on unit, 2 lakh. This computer, for that matter, the depreciation rate is 40%. So, you will record the same and 9,27,500. Now, if you are calculating the additional depreciation over here, whatever the new machinery which you have purchased, that is on 10, you will get 10% of the depreciation as your calculation because it is being used for a period less than 188. 20% into 10%, 20% into 50%, that is nothing but 10% you will get over here. 10 lakh into 10%. Simple. Well, very well. Now, which is the new asset which you have purchased? Where is the computer? Generation wing of the computer. So that is going to be considered 20% into 2 lakh. However, it has been purchased for period more than 180 days. So computer is allowed and it is installed in the generation wing, nothing but like of similar to factory. So this is allowed 2 lakh into 20%. Why is this not allowed is that this is the second hand machinery. Second hand machinery imported or second hand machinery within India, used without India, no, whatever it is. Second hand machinery, you can't take any additional depreciation to it. Clear? That is the reason why additional depreciation not taken here, and it is taken here. Clear? Now, see, this question 3, 4, and 5 till 6. These are all the question relating to the theory. Question 3. Test your knowledge. Examine with reasons the allowability of the following expenses incurred by Mr. Manav, a wholesale dealer of the commodities under the Income Tax Act 1961, while computing the profits and gains from business or profession. Yes, exception out of shifting out of default tax regime. You have to state with reasons whether it is deduction is allowed or not allowed under your PGBP, right? Construction of school building in compliance with the CSR activities amounting to 5,60,000. See, basically, he has given the that is he has incurred the cost of 5,60,000 for construction of the school building. That too with the compliance of CSR activities only. See, if you are incurring some revenue expenses, it is allowed as deduction. Capital expenses also subject to conditions. There are deduction is allowed. However, all the capital expenditure are not allowed in one situation, in certain situations, right? Now, whenever the expenditure has been incurred by you for the purpose of CSR activities. Remember, whenever the CSR activity you are spending, it is considered as not for the purpose of business, not directly for the purpose of business. Hence, anything you spend in the name of the CSR activities, you shall not be allowed as deduction. Right? So the first situation, not allowed as deduction. Second is purchase of building for the purpose of specified business of setting up and operating warehousing facility for storage of food grains amounting to 4,50,000. See, first of all, under section 35 AD, he can, that is Mr. Manav can claim the deduction of 4,50,000 rupees for the for the expenses which is incurred for setting up of warehousing the facility. That is a capital expenditure. 100% is allowed as deduction because he has opted for normal regime, that is shifted out of default tax regime. Yes, section 35 AD is available, and yes, he will be eligible to claim 4,50,000 rupees as his deduction. Okay, see, all the points have been highlighted. You can get this PDF over Telegram. Link will be provided in the description. Interest on loan paid to Mr. X, a resident, 50,000 on which the tax has not been deducted. See, and the sales for PY for 24-25 for Mr. Manav is 2 lakh. Sorry, 202 lakh. That is nothing but 2 crore. Mr. X has not paid any tax on his interest. Basically, he has paid the interest on loan. Okay, he was supposed to deduct the TDS because he is an individual where his turnover is greater than 1 crore. He has not deducted the TDS. So what will happen? 30% of that amount will be considered as disallowance, and remaining, however, it will be allowed. 30% of the amount paid, whatever the payment made, will be considered as disallowance. Right? Under section 40A, here that is what I have been mentioned. We can highlight the points. Commodities transaction tax paid 20,000 rupees on sale of bullion. Remember, commodities transaction tax paid. If it is in the course of the business, your business is only you are dealing in this commodities transaction, and you paid the tax for it, and it is in the course of business. Yes, this 20,000 rupees will be allowed as a deduction. Commodities transaction tax paid in the course of the business is allowed as deduction, right? Provided whatever the commodities from selling these commodities, you are getting the income. That income should be charged under the head, the taxable under the head PGBP. Only then you will get the deduction expenses also. You will get the income deduction also. Clear? Question number 4. Test your knowledge. You have to examine and state whether it is true or false. For a dealer in shares and securities, transaction tax paid, security transaction tax paid in recognized stock exchange is permissible business expenditure. See, people, security transaction tax paid, and this fellow is dealing in shares and security. His course of business is only trading, right? Dealing in the shares and securities, and whatever he is paying, it will be allowed as deduction. But if you are calculating it is not in the course of the business, then it is not going to be allowed as your deduction. In the course of business, then it is going to be allowed as deduction. Okay. Where a person follows mercantile system of accounting, expenditure 25,000. Mercantile system of accounting means you are going to consider in whatever the expenses paid, payable, received, receivable, all the four you are going to include in the current year. Okay. Receivable and payable are going to be included. That is what I mean. And in the later year, the said expenditure, he paid 25,000 through cross check. See, he did not pay actually through cash. Okay. But he paid through cross check, which is not an acceptable form under section 40A3 for you to get the allowance over there. In order for your expenses not to be disallowed, that is, your amount to be allowed or it should not be disallowed. If you're thinking that, then you should have paid through account pay check, account pay draft, any other electronic clearance mode. It should not include cash check. It should not include cash, or it should not include crossed check. Okay, this fellow paid through cross check only. So it is going to be considered as disallowed. So section 48.3, similar to cash payment. Okay, section 48.3 is considered, and it will be what? Disallowed. So you can see the understanding here. The payment so made shall be deemed to be the income of the subsequent year. Disallowed means you are going to add back to your PGPP. Clear? Right. It is mandatory to provide for depreciation under section 32 while computing PGBP. This is mandatory. Remember, depreciation under section 32 is not optional, it is mandatory. So the answer is true. Depreciation, allowance of depreciation is mandatory. Right? Great. Fourth point, mediclaim premium paid by GIC by Mr. Lomesh for his employees. He has paid to account paycheck is a deductible expenditure. Whether it is true or false, it is true, right? Because this fellow paid mediclaim policy, employer paying the mediclaim premium for his employees in a mode other than cash shall be allowed as deduction. See, mediclaim premium paid by employer on behalf of the health of the employee paid by any other mode shall be allowed as what? Deduction. Under Section 35(8) DDA, amortization of expenditure incurred under eligible voluntary retirement scheme at the time of retirement alone can be done. The statement is false. The deduction under Section 35 DDA is provided on 5 equal installments, right from the time when they have made the actual payment. The expenditure incurred in this voluntary retirement, the deduction will be allowed in 5 equal installments beginning from the year in which each payment is made to the employees, not only at the time of retirement, whenever the payment is being made. An individual engaged in trading activities, exercises to shift out of default tax regime, can claim additional depreciation in plant and new machinery in trading concern. Is engaged in trading activities, can he claim additional depreciation? Is claiming the additional depreciation. Whether the statement is true or false, the statement is false. Additional depreciation can be claimed by the manufacturing unit, the production of a unit or an article or a thing, not by a trading concern, not by a service sector. That is what being provided. Additional depreciation can be claimed only by eligible plant and machinery and installed in the business of machinery manufacturing. Hence, in this case, he will not get anything. Clear? Great. Next question. Question number 5. Test your knowledge. Examine with reasons the allowability of the following expenses under the Income Tax Act 1961 while computing the income from business or profession. Okay. Again, allowable or not allowable is the question. Provision made on the basis of actuarial valuation of payment of 5,000. No payment was made. Remember, under section 40, subsection 7. Whenever you are making, when if you want to get any deduction under the gratuity, you have to make the actual payment. It is not the provision that you create under the actuarial valuation. It should be the actual payment made. That is, if you are creating, suppose if you are creating a provision for the purpose of actual payment made and the payment is actually made, right? In only in that those two situations wherein the payment is actually made on account of gratuity, you are going to get the deduction. Otherwise, no deduction is allowed in respect of any provision created except the payment is made under the provision. Here in this case, it is made on the actuarial valuation. Since no payment is actually made on the account, there is no deduction which is allowed. Right? Clear. Purchase of oil seeds of 50,000 in cash from a farmer on a banking day. See, section 40A3 disallowance is not attracted when the payment is being made to a farmer, to a person who is producing, to a person who is cultivating, basically, right? Directly in cultivation, growing, producing certain thing, wherever you are making the payment or for the purchase of agricultural produce over there, there is no disallowance that would attract when you make the cash payment even excess of 10,000 also. Tax on non-monetary purpose provided to employee. Remember, the tax on the non-monetary purpose, when the employer has paid it, it is going to be tax free. That non-monetary purpose is going to be tax free in the hands of employee. So what will happen? This amount which becomes tax free in the hands of the employee, it will not be allowed as deduction for the employer. So in this case, it is not allowed as deduction for employee. That is what being mentioned here, nothing else, people. The same things are mentioned over here. You can just give it one time. Okay. The payment of 50,000 by using a credit card for fire insurance. See, fire insurance comes under the general expenses. Yes, is it allowed for the purpose? If it is for the purpose of business and it is revenue in nature, yes, it is allowed. However, the payment of 50,000 is not paid in cash. No, for your section 48.3 to be attracted, it is paid using credit card. Hence, it is going to be allowed as deduction. The same point has been repeated. The payment of fire insurance is allowed as deduction. Since the payment is made to credit card, 48.3 is not attracted. Clear? Salary payment of 10,000 to Mr. X outside India by company without deduction of tax, assuming Mr. X has not paid any tax on such salary. Wherever you are making the payment of salary outside India, TDS has to be mandatorily deducted. If you're not deducting the TDS over there, then your deduction, that is disallowance of section 40A3 attracted in respect of salary payment outside India, because they have not done the TDS. So it is not allowed as deduction. The payment made in cash of 30,000 to a transporter in a day's carriage. Remember, section 40A3 deduction, sorry, disallowance is attracted, wherein you are making the cash payment excess of 10,000, right? Excess of 10,000 point is the regular term, but for this this carriage, this transporter flying or hiring of the goods carriage for that matter, the limit is 35,000, not 30,000. So not 10,000. So excess of 35,000 in cash payment, that is other than account paycheck, account pay draft, any other clearance mode, is going to be disallowed. In this case, it's going to be what? Allowed as deduction. Limit for attracting disallowance for the purpose of flying, of hiring or leasing of goods carriages, 35,000. Clear? TYK, question number 6. Examine with reasons whether the following statements are true or false with regard to the provisions of the Income Tax Act 1961. Payment made in respect of the business expenditure incurred on 16th February 2026 for 25,000 through a cross check is hit by the provisions of section 48.3. See, if you are making any payment other than account pay check here, cross check is not considered as account pay check. This is equivalent to other than account pay check. So this will be attracted to section 48.3 disallowance. So whether the statement is true or false, it is hit by provision of 48.3. Yes, the statement is true. That is what provided here. It is a condition precedent to write off in the books of accounts the amount due from the debtors to claim the deduction under section for bad debts. See, try to understand one point. First of all, whatever the bad debts has incurred, it is mandatory to write off the amount due from the books of accounts in order to claim such non-receivable amount as bad debt. However, see, what would have happened is that you have taken the debt has been taken into account in ICDS. As per the ICDS, you have taken this debt into amount. As per books of accounts, you have not considered any debt for that matter. That is, any bad debts you have not considered in books of accounts, but for ICDS, you have considered. Remember, when the debt becomes irrecoverable, in the previous year, you can claim it as deduction. And for in the books of accounts, it is automatically considered as it is written off. So the statement, whatever they have told, it is a condition to write off in the books of accounts to claim the deduction. Yes, it is absolutely true, because once you treat it as irrecoverable, you are going to claim it as a deduction in the year, in the previous year in which it is been considered, and you are going to, it is assumed that you have written it off or you have to write it off in your from your books of accounts. Okay. Whatever the failure to deduct the TDS in accordance with the provisions from the amount payable to this non-resident as rent or royalty will result in disallowance while computing. Yes, whenever you have not deducted the TDS, whenever you are supposed to make the payment to a non-resident as rent or royalty for that matter, this will be considered as disallowance, and hence the statement is true. Question number 7. Mr. Shivam, a retail trader of Cochin, gives you the following trading profit and loss account for the year ended 31st March 2026. So, what is the information given in the question? They have given you the trading and P&L information. Okay, opening stock here, purchase GP is given, sales, closing stock is given, salary, rent and rates, interest on loan, depreciation, printing and stationery, postage and telegraph, loss on sale of shares, to other general expenses, net profit is given, gross profit and income from UTI is given. What is the additional information which is provided in the question? It was found that some stocks were omitted. Basically, some closing stocks and opening stocks were not recorded. Can I say, if the closing stocks and opening stocks were omitted, means these are undervalued. If the opening stocks and the closing stock is undervalued, we have to look into corresponding effect, what it has affected in profit, and then we have to give certain effect, right? Okay, we'll come back to it. Let's go one by one. Salary includes 10,000 paid to his brother, which is unreasonable to the extent of 2,000. All of us know, to the extent of which is unreasonable to his brother. That is under section 48(2). To the extent of unreasonable to his relative, it is going to be what? It is going to be disallowed. To the extent which is going to be as per the fair market value or reasonable, that is going to be allowed as expenses. Unreasonable, it's going to be allowed as considered as disallowance. The whole amount of printing and stationery was paid in cash by way of one-time payment to Mr. Ramesh. One-time payment they have given to one person at one time. So what is that in printing and stationery? 23,200. It is paid in cash. Section as per section 40A3, excess of payment which is made in excess of 10,000 rupees other than account paycheck, account pay draft, or any other electronic clearance mode. Basically, now it is paid in cash. Cash payment excess of 10,000 shall be considered as disallowed. So 23,200 is disallowed. So all of us know as of now, it is disallowed means, so what does it mean? It is disallowed for the profit and loss account. It means allowed means you would have given minus from your profit, right? See, in order to understand this, I'll give you a very, very quick glimpse on how the profit and loss account works. Okay. If you know this, you can skip to the actual solving of the video. Those who don't know can watch this. Okay. See, whenever it comes, you have opening stock. I'm just writing T-shaped profit and loss account over here. You can just record your purchase. You will have some expenses. You will have sales. You will have closing stock, right? So let's consider you have opening stock sales as 100, just an example, and purchases has some 60, and you have closing stock of 50. So it is coming up to a total of 150. So how much is the difference? The difference of opening stock is how much? 90, right? So this is your actual figure. Just an example. I'm giving you just an example. Otherwise, you can do in a reverse way. You can call purchases as 80. So how much is it? How much is your opening stock going to be? 70. So the total is 150. Okay. So now if you observe something, let's do one point. Let's keep sales and purchases constant and let's change only the closing stock. Okay. Uh, 1 minute. I should have initialized this. Let's consider the opening stock is 30 and let's make it as profit. Sorry, okay. Profit. So 150 minus 80 minus 30 leads to profit of how much? 40. Okay. So now we know the effect of how the trading account is looking at. You can consider it as profit for that matter. Let's do one thing. Let's increase the closing stock to 60. Let's keep all the other figures same. What will happen to the profit? Profit automatically increases to 50, right? I'll change this total. Okay. When closing stock increases, what happens to profit? Profit automatically increases. If I do the same thing, if I just make it as 40 here, automatically your profit goes to 30. So can I say closing stock decreases, profit decreases. Now, let's do one thing. Let's keep the closing stock common. Let's keep the closing stock same and let's do the changes in the opening stock. Okay. Let's consider you have increased the opening stocks to 40. What will happen to profit? Profit will automatically decrease. So can I say when the opening stock when the opening stock increases, your profit decreases. Vice versa is also true. When the opening stock decreases, your profit increases. You can give another number for that and you can see. So you can just give it as 20 here. You'll automatically see this will get to 50, right? So when the opening stock increases, your profit decreases. When the opening stock decreases, your profit increases. So now what's the situation that we are seeing is that they have undervalued the opening stock and undervalued the closing stock. What does it mean? Undervaluation of closing stock means what effect it would have had on the profit is it would have had the increase effect in the profit, which is not correct. They have done this undervalue. Because of this, the effect is profit increase. This effect is not correct. So I have to give the opposite effect of it. See, opposite effect, this increase plus means opposite effect is also true. Opposite effect is minus is what you should do. And closing stock closing stock decrease has happened. This because of this profit has been decreased. You have to give the opposite effect, that is nothing but plus. You have to increase. So in this point, I hope you have understood what I have recorded here or what do I mean by here, right? What do I mean by here? This particular point. So we'll get back to all these points later, but let's finish of this particular point now, as however we have come up to this. So when the opening stock decreases is undervalued, the effect that it would have had on the profit is plus profit would have increased. The effect that it would have had on the profit is increased. So now you have to give the opposite effect minus. Closing stock decrease means profit would have also been decreased. So now you have to give the opposite effect, that you have to do the plus for closing stock. So now what you need to do in your solution is that your starting point will be your net profit as per your P&L, right? So what you should do for closing stock is that you should add 18,000 rupees in your P&L in your PGBP computation. Undervaluation of closing stock is 18,000. Okay. See now, undervaluation of closing stock is minus 9,000. That is what you have done here. This plus and minus effect. I hope you have understood. All of us has understood this. Clear? Great. So, however, we have come up to it, like we'll look into the each point one by one. This is done. So, salary includes 10,000 paid to his brother, which is unreasonable to the extent of 2,000. They themselves has given that unreasonable to the extent of 2,000 means this is disallowed. Disallowed means what here? Disallowed means you will add back to your profit, right? So 2,000 rupees you have added back. Clear? The whole amount of printing and stationery was paid in cash by the way of one-time payment to Mr. Ramesh. We have seen that point of 23,200. 23,200 we have added back in our P&L account. Why are we adding back? Because it's disallowed. Disallowance means what? You are not allowing it to be considered as your expenses in your P&L account. That is in your PGBP. It has been already allowed in your P&L account, but it is not allowed under your PGBP. Hence, it is disallowed. Printing a stationery 23,200. Clear? Now, depreciation provided in the profit and loss account 1,05,000 was based on the following information. See, your computation already has a depreciation of 1,05,000. This is as per P&L account, not as per your income tax. So, as per your accounts, books of accounts, as per your P&L account, whatever the depreciation is there, you are going to add back the depreciation and allow the depreciation as per your income tax. Right? How much is that? The opening balance of plant and machinery, that is the written down value as on 31st March 2025, minus the depreciation for AY 24-25 is 4,20,000. This is nothing but the opening WDV. The new plant falling under the same block of depreciation was bought on 1/7/2025 for 70,000. That is, new plant and machinery was added on 1/7/2025. Right? On 1/7/2025, new plant and machinery was added. So, the two old plants were sold on 1/10/2025. There is purchase, there is sales also. So now if I'm supposed to do the computation, how will I do? A very simple point. Opening balance, you will write cost of new machinery which was purchased and it is used for the business for more than 180 days as given in the, question. So it is 70,000. Whatever the subtraction, that is sales that you are doing, you are going to subtract it. Whatever the net figure you got, Array, this has been for more than 180 days. Think, this has been for more than 180 days. This has been for more than 180 days. It means both of them you can give 15% as the depreciation rate. No? See, people, you have a question, very good question, which has been added into your ICM material in the new syllabus terms only in this AY. There is some good question. There is one good question with relating to the depreciation wherein you are considering first in, first out method. By default, you're taking in the first in, first out for the purpose of calculating the depreciation. I'll teach that. Don't worry. Okay. As of now, understood? Opening balance plus purchases, what you have done. More than 180 days, full rate of depreciation is allowed. Here also it's allowed. 50,000 rupees is the subtraction. You are doing it. Out of the total, whatever you are getting as the last amount, 4,40,000 into 15% you will take and you will record 66,000 and you will close. Okay, 66,000 is the depreciation. Give the working note. Don't forget to give the working note. Every point which you are recording, which we are discussing over here, should be attached with a working note. Every point I'm repeating, every point should have a working note. Without working note, the 100% of the marks allocated will not be given to you. Only 50% of the marks allocated for each point will be given. Only if you write the solution without any working note. Without working note, you will not get full marks. That is why moral of the story. Rents and rates include GST liability of 3,400 paid on 7/4/2026. What is it? Rents and rates includes GST liability of 3,400, which is paid on 7/4/2026 year. Whether this rents and whatever this GST liability that was supposed to be paid, is it paid before 31st of October 2026? That is nothing but this is individual, no? Sorry. Then 31st of July 2026, whether it is paid before that. Or if it is paid before that, what problem do we have in life, right? All the taxes as per section 43B, there are certain payments which are supposed to make the payment before 31st, that is before the due date of return filing. This is an individual assessee. So before 31st of July, if this fellow has made the payment, you have no problem. 3,400 entire amount can be allowed as your, the entire amount can be allowed as your deduction. So there is no disallowance which is considered, but make sure that you are writing a working note to it. Other general expenses includes 2,000 paid to donation, charitable trust. Okay. 2,000 paid as donation to a charitable trust. Where is it? See, other general expenses out of the 7,060, whatever you have recorded, this includes pay 2,000 rupees, which is paid as donation, the charitable trust for that matter. See, whatever the donation which you have made, remember this donation will be not allowed as per PGBP, but there is a separate deduction which is allowed under section 80G and series. Not exactly under section 80G. It depends on for what purpose you are doing it. So under section 80G, you will get the deduction under chapter 6A. Deduction under chapter 6A, you will get the deduction, not get the deduction under your PGBP. Clear? So donation has been added back. This has been disallowed. So this is disallowed. This has nil effect. This has, as per books of accounts, whatever P&L you have, you will add back. As per your income tax, whatever the depreciation that you've calculated, you will give it as minus. Correct. This you have, however, disallowed. How much? 23,200 you have disallowed. 2,000 you were disallowed, and here you already have the effect. Clear? What is it you're required to do? The PGBP computation, fine. Under presumptive taxation also you're supposed to do, and under the normal provisions also. Clear? And assume that the whole amount of turnover received by account paycheck for that matter. For the purpose of, why is this information given? For the purpose of presumptive taxation. Presumptive taxation, all of us know. You have to consider if this is business or manufacturing. What is it? A retail trader for that matter. You have to consider how much? Under section 44 AD, you have to consider 6%. Okay, we'll come to it. We'll come to it. Let's not jump everything. We'll come to this presumptive taxation very soon. All these adjustments we have known. You can see here once under valuation 18 relation this 48 disallowance depreciation. We are supposed to do this. Donation is already given. Under valuation of stocks is given, and depreciation is also given. Let's look into these certain points in this. Okay. See, salaries allowed, rents and rates, and whatever considered, interest on loan. They have not given any information with regarding to interest on loan, so we are not taking any further consideration to it. We are assuming that it's already paid, and we are leaving it. Depreciation, we have already told you. Depreciation, whatever is mentioned as per your P&L account, this has to be disallowed. Clear? Printing and station is done. Postage and telegram is allowed. However, if it is for the purpose of business here. Loss on sale of shares. This has to be dealt with the capital gains, not as per PGP. Okay. In the question, they have just asked you to calculate PGBP. So, what are we doing here is, this is then expense. This is towards the expense side of your P&L. It means it is already allowed as expense. Now, what you are supposed to do, you are supposed to disallow that. Disallow of how much? 8,100. Array, this is the loss which you are going to show that in your capital gains. Why do you come and put it over here? It has to be shown in your capital gains only, no? So, loss on the sale of shares, it will be dealt in capital gain, not in your PGBP. As we are doing the computation of only PGBP, we are adding that. And in other cases, we would have shown it under capital gain as capital gain loss. Okay. And here, income from UTI. Income from UTI, this is the income from other sources. No, this is income from other sources. So, it shouldn't be coming under PGBP. This is increase the profit. See, this profit, net profit of 50,000 has the effect of this income from UTI, no? So, this has increased the profit, which shouldn't have happened. So what are we going to do? We are going to do this minus in PGBP and add this in income from other sources. Can I say add it in income from other sources? This comes under total income computation question. This is only PGBP. So we are giving only one effect, that is minus in PGBP. Minus in PGBP 2400, the short term capital loss on shares 8100 you have added. So after doing the computation, you will get 1,30,900. Computation of the business income as per the section 44 AD. This is as per the normal provision. Now calculating under the presumptive taxation, all of us know 6% of the turnover because it is completely bank transaction, no cash turnover over here. So whatever how did you get this 1,12,000? Govinda, see here. Buy sales 1,12,000, 11. Sorry, 1 crore 12 lakh 11,500 you have here, no? This itself is your turnover for the purpose of calculating into 6%, you will get the solution. Okay. So this is your illustration. Sorry, test your knowledge question number 7. Next question 8. Mr. Sukhvinder is engaged in the business of flying goods carriage. On 1st April, he owns a 10 truck, out of which 6 heavy goods vehicle, and the gross vehicle weight of this is 15,000 kg. So he had 10 vehicles, 10 trucks, out of which 6 were heavy goods vehicle. Okay, calculation of heavy goods vehicle are different, other than heavy goods vehicle are different. So it becomes important. On 2nd May 2025, he sold one heavy goods vehicle and purchased a light goods vehicle. So now the category is something like this. You had 10. 6 were, you had 10. 6 were heavy goods vehicle and 4 were non-heavy goods vehicle. Right? Now you have sold this. So how much you have? You have 5 heavy goods vehicle and you have 5 non-heavy goods vehicle. So this is the understanding that you are supposed to have. Okay. So compute the total income of Sukhvinder, taking into note freight charges collected is 12 lakh 17. This is as per the books of accounts maintenance. Okay, net profit how much he has got? 4 lakh 45,000. Depreciation also he has here. Other than the business income, that is other business and non-business income is 70,000. So now what you're supposed to do is that he has already is already having information as per the normal books of accounts. Now what are you supposed to do is that you are supposed to consider what will be his income that is supposed to be taxed under section 44 AE under presumptive taxation, which is available for this goods carriage for that one. See, if you can observe, heavy goods vehicle, this fellow has sold it on what period? On 2nd May, right? On 2nd May, he sold one of the heavy goods vehicle. So for your understanding, can I say whenever you are taking in heavy goods vehicle, what is the minimum amount that you are supposed to consider as your income? 1,000 per ton per vehicle for full month or a part of month. Part of month means even for one day. One day in a month you have used it also. You have to consider one entire month for the purpose of income calculation. You have to take it and round it off. So 2nd May means April is one full month. And April 2 days you have used. No? So even that will add as your months over here. So 1,000 per ton into number of tons into number of months into number of vehicle. One vehicle, no. So it's going to be 30,000. Remaining 5 goods are there. You have not touched, you have not sold anything. It is running as usual. So can I say 1,000 per ton? 15,000 tons are there. So it is going to be 15 tons. 15,000 kgs is there. So it is going to be 15 tons. Into months is 12. Into 5 goods vehicle carriage throughout the year is 5. So how much is it going to be? 9. Correct. So you are going to multiply. Other than the heavy goods vehicle, if you can observe, 4 were there earlier also, now also. So 4 goods into 7,500 rupees is what you're going to consider for 1 month. There is no tons or anything like that. It's just for 1 month, one vehicle 7,500, 12 months, 4 vehicle. You got the amount. 7,500. You have purchased a new vehicle on 6th May. So that is going to be 6th May means even 11th month also you need to include. That May month also you need to include. So 11 months into one vehicle. So it's going to be how much? 82,500. So now if you do the total calculation, you will get under presumptive taxation, your total income will be, or a total of all these things here. This total you will get 13 lakh 72,500. Okay. And other income as usual of 70,000. So total income was this. If the books of accounts were maintained, 4,45,000 was your income. How did you get this? It's already there in the question. And other income 70,000. So 5,15,000. Fine. Are have they asked you for a suggestion as such, like which one to use or which one not to use? No. They've just told compute the total income of Sukhvinder taking note of the following data. So it means to state they have just asked you to calculate, just leave it. If they ask you for the suggestion, you tell books of accounts maintenance is the better option for the assess. You can see that. Clear? Great. The next question, Mr. Raju. Mr. Raju, a manufacturer at Chennai gives you the following information: trading and profit and loss account for the year ended 31st March 2026. Manufacturing, trading, profit and loss account for the year ended 31st March 2026 as below. And you have certain information which is given in your P&L and trading and profit and loss account. See, people, all this question number 7, this question number 9, all these are exam oriented question. It means day before the exam you have to make sure that you are recording or you're understanding or you're solving by your hand all these questions. Okay. Following information relating to the financial year 2025-26. Administrative expenses include 46,000 paid as commissioner to brother of the SSE. The commission amount at the market rate is 36,000. See, normally speaking, if you would have paid as per the fair market value, you would have paid 36,000. But because he's your brother, how much you are paying? 46,000. The payment made to a relative excess of fair market value will be considered as disallowed. So can I say in this case 46,000 minus 36,000, that is 10,000 will be what? Disallowed. Disallowed means added back. Clear? Amount paid 33,000 in cash for a transport carrier on this date. Amount is included in manufacturing expenses. TDS not applicable, whatever it is. See, transport carrier, if you're considering the cash payment in excess of 10,000 rupees, the limit of 10,000 rupees is increased to 35,000 under section 40A3 for this transport carrier specifically. Flying, leasing, or carrying of this carriage of this goods carriage of the transport goods carriage for that matter, 35,000 is the limit. So below 35,000, whatever cash payment you make, in this case 33,000 in cash is also allowed. So the effect is nil. It is allowed as per your income tax. No disallowance. So a sum of 4,000 per month was paid as salary to a staff throughout the year, and this has not been recorded in the books of accounts. Tell me, the sum of 4,000 per month was paid as salary to staff throughout the year. This has not been recorded in the books of accounts. See, this calculation for that matter, it can be assumed in two ways. One, omission, and another one, undisclosed expenditure. You can consider it as anything. If you consider it as omission, it means now the expenses is considered as allowed expenses and you will record, right? See, what have they considered in your ICA material is that staff salary paid but not recorded is what they have considered. It means omission. You also consider, take the same assumption and record the salary staff, which is a revenue expenses for the purpose of business, has been omitted, but it is allowed as per your income tax. So if it is allowed, what you will do? 4,000 into 12 you will do, that is 48,000. This will be allowed as your expenses. So allowed as your expenses minus. Okay. Good. Bank term loan interest actually paid up to 31st March 2026 was 20,000 and the balance was paid in November 26. So how much is the interest on loan given in the question? 60,000 is the interest on loan given. See, out of 60,000, this fellow has already paid how much? 20,000. So remaining 40,000 is paid in November 26. This is after the due date of income tax return 139(1), right? As per section 43B, any payment, that is the following payment, which includes the interest which is supposed to be paid to the financial institutions, banks also. If the payment is made after the due date of 139(1), then you are not supposed to get that expenses as deduction. It means it will be disallowed. It will be disallowed. How much? 40,000 will be disallowed. Clear? Now, housing loan repaid during the year 50,000 and it relates to residential property for that matter. Taking these are not dealt in the P&L account given above. This information is not there in your P&L account. Right? Now, See, compute the income of Mr. Raju for AY 25, 26, 27, assuming he pays tax under default tax regime. This is the catch over here. He pays tax under default tax regime. Now, after looking into this point, you can come over here. Housing loan repaid of 50,000 rupees. Generally speaking, if he was supposed to pay under normal tax provision, housing loan repaid, he would have got under 80C. But because it is under default tax regime, he is not getting any 80C deduction here, right? And it relates to residential property acquired by him in PY 24-25 for self occupation. Interest on housing loan was how much? 23,000. Again, will he get this interest deduction for that matter? Will he get this interest deduction? Will he get this interest deduction? There is no interest allowed as deduction under section 24B for self-occupied purpose if he is coming at a default tax regime. So both of this will not have effect in your calculation. Correct? Done. Let's look into this point in our solution. Okay, only that point. Income from house property, self-occupied property. So there is no value. Interest under section 24B, interest on housing loan, it is not allowed as per your income tax under section 115 BAC. If you're opting in for 115 BAC, there is no interest on housing loan provided for self-occupied property. Clear? There's nothing. There's no loss which is allowed. There's no expenses which is allowed. Depreciation allowable under the act. Now, like coming back to the PGBP on the basis of the following information. P&L account depreciation rate is how much? 15%. WDV as on 31st March 2025 minus depreciation for PY 24-25. Opening WDV value they have given. Additions during the year more than 180 days is 2 lakh. Total addition is 4 lakh. Be very careful. Total addition is 4 lakh. Out of this, addition more than 180 days is 2 lakh means remaining this minus this is 2 lakh. Out of the 4 lakh, 2 lakh is more than 180 days. Okay. This is more than 180 days. So then, how much is less than 180 days? Deduct the additions which has been made. Another 2 lakh. Right? Clear? This is what is happening. So now, we have seen the similar points here. 5 lakh. Payment made to a relative. I told you 10,000 rupees is the deductions that you're going to take. 10,000 rupees done. Cash disallowance up to 35,000 it's allowed. So nothing. Bank term loan, I told you 60,000, 20,000 is already paid. 40,000 is not paid before the 139 due date. You will consider. We'll come back to this point later. Depreciation as per P&L account. How much is it? How much is given as per P&L account, people? P&L, P&L, P&L. How much is depreciation given as per P&L account is 2 lakh. So what you're doing it, 2 lakh rupees you are adding back. Now if you take the calculation as per your depreciation as per your Income Tax Act 1961. WDV as on 1/4/2023 is how much? 11 lakh 90,000. Purchase more than 180 days, 2 lakh. Less than 180 days, 2 lakh. So the total additions you have. If you can observe something, this you are going to apply 15%. This you are going to apply 15%. You can apply 15% separately to this also and do the calculation. That's totally fine. So what I've done is that I've added both and I've given 15%. Both are totally fine. Okay. So less than 180 days means it's just only 50% of the allowable rate of depreciation is allowed. So 15%, that is 7.5%, 15,000 is allowed here. The total depreciation is given in the question. Sorry, the total depreciation you have calculated 2,23,500. Now tell me, would you get additional depreciation for the new machinery purchase? No, additional depreciation would not be available to him because he is opting for 115 BAC. Remember, there is no additional depreciation that you are supposed to provide. Okay, see, depreciation as per income tax. Considered, cleared, and salary staff paid not recorded is also here. So now let's get back to few points over here. So all these points have been dealt with. Okay. Administrative charges is done. SGST penalty. Do you have any information as such? No. But remember, any penalty which you have paid, for the breach of contract, it's going to be allowed as deduction. But breach of law, it's not allowed as deduction. What does it mean? See, you have told that you will deliver some 10,000 kg of certain material. Okay, you have delivered only 8,000 kg within the, let's consider 10th of March. You have supplied only 8,000 kg. You did not fulfill your entire contract, because of which they have given 5,000 rupees penalty, suppose. So now that 5,000 rupees penalty which you have paid can be considered as deduction under your income tax, because see, if you are doing business here and there, things happens, you pay penalty, that should be allowed as expenses. Department is considering, yes, we will do that. Fine, totally fine. But when it is the breach of, when you did not comply with certain provision of law which has been stated, then they are like, no, we will not allow that. We are going to disallow this. Disallow means add back. That is the SGST penalty, wherein you have to consider SGST penalty is been added back. It means it is disallowed. I hope it is clear. See, GST paid. GST paid information is already that it is paid. It's not payable. It's already paid. So we have no problem. We are not touching it. General expenses considered, interest on loan considered, depreciation considered. This is fine. So now if we can come up to these 2 points, dividend from domestic companies, 15,000, right? This is your income which is supposed to be charged under tax under the head income from other sources, but not under PGBP. So now you have to take this income out of the PGBP profits. This 15,000 which is included in the profit, you have to remove it from your PGBP. Means minus from your profits, add it under income from other sources. Okay, throw it under income from other sources and keep it. That is what you're doing, minus PGBP, and you're going to add that in income from other sources. Next, income from agriculture. By income from agriculture, all of us know income from agriculture is exempted. We are not going to make it as taxable. It's exempted. So what you're going to do now, you have to remove that from your profit because this is not taxable under the PGBP. You're not going to add it anywhere because it is exempted. You're just going to write one note over there. It is exempted. So we are not going to consider. Minus PGBP. See, two things you have to do under minus PGBP. Dividend from domestic company, taxable under income from other sources. Income from agriculture, exempted under section 10(1), 1,80,000. Okay. So now here, you are doing total income computation. So dividend from domestic company, I told you, add it under income from other sources, minus it from your PGBP. Clear? Minus in PGBP, add it in income from other sources. That is what I told, minus and plus. Okay. Clear. So after doing all the calculation, you can do the similar, you can do the plus and minus, and then you will come to GTI. This is default tax regime, so you don't have any ATC deductions or anything like such. Then directly we'll get to NTI 3,03,000. That is what asked in the question. You have done with it. I hope this question was clear. Okay. Mr. Tenzine is engaged. Now question number 10. Test your knowledge. Mr. Tenzine is engaged in the composite business of growing and curry coffee in Coorg, Karnataka. The whole of Karnataka, the whole of coffee grown in plantation is curry. So they have given the relevant information for you. Opening balance of car. This is the only asset in the block as on 1/4/2025. Opening balance is given. This is after doing the depreciation for the last year. Nothing but the opening balance they have given here directly. No problem. Opening balance of machinery as on 1/4/2025. This is also the opening balance of machinery they have given. No worry. Expenses incurred for growing coffee, which you have to subtract. Expenses incurred for currying coffee, expenses subtract. Sale value of curd coffee. This is the revenue, right? From this, you are going to subtract this, and you are going to subtract the depreciation also. Besides being used for agricultural operation, the car is also used for personal use. Disallowance for personal use is 20%. So, the car has been used. The depreciation, what you are going to consider, shall only be to the extent of 80%, which is allowed, and 20% of this depreciation is not allowed. Remember this. Okay. And the expenses incurred for car maintenance is also how much? 50,000. Out of this, you are going to consider only 80% of this car expenses as allowed. 20% of that will be disallowed. Disallowed means it's not allowed for your calculation. So computing income arising, a very simple question. Question looks complicated. Question is actually very, very simple. Solution is simple. You should make sure at one last point, this is the coffee, so that you're going to have an apportionment of 75% and 25%. 75% is treated as agricultural income and 25% is treated as your business income. So make sure that you are doing it. 25% and 75% you are supposed to do it. Now, first, let's do the depreciation calculation. We have the opening balance. There is no purchases. There is no sales. Closing balance is also so much. Depreciation, you will take 3 lakh. For the car, all of us know it is only 15%. 15% you will take 45,000. But however, 20% is disallowance. No, you are not supposed to use 20%. So you are going to take only 36%. So you could have done this also directly instead of this so much calculation. 3 lakh into 15% into 80% if you would have done also, your solution would have been right. No problem. Okay. And here you will take opening balance, no purchase, no sales is there. So directly 15% you will take 2,25,000 plus 36,000 becomes your total depreciation that you're supposed to record here. Okay. See, sorry, depreciation on machinery is given. You can take the total depreciation directly or you can show it as separately. It is shown separately in the solution. So you can show it separately. And expenses for coffee is already given. Sale value of curd value I already told you to set it as revenue. Expenses for growing coffee is minus. Car expenses, as I've told you, 50,000 into 80% only considered as that is allowed as deduction. Car on depreciation on car is given. Depreciation on coffee currying operations is also given. Minus you're doing, depreciation is also provided. Expenses is there, depreciation is also. Now you have total profits from composite that is from your total composite operations, that is 12 lakh 89,000. This 12 lakh 89,000, this is your total 100% of your income that you have, and out of this 75% is exempted, 25% is considered as your business income, which is supposed to be taxable. Clear? Test your knowledge. Question number 11. A very simple question. It's all a very easy question for you people. I know. I have the confidence on you. It's a very simple question. Mr. Prem has the following assets used for business purpose on 1/4/2025. See, there's a machinery which is costing 4 lakh and it is used for scientific research, and wherein the deduction under section 35 is already allowed and clean. Tell me, what have they asked you in the question? They have asked you what is the depreciation allowed. When you've already claimed the deduction under section 35 for scientific research, the entire machinery cost of 4 lakhs, will you get the depreciation again? No, you will not get the depreciation again. It means once you take the deduction, you will not get the depreciation. So there is no depreciation which is allowed. Laptop received as a gift from his friend costing 60,000. It was purchased on 1/4/2024 by his friend. See, when the laptop was purchased, it was purchased on 1/4/2025, which was costing 60,000, and it is received by him now. See, when this laptop was purchased 60,000 rupees in last year, that is in PY 24/25, now I have to bring it to the opening value to see how much is the depreciation that I can take from it, right? Out of the 60,000, 40% depreciation shall be charged for last year. So 60,000 minus 40% if you do, you will get 36,000. This 36,000 into 40% is what the depreciation that you can consider in the current year. That is nothing but 14,400. 14,400. Okay. 14,400 is the depreciation you will take. Don't forget, this is not current year. This is the last year that fellow has bought. So I have to bring it to the corresponding, that is to the relevant PY for the purpose of calculating depreciation. Temporary wooden structure costing 70,000 erected in December. All of us know temporary wooden structure. How much is the depreciation rate? 40%. If you know the rate over here, you can play with this question. Wooden structure 40% on 70,000. However, it is purchased in December. So only 50% of the depreciation is going to be allowed in the relevant year. That is nothing but 70,000 into 40% into 50% of this. Nothing but 20%. 70,000 into 40%. 70,000 into 20%. Right? Clear. So 28,400. AB Light PLP. Now the question number 12. AB Light AB Light LLP consists of two working partners, Mr. Anand and Mr. Beam, with 60% and 40% share respectively. As per the partnership deed, they are eligible for interest on capital at 15% per annum. on the capital contribution of 15 lakh each and the remuneration of 50,000 to Anand and 40,000 to P. Basically, what is happening is there are two working partners, okay, 60% and 40%. This is absolutely of no info. This is absolutely of no use for us in this question. Eligible interest rate, they have, as per the deeds, they have 15%. Okay. Capital contribution is 15 lakh. Remuneration, how much they are taking, each person is taking is Anand is taking 50,000 and Beam is taking 40,000. And this firm is in manufacturing business. Very well. How much is the net profit and loss before interest and remuneration is 25 lakh 86,000 and also before the following items considered. Clear? You are required to calculate what have they asked you to calculate. They have asked you to calculate book profit. This is a new question which has been added. So all the new questions which are added, those will be an hot topic for us for our exams. A practice is needed. You are required to calculate book profit. Remuneration available in the hands of AB Limited for AY 62627. Also determine the amount of remuneration which is taxable. So what have they asked you? One, they have asked you to calculate a book profit. How much is the remuneration that is going to be available? And also how much is the remuneration which is taxable in the hands of Mr. Anand and Mr. Pim. Three things we need to calculate here. In order to calculate the book profit, we need to know how much is the actual profit, 25 lakh 86,000. Okay, very well. This is before interest on capital, no? So now we are supposed to subtract what is the interest on capital which is allowed as per income tax. 15 lakh into 12% you do, that is going to be 15 lakh into 12%. How much is 15 lakh into 12%? 1 lakh 80,000. This is for one partner. If it is for two partner, how much is it? 3.6 lakh. So 3.6 lakh is allowed as deduction. Where is it? Out of this, 3 lakh 60,000 is allowed as deduction. I told you the calculation. Clear? Now, remuneration, we'll look into it later. We are calculating the book profit. So now first out of this 5, whatever the information you can see, now we have to subtract one by one from your profits. First, you have to subtract the current year revenue expenditure on scientific research. 2,40,000 you will subtract. Okay. Then, just a minute. 2,40,000 you will subtract. Then, you will subtract current year depreciation also you will remove. Okay, you will remove current year capital expenditure. That is, you will subtract all this from your profits in order to calculate the book profit. Okay, all these are allowable as per book profit also. You will subtract the unabsorbed capital expenditure on scientific expenditure and you will subtract unabsorbed depreciation. All the 5 points you will subtract. 2 lakh 40, 4 lakh 70, 3 lakh 45, 52 and 85. You will get the final. But you will not subtract this book profit that is brought forward the business loss because that is not allowed as deduction under your book profit calculation. We are not going to subtract that business loss, brought forward business loss in your book profit calculation. So we are not leaving that. Your actual calculation is different. I'm speaking about the book profit calculation, right? So 10 lakh 35,000 34,000 rupees is your book profit. You have done with it. Now we have to calculate what is the uh, remuneration which is available or allowable. What is the remuneration actually paid is 50,000 into 12 months for Anand and 40,000 into 12 months for Beam. So total 10 lakh 80,000 they are paying as the remuneration. Partners remuneration which is available under section 40B is up to 6 lakh, 90% is allowed. On the balance or the remaining 60% is allowed. So how much is your income? 10 lakh 34,000 is your book profit. So out of that 10 lakh 34, 6 lakh, if you take on the first 6 lakh, 5 lakh 40. And how did you get this 4 lakh 34,000? 10 lakh 34,000 minus 10 lakh 34,000 minus 6 lakh. If you do this, you are going to get how much? You are going to get this 4 lakh 34,000. On that 60% you are multiplying and you will get the total of 8 lakh 400 after adding these two. This is the actual remuneration which is available as deduction under section 40P, maximum remuneration allowable as deduction. But how much is the remuneration which is actually paid to the partners is 10 lakh 80,000. So how much is the total available for the firm as deduction is only 8 lakh 4,000. So second part of the question is also done. Only the last part is there. That is the third part, wherein how much is taxable in the hands of Mr. Anand or Mr. Beam is the point. Mr. Anand as business income is going to be this 8 lakh 400 is allowed as deduction out of 10 lakh 80,000. Then how much is for the 6 lakh that is getting? Say a very simple calculation. 8 lakh 400 is the actual remuneration that is supposed to be allowed as deduction and taxable in the hands of Mr. Anand, out of how much total? 10 lakh 80,000. This is what both are getting in total out of the total payable of so much, actually paid of so much. If this is the case, this fellow is only getting 60,000. This is nothing but 50,000 into 12. Okay, 50,000 into 12. You're going to get how much? 4,44,667. This is one point of doing. Okay, if you feel this is difficult, you can do in another way also. 10 lakh 80,000, sorry, 8 lakh 400 is something. The total remuneration which is available as a deduction under income tax. No, we'll do one thing. If this is for the total, this is for the total remuneration per month which they are receiving, 50,000 plus 40,000. Okay, for 1 month only we'll consider. If this is for particularly 1 month, the total of 90,000 which we are getting. So how much is it for 50,000? How much is it for? How much? 50,000. So how much would you get? Here also you would get 4,44,667. You can calculate in any ways, either this way or this way. See, this is for total 12 months, both the partners. This is for one partner, Anand. You are calculating it for only Anand here. So how much is specifically for Anand? One entire year. Otherwise, you can take in per month total. For both the partners, for 1 month, if he is getting so much, how much is Anand supposed to get the amount and make it as taxable in total? Out of this 8 lakh, 4,44,667 will be taxable in the hands of Mr. Anand. Similar calculation you will do for Mr. Beam also. 3,55,733 will be taxable in the hands of Mr. Beam. So this is your question number. Now, question number 13. See, this is also a very, very simple question. Question 13. Mr. Piyush runs, this fellow runs a sole proprietor and he owns 4 machineries for that matter. Okay. And the depreciation on these machineries are charged at 15%. WDV value. Opening balance is 7 lakh 70 and 2 machines, see here, 2 of the old machines were sold on 15th July 10 lakh and 2 and the second hand plant was bought on 6 lakh 10,000 rupees. Bought on 6 lakh 10,000 on 30th December 2020. Further, Mr. Piyush has bought the following, has made the following expenses. He made certain payment to UV University and approved university wherein he can get the deduction. And another to Satyavati College, there is no point of approved university. So this is not an approved university, right? You have to calculate claim of depreciation and deduction available under section 35 if he has shifted out of default tax regime. Okay. Claim of depreciation is very simple question. Opening balance you have 7 lakh 70. Okay. How much is it? Just a minute. 7 lakh 70,000 opening balance is given. Purchase of second hand plant during the year is 6 lakh 10. Total is 13 lakh 80,000. And second hand machinery which has been sold, basically 2 machineries which has been sold is 10 lakh. So how much is the block which has been left? 3 lakh 8. See, if you observe something very carefully and if you apply the common point or the common sense here, this sale has happened is 10 lakh. Obviously, this has been purchased in December. It means this 10 lakh rupees should be first exhausted against your opening block, right? First 10 lakh rupees, you have to set it off against 7 lakh 70,000. Then the remaining amount will be set it off against this. It means what is left in the block, that is 3 lakh 80,000 which is left in the block is nothing but your the purchase which you have made as a second hand plant only. This balance is nothing but this. So it is very much, it is a very much a logical point for me to take this 3,80,000 and say this 3,80,000 rupees, I'm just going to take the depreciation of 15%, which is restricted to only 50%. Nothing but depreciation of 15% is allowed. But I'm going to take 50% of it, means I'm going to take only 17.5% on this 3,80,000, because this 3,80,000 is nothing but, logically speaking, a leftover part of the second hand machine only, and it has been purchased in the month of December. So only 50% of the depreciation is allowed. That is why I have taken 3,80,000 into 15% into 50. Nothing but 3,80,000 into 7.5%. If you do, you will get 28,500. Clear? A very, very good logical point. So the next point is deduction available. I told you UV University is an approved university. So under section 35 subsection 1 clause 2, 100% of the depreciation is allowed. Sorry, 100% of deduction is allowed. How much is the deduction allowed? Entire 15 lakh. However, the Satyavati College wherein you have mentioned is not an approved university, so it is going to be nil. So deduction allowable under section 35 is amount 50. So this is your test your knowledge question. Illustration 1, PGBP. Mr. X, a proprietor engaged in the manufacturing business, furnishes the following particulars. Opening balance of plant and machinery as on 1/4/2025, that is WDV as on 31st March 2024, after reducing the depreciation for PY 24/25 is 30 lakh. So opening balance of the plant and machinery as on 1/4/2025, this is nothing but the opening, that is nothing but the opening WDV, that is 30 lakh. They've already covered the depreciation for the preceding PY, so no problem at all. This is nothing but my opening WDV. New plant and machinery purchase and put to use on 8/6/2025. New plant and machinery purchase, very well. And 8/6/2025 means it is used for a period more than 180 days. Nothing but 20 lakh, you will get full rate of depreciation. This has been put to use on 15/12/2025. It means only 50% of the allowable rate of depreciation, that nothing but 7.5% will be allowed as depreciation over year. Computer acquired and installed in the office premises on 2/1/2026 year also. 50% of the allowable rate of depreciation, 40% is allowable into 50%. That is nothing but 20% will be allowed as the depreciation for 3 lakhs. What are you supposed to calculate? You're supposed to calculate the amount of depreciation and additional depreciation which is available. He has shifted out of the default tax regime is the question. See, for computers which is installed in the office premises, you will not get additional depreciation for this, right? However, you will get additional depreciation for this new plant and machinery acquired. 100% of the additional depreciation you will get here, you will not get 100%, you will get only 50% here. That is what the question is about. See, normal depreciation, you have the opening balance. How much is it? 30 lakh. Plus how much? 20 lakh. The total of 50 lakh, however, you have the 15% which is the applicable rate of depreciation in the both the place. This has been purchased for a period. This is a opening balance. Purchased for a period more than 180 days, that is used for a period, put to use for a period more than 180 days is 20 lakh. So total WDV year over is 58 lakh, including the new plant and machinery acquired. What are we looking over here is the WDV. What is the format of WDV? Opening plus additions. In additions more than 180 days, less than 180 days. Then you will give minus sales. Right? That is how the format is. You have to write as per the format. That is WDV before depreciation is 58 lakh. And computer, the another block is added over here. That is nothing but 3 lakh is the block which has been considered here. And written down value is so much. And composition of plant and machinery for that matter is, in case of the WDV is 50 lakh, 30 lakh plus 20 lakh is the total, used for a period more than 180 and less than 180. This is 8 lakh over here and computer over here. You can just give this one table and that would be fine. Good to go with this. This is just a practice question. If you are getting a question similar to this, it can be an MCQ, not in a full-fledged question though. Okay. So 50 lakh, all of us know, opening 30 lakh plus purchases made during the period, which is more than 180 days. They have considered both. You can either split it into 30 into 15% and 20 into 15% and write both means same. It's the same answer. You're going to get the same marks. 15% into 50 lakh, so much. Then less than 180 days you have no 8 lakh worth of the plant and machinery. 8 lakh into 7.5%, yes, you have considered here. And then for computers, you have 3 lakh into 20%, you have considered here. Correct. So additional depreciation would be you will get only for new plant and machinery, that too installed in the factory, not in the office. So for new plant and machinery more than 180 days, 100%, 20% also you will get. 100% of the allowable rate of depreciation means full rate of depreciation you will get. That is what in normal language. Full rate of depreciation, half rate of depreciation only over here. I hope you have understood. It's a very simple question, no complications in it. Okay. Now, question number 2, that is illustration 2. Car purchased by Dr. Soman on 10/8 2022 for 5,25,000 for personal use. Very well. He bought it to professional use in 25/26 PY when its market value was 2,50,000. You have to calculate the depreciation, actual cost of the car, and the amount of depreciation for AY 25/26, assuming rate of depreciation is 50%. See, the question is very, very simple. You can expect this sort of question in MCQs, wherein it's a good question for MCQ also, wherein they have given you a point for you to confuse. The market value is so much. But always remember the actual cost of consideration, the actual cost, the money which moved out of your pocket will be considered as the actual cost of asset. That is what you'll consider as the actual cost for the purpose of your definition, right? Market value which they have given is not relevant. Hence, 5,25,000 into 15% will be considered, 78,750 will be considered as your depreciation. Clear? Now, a newly qualified illustration 3, a newly qualified CA, Mr. Dhaval, he has started his practice and he has set up his uh, office during financial year 25/26 at a cost shown at each item. You need to calculate depreciation for EY 26/27. All items were purchased via account pay check. Okay. Computer, including the computer software. Here they have given two information, date of acquisition and date when it is put to use. Both the information is been provided. So what you need to do is that you need to now understand whenever you are considering the date for calculating 180 days, less than 180 or more than 180, you should never consider date of acquisition. Date put to use is what we are considering, right? So this becomes irrelevant. You don't cancel out in your textbook and all. It's just for your understanding that we are not going to consider this. We are going to consider only this date when it's put to use. Amount. Okay. Now, so computer including computer software, it is on 1st October. So used for a period more than 180 days. Or you can calculate here. It is more than 180 days. 35,000. Computer UPS used for a period 8th October means it is used for a period less than 180 days. If you do the calculation, you will get less than 180 days. So it is going to be 50% of the allowable rate of depreciation. Computers are 40%. No, computers and computers accessories are 40%. So 50% of 40% is nothing but half rate of depreciation only you will get. You will calculate 20% here. 1st October, you will calculate 40% here. Books for that matter, other than publications, are of 12,000. Books for that matter, it is going to be how much? 40%. It is 1st April 25, so 180 days, more than 180 days. Office furniture acquired for practicing CA, 1st April. Again, office furniture goes with the concept of 10%. Laptop, it's going to be concept of 40%. However, it is 8th October, so it is going to be half rate of depreciation allowable. If you can just see the table here, furniture will be taxable at the rate of 10% used for a period of more than 180 days, 3 lakh into 10%. Done. Computers, including computer software, 40%. Here, less than 180 days, 20%. Computer printer over here, used for a period more than 180 days, 40%. Less than 180 days, 20%. Books, being annual publications for that matter, books for that matter, it's going to be how much? 40%. So you're going to provide the same, you're going to include the same, you're going to get 34,500. So now whatever the depreciation you've calculated, you put in the total, you will get the total depreciation which is allowable, right? Now, illustration 4. Mr. Gama, this fellow is a proprietor. Excuse me. Sorry. Started a business of manufacture of tires and tubes. Okay. A manufacturing unit set up on 1/5/2025 during the period. He commenced his manufacturing operations on 1/6/2025. The total cost of the plant and machinery installed in the unit is 120 crores. The said plant and machinery included the second hand plant and machinery also. Basically, the total cost of plant and machinery which he installed is 120 crores. Okay, that is the crux. And the plant and machinery, whatever he bought within this 120 crores, included a second hand machinery of 20 crores and a new plant and machinery for scientific research, which was 15 crores. These two are the crux. One is second hand and one is new plant and machinery. Compute the amount of the depreciation allowable under Section 32 of the Income Tax Act 1961 in respect of the assessment year 2627. Now you need to calculate the what is the depreciation which is allowable. If you can consider something, see total cost is 120. Out of that, something which you're using for scientific research, you will get 100% of the deduction. Capital expenditure which you have made, you will get what? 100% of the deduction. So entire 15 lakh you will get deduction. You will not get any depreciation for that. 15. If deduction is available, there is no depreciation. If you are considering it as depreciation, there would be no deduction. You can take only one. Okay. You can choose any one. You can't choose both. 105. Normal depreciation at the rate of 15% on what? On 105. That is 15% is the rate of depreciation. You got it. Additional depreciation when you're calculating, all of us know scientific research, though it's not available. All of us know this. Second hand plant and machinery is not eligible for your additional depreciation. So this 120 included this 20, remove that 20. This 120 included this 15, wherein deduction is already taken, remove that 15. 85 you have. On that 85, you will take the full rate of depreciation because it is more than 180 days, 17, and you will calculate depreciation allowable during the year is 32.75. Illustration 5. A very simple question, nothing is there here. So Mr. A has provided the following information. Okay, you need to compute what is the deduction which is available under Section 35 while computing his income under PGBP, under default tax regime, and under normal provision. Understand one thing. Okay, there are few situations wherein you will not get any deductions under Section 115 BAC. Section 35 subsection 1 clause 2, Section 35 subsection 1 clause 2A, clause 3, Section 35 subsection 2AA. These four sections which you can see, you will not get any scientific research contribution whatever you are made under which is eligible under this section. Under Section 115 BAC, you will not get any deduction. You will not get what? You will not get any deduction. Please remember this. If you want this material, particular material which you're seeing, you can get that in Telegram channel. It's available. Okay. So amount paid to notified approved Indian Institute of Science Bangalore for scientific research 1 lakh. IIT approves scientific research program 2,50,000. Amount paid to X Limited, the company registered in India, which has a main objective as its scientific research and development, 4 lakh. Expenditure incurred on in-house scientific research, it's revenue expenditure and capital expenditure is given. So now first you need to identify which section these things falls under. Okay. For Indian Institute of Science, it falls under Section 35 subsection 1 clause 2. Tell me whether it is available under Section 115 BAC. 35 1 subsection 2 is not there. 2 AA is not there. 2 clause A is not there. Clause 3 is also not there. So whatever contribution you have made, you will not get any deductions for this. Amount of deduction eligible is nil. Even though you have made the payments, even though you have made contribution out of your pockets, you have paid out of your generosity, but there is no deduction available for whatever the generosity expenses which you have made over here. However, for expenditure incurred in in-house research is available for 115 PAC also, 3 lakh and 2 lakh 50,000, which comes under this respective section allowed under default tax regime. Yes, you can get it. Clear? If you're shifting out of default tax regime, or everything is available, whatever you pay 100 rupees, I'll get a deduction of 100. You pay 200 rupees, I'll give you a deduction of 200. You pay 1000 rupees, I'll give you a deduction of 1000. Or whatever you pay, I'll give. That is what the government is stating. Okay, we'll accept that. Deduction allowable under section is 35. 35 is 13 lakh. Okay. Illustration 6. A very good question. So please concentrate. Mr. A commenced operations of the business of setting up of a warehousing facility for storage of food grains, sugar and edible oil on 1/4/2025. He incurred capital expenditure of 80 lakh. Remember, what is the capital expenditure? 80 lakh for food grains, 60 for sugar, and 50 for edible oil. Remember, that is how the point flows. Respectively, on purchase of land and building during January, March. January to March. Okay. The cost of land. The cost of land included 50 lakh, 40 lakh, and 30 lakh respectively. So 50 lakh towards the food grains, 40 lakhs towards the sugar, 30 lakhs towards the edible oil. Okay. And during the financial year 2025-26, he incurred capital expenditure of rupees 20 lakh, 15 and again he incurred a capital expenditure. This is for respective food grains, sugar and edible oil. Clear? Respectively for extension of the business used exclusively for what? What have they asked you? They have asked you to calculate the PGBP income, assuming is shifting out of default tax regime and is claiming deduction under section 35AD, right? And the profits of the business warehousing for that matter, profits is 16, 14 and 31, which becomes important. 16 for food grains, 14 for sugar and 31 for edible oil. If you can understand one thing under section provided over here, under section 35 AD, you will get 100% of the capital expenditure has deduction being the first point. But you will not get for land. Second point. Capital expenditure 100% deduction is available except land. It means land is not allowed as capital expenditure 100% deduction. You will not get depreciation also. Leave that. Then what is getting covered under the warehousing facility is that the storage of food, food grains, agricultural produce is included. Storage and this warehousing of sugar is also considered under section 35 AD. But edible oil is a processed oil. It is not a natural agricultural product. It is processed. So edible oil is not getting covered under section 35 AD eligible investments or eligible business. Okay. So now these two, food grains and sugars, these two are considered as the warehousing where you can enjoy the section 35 AD deductions. This you have to calculate as per the normal business. Clear? That is what this entire question segregation is about. You have the profits given in the question, that is 16, 14 and 30. Right? So under section. Now what is the deduction that you are going to take is that we already know for food grains how much is the cost, 80. How much is the land cost of land for this is 50. So what is the eligible? So what is the eligible deduction that you can take is only 30 for food grains. 60 is for sugar. 40 is the land. 20 is the deduction that you can claim for capital expenditure on this point. Right? And again, the capital expenditure, additional capital expenditure incurred is 20 and 15 over here in the respective case. So now you have the total capital expenditure which is available as deduction. Now what you will do is that 50 minus 16 if you do, you will get a loss of 34. What did you do? 50 minus 16. We'll do it in a way it is given in the question. 16 minus 50, you will get negative 34. 14 minus 35, you will get negative 21. This is nothing but the total. That's it, nothing else. Okay. This is nothing but the total. So this is the calculation that you would do for your specified business. However, for your business other than the specified business, edible business, edible oil business, so 31 you take, you will not get any capital expenditure deduction over here. However, you will get the uh, depreciation under section 32. So can I say 50 is your total value which is over there given in the question. Minus 30 is the cost of land. Will you get depreciation for land? Govinda, you will not get any depreciation for land either in your books of accounts or in your income tax. There's no depreciation allowed on land. There is no depreciation allowed on land. Please. 50 minus 30. You will get 20. 20 plus the additional capital expenditure incurred is 10. So 30 lakh multiplied by 10% for building being concerned, you'll get the depreciation of 3. So how much is the profits that you are going to get from your non-specified businesses? 28. A very good question. Practice. And you should make sure that you're writing whatever the understanding you're having, you should write in the form of working. Mr. Suraj, a proprietor, commenced operations of the business of 3-star hotel Illustration 7 is what we are speaking about now. Now, he incurred capital expenditure of 50 lakh during the period January 25 to March 25 exclusively for the above business. Capitalized the same in the books of accounts as on 1st April 2025. Further, during the financial year 2025-26, he incurred capital expenditure of 2 crores, out of which 1.5 crore was for acquisition of land exclusively for the above business. Compute the income under the PGBP for EY 26-27, assuming that he has fulfilled all the conditions specified under Section 35AD, opting for claiming deductions under Section 35AD and all the other things. What is the business is getting, what is the profits is getting from running this hotel, this 25 lakh. From running an existing hotel at a Coimbatore is earning 120 lakhs. Okay. So now if you can see, incurred capital expenditure of 50, which he capitalized in the books, plus he incurred 2 crores, out of which 1.5 crore was for acquisition of land. So out of 2 crores, 1.5 is not allowed. Remaining 50 lakh is allowed, no? For the purpose of capital expenditure deduction. 50 lakh on one side, 50 lakh on another side. Total is, and you have the profits, which is already given in the question. Profit is 25. Minus less the deduction under section 35 AD itself is 100. So you are getting a negative loss from specified business 100. Loss from one specified business can be set it off against the profit from another specified business. So what you will do, 120 lakh minus 75 lakh, remaining 45 lakh will be considered as your income. Okay, this is your illustration. Illustration 8. See, this question is bit different. Okay, what it's stating is that provision is very simple. If you're transferring a unit, suppose let's consider specified business, you have taken an asset A, machinery A, and you have claimed 100% of the deduction. But 10 lakh was your cost of that asset. Entire 10 lakh you have claimed it as deduction in this year. And if you want that 10 lakh to be claimed as a deduction, you should make sure that you have to keep it for 8 AY. You have to keep it for how many years? 8 AY. 8 years. You have to keep that asset in your business so that you can claim 100% of the deduction. Suppose if you transfer that asset after 8 years, then you need not do anything. There is no problem for you for the purpose of reversal amount. What if you transfer it before 8 years? Then you have to pay the tax considering it as an income with a certain the picture. Okay. What is the provision? What is the provision that I told? Very simple. There is a scientific research asset. You have transferred it before 8 years. 8 years is the minimum period that you need to hold. You did not hold it for 8 years. You transferred it and you transferred in the mid of this 8 year. Now you have to pay the tax keeping the deemed income provision in picture under section 3587. How do you do that? We'll see here. This fellow is a proprietor. He has two units. Unit A, specified business, where is warehousing sugar. Unit B, non-specified business. Very well. Unit A commenced operation on 1/4 and it claimed deduction of entire 100 lakh on purchase of two buildings for 50 lakh each. Okay, for warehousing of sugar under section 35. However, in February 2026, that is in the next year, next PY, this is for PY 24-25, they had no problem. Happy life. Very well. So this is going to be 26. This is going for PY 25-26. This transfer is happening. Unit A transferred one of its building. Another building is still staying with him. Only this 50 lakh worth of one asset is being sold. Sorry, it is being transferred to Unit B. Now, what is the tax implication? Is that try to understand. Point 1. Suppose if I wouldn't have claimed the deduction, I would have definitely claimed the depreciation. No. So for 50 lakh, if I would have claimed the depreciation, it would have been 10%. So minus 45 lakh would have been my closing WDV as on 31st March 2025. Last year's WDV, that is nothing but last year closing WDV, nothing but my opening WDV I'm speaking about. Okay. For 1 year, I would have claimed a depreciation. I would have got 45 lakh as my opening balance or the closing balance of the last year. You will consider that for the purpose of your calculation to call it as a deemed income. I'll repeat. How much is the deduction that you have claimed? Suppose if you have not claimed the deduction, you would have definitely claimed the depreciation. After claiming the depreciation, what would have been your actual value of that asset? 45 lakh would have been your actual value of that asset. No, you have already claimed this as a deduction. Suppose let's understand this with a simple numbers first. Okay, let's consider 100. 100 was the cost of asset. Sorry, 100 is your profit. This is in year PY 24-25. Just an example for your clear understanding. For PY 24-25, you had the profit of 100. You had an asset of 50, wherein you have claimed the entire amount as deduction in this year under section 35 AD. You have claimed the deduction. How much would have been your profit? Your profit would have been 50, close. Your point would have been closed. No problem at all. In next year, what happened in PY 25-26? You did not keep it for 8 assessment years. You sold it before 8 assessment years. Now, whatever this deduction which was allowed to you, now it shouldn't be allowed. Now you have to add back it as an income, because just imagine there was no deduction which was available. There was no 35 AD deduction which is available for you. Okay. This is not available. So what would have been your profit? Your profit would have been entire 100 if you understand something, right? Your profit would have been entire 100. It would not only be 50. Because now the profit has been decreased to the extent you are now supposed to add some amount into the next year, because you did not pay the tax for the profit of the last year, right? There was, if there was no 34 or 35 AD, you would have paid you would have paid 100. Because it has there is 35 AD, you are now paying only for 50 in the last year by taking the advantage of this 8 assessment year. Now you paid it, you did not comply with the provision. Now you will end up paying the tax for something which you haven't paid the tax for the last year. That profit you did not pay in the last year. This year you will end up paying tax. I hope you have understood. Now let's understand the situation. There was no 35 AD, but however, you would have had section 32. So can I say this 50 into 10%, you would have definitely got, whatever the worst situation is, that you would have definitely got 5 as your deduction, 95 would have been your profit. So now whatever you have paid earlier 50. Now whatever, this is what your tax for which, the profit for which you would have paid the tax for 95. Because of 35, you have paid the tax for only for 50. Whatever the difference between this is nothing but 45, right? This 45 is something which you are adding in PY 25-26 along with your profit and paying the tax for entire 145. I hope you have understood this. Clear? And how do you do this 145 calculation? Just a number, just for the purpose of number, I have taken this. Now come back to the provision. Now come back to the provision. Okay. Whatever is the 50 for which you have already taken the deduction in PY 24-25. Okay. So now this 5 is something which you have already, you would have already taken in PY 25-25 no matter what. Your balance is 45. This is the amount for which you would be paying the tax in the PY 25-26, nothing but AY 25-26-27. Okay. Whatever is the closing balance of the previous year that you would have considered becomes your actual cost of asset, and actual cost of asset for the purpose of unit B in the hands of Mr. R for unit B would be 45 lakh. It will not be 50 lakh, because 10% depreciation you would have already given. No, it's only 45 lakh. This is your illustration 8. Illustration 9. Delta Limited credited the following amounts to the resident payee for that matter. Basically, what are they asking is that what would be the consequences of non-deductions by Delta Limited? They have made two transactions here. That is, one, they have paid salary to its employees. They have paid salary to its employees, and Mr. X credited and paid in March 14 lakh rupees. Director's remuneration credited in March 2026 and paid in April 2026, 28,000. Would your answer change if your Delta Limited has deducted tax on director's remuneration in April 26 at the time of payment, remitted the same in July 2026? Okay. So what have they asked? They have asked you what would be the tax consequences if they wouldn't have deducted the tax in these two situations. This is second situation. We'll come to it later. Okay. See, if there is no deduction of tax, basically section 192, the salary deduction comes under section 192, TDS to be supposed to be deducted. And the director's remuneration that need to be supposed to be deducted is under section 194G. Okay. This would attract the disallowance at the rate of 30%. Section 192 and Section 194J would attract the disallowance at the rate of how much? 30%. That is, if you haven't deducted the TDS, but you paid the amount, you made the payment, 30% is the disallowance that is going to be disallowed for you. And in both the situations, what would have happened? 14 lakh into 30% disallowance. 4 lakh 20,000 would have been disallowed. And in director's remuneration case also, 28,000. Amount that is supposed to be paid is 28,000. And this 28,000 into 30%. Remember, under section 194J, the limit for the other payments which you are making, that is the fees for professional payment, fees for technical services, royalty, and the non-compete fees which you are making. If that single transaction payment is less than 50,000, now the limit has been increased, threshold limit has been increased. If it is less than 50,000, you are not supposed to deduct any TDS. But here, this is in the case of director's remuneration, even if you have paid single rupee to the directors as a director's remuneration for that matter, you have paid single rupee to the director for that matter, the TDS has to be deducted. So in this case, 28,000 TDS has not been deducted, 30% of the amount has been disallowed. Suppose if the tax is deducted on director's remuneration in the next year, that is in PY 26-27, at the time of payment and remitted it to the government, the amount of 8,400 would be allowed as deduction while computing the income of business income for AY 27 and 28. Whichever year that you have deducted and you have paid. See, you did not deduct only, you deducted in April and you paid it in July for that matter. That would have been allowed. The amount of 8,500 would be allowed in the year in which the amount was deducted, and it would be considered while computing the business income for 27 and 28 AY in the next year. Illustration 10. During the previous year, there is a individual, that is resident individual, Mr. Raja, and during the year ended 31st March 2025 was 99 lakh was his turnover basically. Okay. He paid interest of 45,000 to Mr. Rahman and Co. Without the TDS deduction. He paid 15 lakh rupees as salary to a resident individual without TDS. He paid 26,000 as a commission to Mr. Vidyasagar without the TDS. Okay, this is the situations. Now you need to discuss about the whether it would be allowed or not allowed, to what extent it will be allowed, to what extent it is not allowed. Very, very simple question. See, the section interest that you are supposed to pay over here, that comes under section 194A. That is the other interest payment we are making. Whenever you're deducting the interest, whenever you are making the payment of interest, you're supposed to deduct the TDS provided you are a resident individual wherein your turnover is exceeding 1 crore. Your turnover is not exceeding 1 crore. No. So there is no provision. The provision of TDS applicability will not be liable for you. That is you are non applicable category. Basically, the TDS is not applicable at all here in simple sense. TDS is not applicable for you, is not liable to deduct the TDS. However, whenever you are making the salary payment under section 192, okay, whosoever is making the payment of salary, that section under section 192, without whether your turnover is greater than 1 crore or less than, no matter what, you have to deduct the TDS no matter what. In this case, you have not deducted the TDS, so 30% of such amount of 15 lakh into 30% amount would be considered as disallowed. Commission of 26,000 was paid to Mr. Vidyasagar for that matter. Commission under section 194H is supposed to be deducted if the commission amount is in excess of 20,000. However, in order that this section to be applicable for you, you should be an individual who's having a turnover in the preceding PY greater than 1 crore, exceeding 1 crore. Your income is not exceeding, your turnover is not exceeding 1 crore, so you're not liable to deduct any TDS in this case. Okay, a simple question. This is very, very simple question, just a one-time seeing question only. Okay, illustration 11. The firm had paid 8,50,000 as remuneration to its partner for PY 25-26 in accordance with partnership deed. It has a book profit of 10 lakh. What is the remuneration allowable as deduction? Very simple. 8,50,000. 8,50,000 is the remuneration paid. Book profit they themselves has given 10 lakh. So 6 lakh, 90% is what you will take, and on the balance you will take 60%. 7 lakh 80,000 is the maximum remuneration that you can give. But however, you've already paid 8,50,000. So what you will do, you will restrict it to 7,80,000. If you have already deducted 8,50,000 minus 7,80,000, the difference of 70,000 would be considered as disallowed. Okay, not an important question, just one time seeing question. Illustration 12. See, there's a partnership firm, Rao and Jane. Two partners are there. Net profit is 17 lakh before giving the deduction. Salary 40,000 each partner is taking. Rao is also taking, Jane is also taking. Partnership depreciation of the plant and machinery is 32. Under section 32 is 1,50,000. Interest on capital at the rate of 15% per annum, and the amount of capital gain eligible for interest is 5 lakh. Book profit of the firm under section 40B of the Income Tax Act 1961. Allowable working partner salary for AY 26-27. You are supposed to calculate. Okay, you're supposed to calculate book profit and what is the working partner salary which is available. What is the allowable salary as per income tax? Okay, so first of all, 17 lakh will be my starting point for my consideration. However, we know depreciation we are going to deduct no matter what. And what is the allowable depreciation? Sorry, allowable interest that is eligible for deduction? 12%. So 12% on 5 lakh. 5 lakh into 12% would be 60,000. So 1,50,000 and 60,000 you are deducting. 2,10,000 will be the point. Why you are not considering 15% here? Array, 12% is something. It might be 15% as per the deeds, but as per income tax, it's only 12% which is allowed, right? 12%. So you are going to take 12% here, 2,10,000. Book profit is how much? 14,90,000. The salary actually paid to the partners over year is 40,000 is what been paid. You have seen in the question. Two partners into 12 months, 9,60,000 close. On the first 6 lakh, you're supposed to pay 90%. On the second next balance, you're supposed to pay 60%. You do the similar calculation. How much is it? 14,90,000. No. First 6 lakh you will take here. The remaining balance you will take here. On that you will calculate 60%. You will get 10,74,000 is the allowable salary as per the income tax. But what is that they have already paid? 9,60,000, which is less than the allowable depreciation. Sorry, allowable remuneration amount. Hence, you are going to consider 9,60,000 as the allowable working partner's remuneration. Okay. Illustration 13. Ex Limited contributed 20% of basic salary to the account of each employee under a pension scheme referred in section 80CCD. DA is 40% and basic salary, which is forming part of the employees. What are you supposed to calculate? Deduction which is available under section 36, subsection 1, clause 4A. If the basic salary of employee aggregate is 10 lakh, what amount of disallowance would be extracted and to what extent? See, here you have to keep in mind one small point. Is the deduction or the eligibility deduction given for the contribution which is made? Obviously, yes, it is made. How much is the contribution? Permissible contribution made is only 14%. Deduction, permissible deduction is how much? 14%. Just remember that. Okay. First of all, he has made contribution for the section 80CCD. Employer has made a contribution and employee has contributed. Ex Limited contributed 20% of basic salary. What is the basic salary given in the question? 10 lakh. So, what is the actual contribution? 10 lakh into 20% flows. Okay. What is the allowable deduction that is as per the Income Tax Act? It is going to be 14% of basic plus DA in terms, right? Basic plus DA in terms. What is the basic here? 10 lakh. What is the DA, which is forming part of the salary, retirement benefits? 4 lakh. So the total salary for the definition for the purpose of this section is 14 lakh. 14 lakh into 14%. This is what actually allowed under income tax for the purpose of deduction. What you have paid is more than 1,96,000. So to the extent of 4,000 is something considered as disallowance. Clear? Hari, an individual carried on the business of purchase and the sale of agricultural commodities, basically has not paid the interest for this Andhra Pradesh State Financial Corporations and this Indian Bank. He has not paid for these two, okay, basically. So Andhra Pradesh State Financial Corporations and Indian Bank over here, both APSFC and Indian Bank, while restructuring the loan facility of Ari during the year 25-26, they converted this above interest wherein this fellow had defaulted. I'll tell you the story what has happened. This fellow Hari, he had taken loan from Andhra Pradesh this bank and Indian Bank. He did not pay the interest. How much is the interest accumulated? So much. Now he went to bank, approached the bank, and he told, please restructure and convert this into 60 equal installments. Okay, now every month, how much am I supposed to pay? This divided by 60, this divided by 60. Whatever amount you will get, that will be paid every month. How much this fellow has paid? Hari paid 5 installments of this. He paid 5 installments for this, and this he paid 3 installments for this. Okay. Hari claimed, and this fellow, after restructuring, happily went and claimed the deduction of entire 45 lakh. Is it correct or wrong? Obviously wrong, no. 45 lakh is not something you can take it as per section 43B. Only the interest which is actually paid before the 139(1) due date is something which is allowed. So how much will be allowed? 15 lakh divided by 60. Into how many EMIs he have paid? How many installments he have paid? 5. 30 lakh divided by 60. Into how many he has paid? 3. So that is what the calculation you will be doing. The total eligible amount of deduction is how much? 2,75,000. Okay. Illustration 50. This fellow Vinod is carrying on for a profession as a film artist. His gross receipts from the profession are as under particulars. Financial year 2022-23, financial year 23-24, 24-25, 1,15,000, 1,80,000, 2,10,000. What is his obligations regarding the maintenance of books of accounts for the AY 26-27 with section 44AA? See, section 44AA states very simple thing. If you are a notified professional, you are supposed to keep certain maintain specific books of accounts provided your gross receipts in all the 3 years. In all the 3 years, remember, gross receipts in all the 3 years for that matter, immediately preceding the previous year, has exceeded how much? 1,50,000, right? And if it is new profession which has been set up, then 1,50,000 in that respective previous year. This is applicable for all the 3 years. Its gross receipt should have exceeded how much? 1,50,000. You can see over here only. Here is it exceeded? Yes. Here is it exceeded? Yes. Whether here it is exceeded? No, it is not exceeded here. So what will I do? Is this section 44AA applicable for me? The section itself is not applicable for him. So required to maintain such books of accounts wherein the assessing officer can say, okay, I can compute his total income for that matter. That is what you're supposed to do. Okay. Illustration 60. Mr. Praveen, engaged in retail trades, reports a turnover of 2 lakh 9 sorry 2 crore 98 lakh 50,000. Basically, it has exceeded 2 crore in the financial year 25-26. Amount received in cash during PY 25-26 is 14 lakh. He has received how much in cash? 14 lakh. And the balance through electronic modes. Very well. His income from the said business as per the books of accounts is 15 lakh. So much is my PGBP income. Retail trade is the only source of income for Mr. Praveen AY 25-26 was the first year for which he declared his business income in accordance with the provisions of presumptive taxation under section 44 AD. Is Mr. Praveen also eligible for presumptive determination of his income chargeable to tax for AY 26-27? If so, presumptive taxation, can he take it? And what are the other questions? We'll go one by one. What is the facts of this question? Very simple. He has a turnover of 2 crore 98 lakh 50,000. Okay. He has received so much in cash. And he has said business income Its income from the said business is only 15 lakh. Now we are supposed to calculate the computed as per the PGBP. It was 15 lakh. Now what is it as asked? This fellow, Mr. Praveen, is also eligible. Is he also eligible for presumptive taxation? For that matter, you need to check the condition. See, for presumptive taxation, first of all, your business income should not be exceeding 2 crore, but you have a catch over there. If your turnover, cash receipts from your total receipts is up to 5%, then your 2 crore limit can be extended to 3 crore. Now, please do the calculation. 14 lakh is what you have received. You divide it by 2 crore 98 lakh 50,000 into 100. How much will you get? You will get approximately some 4.69% is what you will get from here, right? This 4.69 is less than 5% only, no? So it means 2 crore can be extended to 3 crore and is eligible for presumptive taxation. If so, determine his income from retail trade as per the applicable presumptive provision. You guys only can tell me how much is it? 2 crore 98 lakh 50,000 is there. 2 crore 98 lakh 50,000 is there. Out of that, 14 lakh is your cash transaction. No, so cash transaction it is 8%. Apart from the cash transaction, it is 6%. How did you get this 2 lakh 2 crore 98 year from? It is 2 crore 98 lakh 50,000 minus 14 lakh which you have already taken. Uh, 1 minute, there is some issue here. Minus 14 lakh. This is leading to 2 crore 84 lakh. 2 crore 84 lakh 50,000 at 6%. Clear? Done. So the next. In case Mr. Praveen wants to declare profits as per books of accounts from retail trade, what are his obligations under the Income Tax Act 1961? In case Mr. Praveen wants to declare as per the normal profits and loss for that matter. See, if you can consider here, how much is the presumptive taxation income that is coming up to 18 lakh 19,000, right? But here, how much is the income that is coming under as per the books of accounts? 15 lakh. So it is less than the presumptive taxation for that matter. First of all, try to understand if he has already opted for presumptive taxation earlier year. Okay, if he wants to now in this year, if he wants to declare the profits as per the books of accounts, which is lower than the presumptive taxation for that matter, then for next 5 assessment year, from the year in which he is declaring his income as per books of accounts, right from that year to the 5 assessment year, he can't opt in for presumptive taxation. He should continue with the normal provisions only. Only after 5 years completion, he can come and opt for the presumptive taxation. See, so many years. And he would not be eligible to claim the benefit of the presumptive taxation from the basically from the next assessment year, that is from AY 25 20 27 28 to AY 31 32, and is also required to maintain the books of accounts and get the books of accounts audited from the auditor under section 44 AB since his income exceeds the basic exemption limit. Clear? What is the due date for filing the return of income under both the options? If he's opting for the presumptive taxation, the due date is 31st July, like a normal individual. If he's opting for books of accounts, he has to get his books of accounts audited. So in that case, his due date will be 31st of October 2026. Okay, great. Next question. Mr. X, illustration 70. Mr. X commenced the business of books, operating goods vehicle on 1/4/2025. He purchased the following vehicles during the PY 25-26. Compute his income under section 44 AE for AY 26-27. Now, gross vehicle weight, number is given and date of purchase given. Based on the date of purchase, won't you be able to identify how many number of months? Even a single day in a 1 month would be considered as one entire month for the purpose of calculation. Count should be taken. See, would your answer change if the goods purchased in April were put to use only in July? We'll come to it later. First, we'll do the calculation. See, date of purchase is given, and based on the date of purchase, number of vehicles is also allotted. So you can do the simple calculation here. Take this right here, number of vehicles, number of months for which the vehicle is being owned. You do the calculation. No, consider from 8, 8, 9, 10, 11, 12. 1, 2, 3. It is going to be 8 months. Two vehicles, 8 months. How much is for the small vehicles over here? It is going to be how much? 7,500 per month. Here they have taken total. Here you could have done another column, 7,500 per month. So you could have multiplied 7,500 into, you could have directly done this calculation also. That would have been also fine. 7,500 into 2 into 8. You could have done this directly instead of writing this column. Anything your wish. If you want to write like this, you can write. Otherwise, you can write one total column and write the total. Ultimately, your answer should be 2 lakh 6,82,500. Similarly, you will do for the others also. Right? Now, and oh, I'm sorry. I'm sorry. This is for heavy goods vehicle. No, I'm totally sorry about this. This is for heavy goods vehicle. So it is going to be multiplied by per ton. Per ton it is 1000. This is for per vehicle. It is going to be 7,500. 7,500 per month. Okay. I'm sorry about the earlier point. This is the actual provision. So you multiply by 1 ton. How many tons this vehicle has is 15 tons. So your calculation ideally would be 1000 per ton into 15 tons into two vehicles into 8 months. This is how your calculation would be. Okay, here also similar. 1000 per ton into 15 tons into one vehicle into 2 months. Okay, here also the similar calculation goes. 7,500 per month multiplied by 12. How many months here? 12 months into two vehicles. Similarly, you will do the similar calculation here and you will get the final answer. Clear? A simple question, not complicated at all. The last question, which is very easier, you just need to know what is the apportionment here, right? So, Miss Vivita, a resident and an ordinary resident in India, she owned the following plantations and estates. Income from sale of centrifuge latex rubber from rubber plants grown in Darjeeling. So rubber plants, we know it is 35 and 65%. 35 is business income, 65 is agricultural income. Based on that, you are going to do the division. Business income is so much and the remaining 65% is agricultural income. Income from sale of coffee grown and curd in Yardcourt is 25 and 75. If it is sale grown curd or roasted and grounded in India for that matter, it would have been 40 and 60. 40 is business income, 60 is agricultural income. Here also it is sold, roasted, grounded in Colombo. It is not in India, it is in Sri Lanka. Sale consideration is received in India, fine, but it is not that in order to get that exemption, that agriculture activity should be happened in India, no? So this has not happened in India. So there is no 35, 25, no divisions at all, 40, nothing division, no divisions at all. It is 2,50,000. Entire amount is going to be taxable. Income from sale of tea grown and manufactured in Shimla. So it's going to be 40 and 60% over here. Income from sapling and seeding grown in nursery at Cochin. Basic operations were not carried on by our land. There is a point which is given in income tax wherein as per this section 2 subsection 1a explanation given in 3, it provides that whatever the income which is derived from that seedlings or saplings wherein it has been taken place in nursery, it would be deemed to be an agricultural income, even though there is no basic operations that has been carried on. Hence, based on that point, which is given by income tax exception for that matter, entire 80,000 would be considered as your agricultural income. There is no business income over here. Clear? So, this is your illustration 18, and this is all the questions covered from your PGBP chapter. Test your knowledge. Question number 1 from the chapter Capital Gains. Mr. Mithun purchased 100 equity shares of Good Money Co Limited on 1/4/2007 at the rate of 1,000 per share in public issue of the company by paying securities transaction tax. Company allotted the bonus share in the ratio of 1:1 on 1/12/2024 and he received the dividend of rupees 10 per share on 1/5/2025. That is during the period 25-26 PY only. Okay. He has sold all the shares on 1/10/2025 at the rate of 4,000 per share through a Recognized stock exchange, he paid the brokerage also 1% and STT also 0.02%. Compute his total income and tax liability for AY 26-27. If this fellow opts out of the default tax regime, that is, he doesn't opt for default tax regime, he's opting for normal provision. Assuming that is having other income of rupees 8, like he has some other income also, and the fair market value of each share of Good Money Co Limited as on 31/1/2018 is 2000. Okay, see what is it that they are trying to ask, that is trying to convey over here is, what is that you need to do here is, you need to find the total income and tax liability also you need to calculate. The major calculation goes with the capital gain calculations only. Okay. Here there is a one small point, that is other income information is given, but that's totally fine. We are going to solve the question. So if you observe something, this fellow purchased 100 equity shares on 1/4/2007 and is selling on what? All the shares is selling on 2025. So whatever this category comes under, this category comes under the long-term capital asset, right? How do you determine the long-term and short-term capital asset as? If the asset, that is listed equity shares held for a period more than 12 months, long-term, less than or equal to 12 months, short-term. The company also allotted the bonus shares in the ratio of 1:1. Okay, earlier how many shares were there? 100 shares. How many shares they issued? 100 shares. So the bonus shares which are issued is how much? 100 shares. He also received 100 rupees per share on 1/5/2025. When did he receive the bonus shares? He received it in PY 24-25, right? That is on 1/12/2024. If you can observe something, he has received the bonus shares and dividend over year. He sold all the shares, that is, he had purchased 100 and the bonus shares issued were 100. So total of 200 shares were sold on 1/10/2025. Out of this 200, 100 is long term. And if you can observe the bonus shares which have been received, it is on 1/12/2024. It is sold on 1/10/2025. Can I say it is within the period of 12 months? You have held that asset, you have held this equity shares for a period less than 12 months. So it is going to be treated as short term. Okay, this 100 is going to be treated as short term. Clear? Great. And now you have classified 100 as 100 as long term and 100 as short term. Here you have received the dividend of rupees 10 for how many shares? For 100 or 200? Obviously it's 200, because when have you received this dividend? On 1/5/2025. As on 1/5/2025, you had 100 plus 100 of bonus. So 200 shares into 10 rupees, that is 2000 rupees you would have received as what? Dividend. Great. Now, at what price these shares have been sold? 4,000 per share. See, rich party selling it at 4,000, you have just purchased it at 1,000. Very well. So 4,000 rupees per share you are selling, that is 200 shares also you are selling. That becomes your revenue. You are going to categorize this into long term and short term over here. Okay. Always remember, brokerage paid becomes a part of expenses, and securities transaction tax paid, it is not allowed in your capital gains as your expenses, right? STT paid is not allowed as your expenses in your capital gains. Remember. See now, gross sale consideration. Now we are categorizing this into two parts. That is one for long term and one for short term. So this is for long term, 100 shares. 100 shares into 4,000 rupees is the sale price. So 4 lakh is your whatever the consideration you are getting. Brokerage at the rate of 1%. Here we've already mentioned here. See, brokerage is paid at the rate of 1% on whatever the sale price is. So 4 lakh into 1% is 4,000. You have deducted, you got net sale consideration. If you can observe something, higher of the following net sale consideration you have now, in order to categorize or find what is your cost of acquisition, the cost of acquisition you can find it through the two phases, that is, which is the higher of the following. The one phase is the actual cost of acquisition, the other one is lower of fair market value as on 31/1/2020 18 or actual sale consideration. There's a reason behind why it is being categorized as higher of the following. Okay, try to understand one thing. What is your actual cost of acquisition? Here is 1 lakh. Okay, the money which moved out of your pocket is how much? 1 lakh. Then you have these two as lower of the following, that is fair market value as on 31/1/2018. See, why is it the case of 31st March 2018 only is that, see, prior to 31/1/2018, This is the budget of which was announced on 1st Feb 2018. Because of that effect, the date of 31st, one day prior to that, the budget date is what being announced. See, I'll tell you very simple reason why. Earlier, that is prior to 31 1 2018, there was no tax for the long term capital gain. That is, how much ever capital gain you get from the long term capital gain, how much ever long term capital gain which you get from the sale of equity shares, it was completely tax exempted. Means there would be no taxable at all. Now it is not the case. Now the situation has been different. They told on 1 to 2018, they came up with a provision stating that year afterwards, we are making sure that long term capital gain, whatever you get, it will become taxable. Now, all the investors started crying because they told, Array, this whatever the effect which you have told, because of this, now we are ending up paying tax. Earlier, just prior, one day prior to your the budget announcement, if I would have sold it, I wouldn't even pay single rupee capital gain. Even if I got 1 crore also, I wouldn't have paid anything. Now, on 1 to 2018, you are coming and announcing that we are going to make the capital gain taxable. Obviously, I'll cry. So, the government told, don't cry. We'll do one thing. So, let's take a simple situation. Okay. Let's consider your actual cost of acquisition is 100. Okay. Let's try to understand this scenario. Okay. No, different page. Let's do that. Let's have a good understanding. Okay. See, try to understand this point which I explain over here. Okay. Let's assume the actual cost of acquisition is your sale consideration is 250. Just an example. The actual cost of acquisition was 100. Just an example I'm telling you. Lower of the following. As on the date you had been holding from 2007, and the fair market value as on 1 2018 is 120. Suppose. Okay. What is your actual sale consideration is 250. So now what you will do is that you will consider lower of the following. Lower of the following is 120, right? Now you will take this as a further classification as 120 here, and higher of the following 120 or 100. 120 you will consider, and you will say the remaining amount of 130 is going to be taxable. Why did you determine this 120 over here as your cost of acquisition? Is because lower of this following, that is 120, higher of the following, that is here also, higher of these two is 120, and you considered here as your cost of acquisition. Now try to take a different situation. Okay, your actual cost of acquisition is 100. Fair market value as on 31 1 2018 is, let's consider it as 80, and here it is how much? 250. Actual sale consideration is going to be same, right? 250. So now lower of the following. What is this lower of the following here? 80. You'll take the 80 as a outer in the outer bracket. 80 or 100, whichever is lower. Sorry, whichever is higher, you will consider 80. Sorry, you'll consider here 100. So 250 minus 100, 150 will become taxable. If you observe something very carefully here, think in your perspective. Okay, you have the shares in 2018. Now think what will happen. If I would have sold my share as on 31 1 2018 only, in the first situation, I would have sold it at fair market value. At what price would I would have sold? At fair market value only, right? So I would have sold at 120. So can I say up till 120 rupees being your consideration, you wouldn't even have paid single rupee capital gain tax, right? You wouldn't even have paid single rupee capital gain. Now, up to 120, though I'll not pay. Okay, 120 I've considered. But my actual sale consideration is higher. Can I say my sale consideration moved from 120 to 250 after 31 1 2018? That is after the act has been passed. That is the long term capital gain is now being taxable. This increase in the value has happened post 2018. So, for which you are supposed to pay the capital gain tax now. 120, you will not pay anything. So you will consider lower of the following will be considered as your cost of acquisition in the outer column. 120 you have taken. The actual cost of acquisition will be how much? 100 or 120, whichever is higher. So now you are stating up to 120, so I am not going to pay any, that is long term capital tax I will not pay. In this situation, higher of the following, you are taking 120 crores. Okay, come to second situation. You are telling my fair market value as on 31/1/2018 was 80. It means up till 80, I wouldn't even have paid single rupee capital gain tax. Very well, you have taken. But now this situation is little different because your actual cost of acquisition is 100. It means you paid out of your pockets 100, which is going to be, which is much more higher than what you were supposed to pay the tax for. For so much amount, you wouldn't pay any tax, right? But what you paid out of your pocket was more than the sale consideration at that point of time. You had some loss. The shares was some problem. It was a problematic share. So you were not able to, your share fell down as on 31/1/2018. And so that is the reason it is 80. But however, the cost of acquisition is how much? 100. Hence the reason you've already paid out of your pocket, which is 100. Hence we are going to take whichever is higher. I hope you have understood now why we will take whichever is lower here and whichever is higher. Whichever is lower, because as on fair market value 31/1/2018 or the actual sale consideration which you have now, least of the following two you are not going to pay any tax for. Okay, you're not going to pay any tax for. Lower of the following, whatever is the lower, 120. Actual cost of acquisition means here in this is the worst case situation that has happened, but I've already paid something more than this worst case situation here. I paid something out of my pocket 100. So it is very much fair for government to give me at least what I have paid out of my pocket as the cost of acquisition. Clear? That is the reason. See, we'll take one last situation here. Instead of the sale consideration is 250, we'll make the sale consideration as some 70. Okay. We'll make the sale consideration as 70. And the fair market value is 80. Least of the following. So how much will you consider now? 70 in the outer column. But your actual sale consideration, but your actual acquisition was only 100. So I myself paid out of my pocket 100 because the market did not perform. My actual sale consideration now is 70. Earlier the fair market value was 80. I will get least of the following as my cost of acquisition deduction. How much is it going to be? Lower of the following, that is 70. Higher of the following, that is 100. I will get 100 here. 30 is my loss. To this extent of 30, I will get long-term capital loss. I hope you have understood. The loss situation, you will end up with the loss situation only when your actual cost of acquisition is more than your sales revenue. That is whatever the sale that you are doing in for. Because you already paid out of your pocket, actual money moved out of your pocket is 100. The money which you are getting now because of there is a market crash or something, it's only 70. So that 30 is the capital loss you will get and you will carry it for. Clear? I hope this is clear. Based on the same understanding, let's try to solve this question. Okay. See, now the actual cost of acquisition in this is 100 shares into 1000, that is 1 lakh. Okay. As on 31/1/2018, it's already given in the question that it is 2000. 2000 into 100 shares. Right? Cool. Actual cost of acquisition, actual sale consideration is how much? 4 lakh. Array, never take this net sale consideration here. This is actual sale consideration. This is going to be this. Okay, don't make that mistake. It is 4 lakh. 4 lakh, 2 lakh, whichever is lower, you are going to consider 2 lakh here. Lower of the following is the point. Actual sale consideration, whichever is higher, 2 lakh is the point. You'll take 2 lakh as your cost of acquisition. And then whatever you get is your long-term capital gain. Bonus shares is something different, something easy also. 1:1. It is a short term over here. Okay. So gross sale consideration we already know. 100 shares into 4,000 rupees, 4 lakh. Brokerage also we already know 1% is the brokerage on that sale consideration. Net sale consideration you have cost of acquisition. Do you have any cost involved when it comes in the bonus shares, which is allotted on or after 1/4/2001? There is no cost of acquisition. You will not pay any physical money outside your pocket for bonus shares. So nothing paid. So cost of acquisition is nil. Your short-term capital gain is how much? 3,96,000. Okay. So this is capital gain is done. Income from other sources, dividend income, 200 share, one from a long term, that is what you purchase, and one from bonus shares. Total 200 shares, 10 rupees, 2,000 you got. Other income, which is already given in the question, is 8 lakh. So now your total income is 13 lakh 94,000. Okay. So now the total liability, so the tax liability which you are getting is how much? Long term capital gain under section 112A is nothing but whatever you got over here. How much is it? 1,96,000, right? 1,96,000 is whatever you got in your long term capital gain. Alright, these are special rates of tax, long term and short term. So you have to charge the tax separately, then take the slab rate for the remaining. So 1,96,000. Okay. Out of this 1,96,000 minus how much? 1,25,000. 1,96,000 minus 1,25,000. How much did you get? 71,000. Why did you subtract 1,25,000? Because under section 112, excess of 1,25,000, you will pay 12.5% as the tax rate. So 1,25,000, however, you have exemption. 1,96,000 minus 1,25,000, 71,000 you got. On that 12.5% is 8,875. For short-term capital gain, you don't have all such exemptions. So 3,96,000 into 20%, you will get 79,200. Out of 13,94,000, 1,96,000 is already considered here. 3,96,000 is already considered here. The remaining 8,02,000, you will apply the slab rate for that. You are doing the normal rates of normal provisions here. So 2,50,000 to 5 lakh, 5%, 5 lakh to 10 lakh. It's going to be having the bracket of 20%. So it is within that bracket of 10 lakh. 8,02,000. You have considered 72,900. The total tax liability is 1,60,975. Out of that, how much is considered here? 6,439 is 4% HEC, and your tax liability is 1,67,414. I hope it is clear. Okay. Test your knowledge. Question number 2. A very, very simple question. So before this, we'll do one thing. We will do question number illustration 3 first, and then we will go to illustration 2. Okay. It becomes much easier. Test your knowledge. Question number 3. Mrs. Harshita purchased a land at a cost of 35 lakhs in the financial year 2004 and 5 and held the same as per the capital asset till 20th of March 2024. She started her real estate business on 21 March 2024 and converted the said land into stock in trade of her business on the said day when the fair market value of the land was 210 lakh. She constructed 15 flats of equal size, quality, dimension. Cost of construction of each flat is 10 lakh and the construction was completed in February 26. She sold 10 flats out of the 15 flats here at 30 lakh per flat. The remaining 5 flats were held in stock. Okay. She invested 50 lakh in bonds of NHAI and another 50 lakh in rural electrification bonds. You have to compute the income chargeable to capital gain and the business income in the hands of Harshit. And the cost inflation index information is given over here. Okay. See, this question speaks about the concept of a conversion of capital asset into stock in trade. See, what will basically happen in this concept is that you will have one particular asset, and that particular same transaction you have to pay tax under capital gain and you have to pay the tax under PGBP. Now we have to bifurcate things. Okay. See, so let's do one thing. Let's take a quick example. Okay. Okay, you are a rich fellow. You have what? You have a plot. Okay. You have a plot. You have purchased this as a capital asset. Let's consider you have purchased this as in capital asset in 2004 and 2005. Okay. You had purchased this capital asset. So what you did in PY 2004, you purchased this capital asset. Okay. In PY 2023-24, you converted this into stock in trade. Okay. What you did, you got the land in 2004 and 5 and you saw the development which is happening outside and you thought that I will get good money over here and you started to convert this into plots. Okay. This conversion happened on what date? This conversion happened in PY 23-24. Okay. Now, after doing the conversion, you sold the plot in PY 25-26. The sales of that flat or the sale of that stock in trade happened in PY 25-26. This is the timeline. Okay. When you had purchased the capital asset, let's consider you had purchased it for 2 crores. Okay. Cost of acquisition is how much? 2 crores. As on the date of conversion, this is date of conversion. This is date of conversion. Okay. As on this date, let's consider the date of conversion. The fair market value as on this date is, uh, let's consider 4.5 crores. Okay. And you sold this plot for, let's consider the sale value is 6 crore. 6, let's make it a 6 crores. Okay. Everyone? Great. If you can observe something, if someone comes and asks you what is your actual profit, you'll say 6 crore minus 2 crore because 2 crore is what I purchased, 6 crore is what I've sold for. Prima facie, at a top level, it's fine. But for the purpose of income tax, what calculation you have done was wrong. Because if you can observe something, from this period to this period, it was a capital asset. And right from this period to this period, it is stock in trade, wherein it means you are liable for capital gain in capital asset period, and you are liable for PGBP in stock in trade period. Same transaction, same asset, but you have to make it as taxable in two different ways, capital gains and PGBP. Now, what happens? What the Income Tax Act stated is that don't cry. I will give you a proper solution. You do one thing. See, instead of conversion, just an example, okay? In PY 23-24, you think instead of conversion, if you would have sold your capital asset to someone without the conversion, at what price you would have sold? Obviously, at the fair market value only you would have sold, not at price anything less or more than that. So you take that, you catch that fair market value as on the date of conversion. Okay. Fair market value as on the date of conversion is 1.5 crores. Clear with this? Great. What is your cost of acquisition? I'm keeping it simple. I'm ignoring the indexation here. Let's consider the SEC is opting for cost of acquisition only, not for indexation. Just for simple understanding. The cost of acquisition is how much? 2 crores here. So how much would be the capital gain ideally that you would have paid the tax for? You would have paid for 2.5 crores, right? Now, let's take another situation. This is capital gain situation. This is PGBP situation. Okay. See, up till year you have paid the capital gain. Now you have to calculate your PGBP. What is your sales? Sales from your PGBP 6 crore, very well. Now you should show some cost here, right? You can't show 2 crores because 2 crores is already considered. Can I say to the extent of 4.5 crores, for this 4.5 crores, to the extent of 2 crores, he has already considered as cost of acquisition. To the extent of 2.5, which is excess of your cost of acquisition from this fair market value, you've already taken it as capital gain. Why do you want to show that income again as your taxability in your PGBP? You have paused it till here, no? Whatever the fair market value for which you've already charged the tax for, consider that as your cost for PGBP. It's all logical. Okay, it's not illogical, it's all logical. Okay, so how much is the tax that you're ending up paying here for PGBP? You will pay the tax for under PGBP for 1.5 crores, right? See, as we discussed initially, 6 crores was your income. What you paid out of your pocket was 2 crores. Ultimately, it is 4 crores only that becomes taxable. But 2.5 in the name of capital gain, 1.5 in the name of PGBP. That is how you will know whether the answer which you have done is right or wrong. Okay, the cross calculations for that matter. I hope it is clear. Whatever you have already taxed it here, that becomes the point of deduction, that is cost over your PGBP. Clear? Great. whatever the concept which you saw, that is the concept which is there in question number 2 and 3. Okay. A very simple one. See, she has a land that cost 35 lakhs. She paid it in PY2 and 2004 and 5 only. Okay. Held as same as per the capital asset till 20th March 2024. She started a real estate business on 21st March 2024 and converted the said land into stock in trade on said date. In 2024, she converted. Okay. In PY 24-25, she converted. Fair market value was 210 lakh over there. After conversion, what she did, she constructed the flat, 15 flats, out of which 10 flats she sold. 30 lakh per flat, 10 flats she sold, right? So it is going to be whatever the sales that will have 10 flats into 30 lakh, that's going to be 3 crores. Cost of construction was additional 10 lakh over here, and 5 flats were held in stock. This is with regarding to the exemption under section 54 EC. We'll come back to that later. See, full value of consideration, I told you. First, what you will take, this is the fair market value. If I wouldn't have converted it, I would have definitely sold it as capital asset only. That is what 210 lakh year means, right? So 210 lakh year. So now what I will do is that my cost was 35 lakh. Okay. See here. Where is it? Okay. My cost was 35 lakh. Out of that, when was the date of purchase year? 2004 and 5. 2004 and 5 cost of indexation is so much. I hope all of you know indexation, how to do that. Based on that assumption, I'm doing this. Okay. 35 lakh is the cost divided by the cost of indexation is 130, and 348 is what? Year of transfer. That is conversion period is the time where we consider, where we stop uh, the year of transfer. The year when it got converted into stock in trade is the year what we consider as transfer. So 2024-25 is the year that we consider as transfer. 23-24, I'm so sorry, it is not 24-25, it is 23-24. Year 23-24 is what we consider as the year of transfer. Why? Because that is the year when it is getting converted, year in which it got converted. Only till that year we are going to consider it as capital gain. After that, we are going to consider it as stock in trade, PGBP. So we took it here. You did the calculation, you got so much. Okay. Capital gains during the, this is not, we'll do it. So the capital gain for that matter over year is how much? 1,02,021 crore, 2,21,239. Okay. Just think, whatever you have done this calculation, this is for calculation of 15 flats equivalent. But it is going to be this conversion of capital asset, it's going to be taxable in the year when it is actually sold, right? In the year when it is actually sold. That is the year, even though the transfer took place in some other time, the tax liability is coming in AY 26-27 because only 10 flats have been sold out of 15 flats. So now everything you have to make it in proportion. Capital gain of 1 crore 2 lakh. If you are taking only for 10 flats for that matter, 68 lakh is what is going to be taxable long-term capital gain, right? So now the exemption which you have here, how much is that? She has deposited 50 lakh in NHI and 50 lakh in RECL bonds. 50 lakh here, 50 lakh here, if you're taking in, you'll get a maximum deduction of 50 lakh under section 54 EC if you're investing within 6 months to NHI or RECL bonds or other bonds which have been notified, that is HUDCO bonds and all, which has been notified in uh, AY 26-27. Those bonds, maximum of 50 lakh you will take under section 54 EC, and yes, taxable capital gains under for AY 26-27 is going to be so much. And business income, all of us know the sale flats is 10 flats for 30 lakh, 3 crores. For one flat, you had an extra construction cost of 10 lakh into 10 flats, so much. And fair market value that you have already considered. See, doing this calculation over year both leads to same point. That is your calculation of fair market value, and on the rate of conversion is 210 lakh is for the entire 15 flats. How much is for 10 flats? 1.4 crores. If you subtract everything, you're getting business income of how much for AY 26-27? 60 lakh, that is the amount for which you are going to pay the tax for. Okay, this is your test your knowledge question number 3. Test your knowledge question number 2 is very, very simple, similar to the previous one. Arav converts his plot of land in 2004 for 80,000 into stock in trade. Okay, the fair market value is in 2025 is 3 lakh. Stock in trade is provided 3 lakh 25,000 Jan 26. And what head of income it is taxable and for which assessment year. So if you can see something, how much is the fair market value as on 31 for which fair market value when it was getting converted, it is 3 lakh. What is actual cost of acquisition? 80,000. So long term capital gain is 2 lakh 20. What is your actual sale price? 3 lakh 25,000. Out of that, how much you have already taxed it for 3 lakh? So subtract it, you will get 25,000. So now how much is the computation for Harav? For under PGBP is paying 25,000 and a long term capital gain in this point is paying how much? 2,20,000. A simple question. Clear? Done. See, whenever some questions are done, please make sure that you're pausing the video, going back, practicing it, and then coming back and solving the solution. Okay, make this as an habit. And if you're watching this a day prior to the exam, watch it at 1.5 or 1.25 speed, whatever you're comfortable with, and then go through all the questions very quickly. Done? Great. Question number 4. Mr. A is an individual carrying on the business. His stocks, machineries were damaged and destroyed in a fire accident which occurred on December 25. Okay. The value of stock damage was 6,50,000. Certain portion of the machinery could be salvaged. Opening balance of the block as on 31/1/4/2025 after providing depreciation was 10 lakh 80,000. That is the opening balance of the block was 10 lakh 80,000. This asset was damaged because of the fire accident. That is what the question is speaking about. Okay. During the process of safeguarding machinery and in firefighting operation, Mr. A lost his gold chain and diamond ring, which had been purchased in April 2005 for 1 lakh 20. The market value of these two items as on the date of the fire accident was 1 lakh 80,000. Mr. A received the following amounts from the insurance company. Towards loss of stock, 4 lakh 80. Towards the damage, he received 6 lakh. Towards the gold chain settlement, that is Mr. A who lost those, he got 1 lakh 80,000. You are requested, like what is the tax treatment for these three compensation which has been received. Say towards the loss of stock, whatever the amount which has been received by the insurance company because of the concept of loss of stock, it is going to be considered as trading receipt and it will be taxable under the head PGBP. For damaged machinery, we are going to see how much is the salvaged value. In the question, see the question does not clearly mention whether the salvaged machinery is taken over by the insurance company or whether there has been any replacement. Hence, we are assuming this machinery is taken over by the insurance company and no fresh additions of the machinery has been made. Hence, 10 lakh 80,000 is what? 10 lakh 80,000 is your opening block which is given in the question. 6 lakh is the compensation received. Subtract 10 lakh 80 minus 6 lakh, 4 lakh 80,000 rupees, whatever the excess you got, we are going to call it as short term capital loss because the machinery is damaged. And the last point, that is towards the gold chain and the diamond, this is going to be considered as a capital asset. Hence, the 4 lakh, 1 lakh 80,000 rupees will be reduced by whatever the cost of that jewelry is, and it is going to be taxable under the head capital gains, long term capital gains, obviously. So now, after this fourth question, we will do the seventh question from the test your knowledge. We'll do seventh and then we'll go sixth and then we'll go fifth question. Okay. So that the harder part and difficult part would be done. We can do the simpler one. Question 7. Mr. Shiva purchased their house property on February 15, 1979 for 3,24,000. In addition, he has also paid the tax duty of 10% on the SDV of 3,50,000. See, basically, this fellow was purchased in 1979, that is prior to 1/4/2001 only. 3,24,000 is purchased. Stamp duty value was 3,50,000 at that point of time. That is nothing but 3,50,000 into 10%. That is 35,000 rupees he paid as stamp duty value. Okay. So, this 35,000 rupees will become part and parcel of your cost. That is what it means. In April 2008, Mr. Shiva entered into an agreement with Mr. Mohan for sale of such property for 14,35,000 and he received 1,11,000 as advance which did not materialize, that is, the sale consideration did not move forward and it was forfeited. In May 2025, he again entered into an agreement for the said house with Miss Deepshika and received 1,51,000 as advance, and again it was forfeited. And in August 2025, Mr. Shiva constructed first floor by incurring the cost of 3,90,000. Okay, up till here, if you can observe something, he went into two transactions, that is for the sale two times. Even both the times it did not materialize, both the times it was forfeited. See, under section 51, if the advance money has been received and forfeited, and if the forfeiture happens prior to 1/4/2014, it is going to be reduced. Whatever the amount is there, it is going to be reduced from your cost of acquisition. If the forfeiture happens after 1/4/2014, it is going to be, this is considered as income. No, you have a property, you're thinking of selling it. Some other fellow comes, he says that 1,51,000 I'll give it as advance and remaining I'll give it later. He was not able to fulfill the conditions, so this 1,51,000 rupees is staying in your hands. It is forfeited. You need not give that money back. That's your income only. No, this income is going to be taxable under the head income from other sources. Clear? That is what as per the provision of section 51 is. And he constructed first floor by incurring 3,90,000. This comes under cost of improvement. If you can observe something, tell me 1,11,000 rupees, whatever you have. This is going to be reduced from your cost of acquisition. And there are certain other information, but yes, this is going to be reduced from your cost of acquisition. This is going to be considered as income from other sources. In which year it is going to be considered as income from other sources? In PY 15/16 only. Does it have any impact in the current year? No, it will not have any impact in our relevant PY, that is 25/26. This is your cost of indexation. Cost of indexation. Yes. Cost of indexation. Okay. On November 15, 2025, Mr. Shiva entered into an agreement with Mr. Manish for the sale of such house, that is for 30,50,000, and received an amount of 1,50,000 as advance through account pay check. Did he receive it through cash or account pay check? He received it through account pay check. So it means this 1,50,000 rupees. You are having the date of agreement on 15th November and the date of sale, it was transferred on February 2026. There are two different dates that you need to consider here. Okay, he paid brokerage also 1%, very well, fine. So February 20th and November 15th, you have two different dates. Date of agreement is different, date of registration is different here. Okay, on 1st April 2001, which is relating to this particular information, fair market value of the house property was 11,85,000. Stamp duty was 10,70,000. Stamp duty valuation as per 15th November and 20th of February is 39 lakh and 41 lakh. Clear? Now, if you can observe something, you have to consider these two dates whenever you are determining the sale consideration. And date of consideration, you have to consider, you have to apply section 43 CA over here, right? What is the section 43 CA mentions, or what is the section particularly states? Any idea? Any thoughts? See, basically, this section says that whenever you are determining the sale consideration, if the sale consideration is up to 110%, or if your stamp duty value is 110% of your sale consideration, then you are going to consider your sale consideration as your cost of acquisition. Sorry, sale consideration as your full value of consideration. What if your stamp duty value is more than 110% of consideration? You have to take stamp duty value itself as your full value of consideration. If you can observe something, whatever we both are sitting and deciding the sale consideration, that is what I'm getting in my pockets, not the stamp duty value, the value which we both determine. But for the purpose of section, for the purpose of income tax, we have to consider the provisions which is there in the Income Tax Act. What is it? When do you consider the full value of consideration over here is that we have to consider, we have to see first whether the stamp duty value is less than or equal to 110% or greater than 110%, right? In order to determine what is the stamp duty value, if you can observe, there are two different stamp duty value given in the question, right? You have to now determine which stamp duty value you need to take in for the purpose of your calculation. How do you do that? As on the date of agreement and as on the date of registration, whatever the stamp duty value is there. If you have paid through account pay check, account pay draft, or any other electronic clearance mode, banking channels, if you have made the payment of advance, then you have to take the date of agreement SDV as your final SDV for the purpose of calculation, right? As on the date of agreement, it is paid through account pay check. So you will take the date of agreements SDV, that is nothing but 39 lakh. Your actual sale consideration given in the question is 30 lakh 50,000. Where is it? 30 lakh 50,000 already given in the question, right? Out of these two, now you will see, is your sale consideration less than 110%, is your SDV less than 110% of your sale consideration or more than that? For that, what you will do? 110% into 30 lakh 50,000. If you do, how much will you get? 33 lakh 55,000 you will get. Is this 33 lakh 55,000? 33 lakh 55,000 less than STV or more than STV? Your 110% of the consideration is 33 lakh 55,000, right? If you can observe something, your STV is greater than 110% of your consideration, right? It means whatever the transaction which you have entered into as per the government, it is not a prima facie good amount which you have stated. It is not, it does mean, it means that as per the government, that is whenever there is a concept of SDV, market value itself is stating it is 39 lakh. You have entered into a transaction of 30 lakh 50,000. It means government is now not secure, thinking that this fellow has not uh, entered into a transaction which is as per the market value. We have to bring it to the market value for the purpose of collecting the tax. So now they have stated we will take 39 lakh as your for the purpose of full value of consideration. Clear? All these points are explaining that. And you have 1% of expenses. If you can observe something, 1% on sale consideration, how much will you take? 1% of 39 lakh, no? Array, you will make mistake over there. 1% of your sale consideration means 30 lakh 50,000 is your sale consideration. I told you actual money moving into your pocket is 30 lakh 50, not 39 lakh. 30 lakh 50,000. So 30 lakh 50,000 into 1%, it's going to be how much? 30,500. Net sale consideration you will calculate. Okay. See, in this solution, observe something. What have they asked? Also compute the tax liability under section 112, assuming that the basic exemption limit has been fully exhausted. Okay. This fellow is an individual, 1 point, and whatever he is selling is a land or building or both, and he has bought this property prior to 23/7/2024 and is selling after 23/7/2024, right? All the three conditions satisfied. Now he has two options. One, to pay 20% with indexation or 12.5% without indexation. We will do both the calculation. You should do both the calculation. Okay. Believe me, people, if you are doing this practice of somewhere around some 2 to 3 times, 3 to 4 times you do the practice of this question, you will get a grip of this. Don't worry. Once this question completely is done, pause the video, solution is done, pause the video, do it again and see where you have gone wrong, and then you can move forward with the next question. Believe me, 3 to 4 times you do it, fifth time you will be able to do it properly. Okay. Cost of acquisition and cost of indexation over here. Working note 1, working note 2. If you can go to this point, I told you the cost of acquisition which was given is in 1979. But whenever there is a cost of acquisition calculation for land or building, you have an option that you can take. No, that's not an option. You have a point calculation that you need to do. That is, you have to take for the determining what is your cost of acquisition. You have to do some circus here. What is it? First, you have to see SDV or fair market value, whichever is lower, will be considered as your outer portion, that is outer part calculation over here. What is it? Stamp duty value as on 1/4/2001 or fair market value as on 1/4/2001, whichever is lower only you have to take. See, if you can observe something here, Fair market value is 11,85,000 given in the question. Where is it given? Where is it given? Array, it's given in the question. 11,85,000 is the fair market value. And the stamp duty value as on 1/4/2001, 10,70,000. You have to take whichever is lower over here. That is 10,70,000. Okay. Now compare that with your actual cost of acquisition and see whichever is higher. Right? What is your actual cost of acquisition? 3,59,000. How did you get 3,24,000 plus stamp duty value? I told you earlier. 3,59,000. Obviously, we'll take whichever is higher. You have paid out of this pocket. You have kept it from period of 1979 to 2001. Because of this, the fair market value of the property has been increased. That is 10,70,000 or 3,59,000, whichever is higher. Right? Whichever is higher is how much? 10,70,000 becomes your cost of acquisition. I told you something. There is a money forfeited for in 2008, which will be adjusted against your cost of acquisition. Now, cost of acquisition is 9,51,000 divided by 100. Why? Because the date of the year of acquisition or 2001 and 2, whichever is later. That is what there in indexation. So divided by 100 and the year of transfer. This is 25, 26. This is the year of transfer. This information is given in the question 376. Okay. So now you take this cost of indexation 3 lakh, 9 lakh 59,000 into 346 divided by 100. You will get 36 lakh 5,840. This becomes your actual cost of, indexed cost of acquisition, which you will consider. Right. Similarly, you will do for indexed cost of improvement also. Index cost of improvement, cost of construction of the first floor is 3 lakh 90. Again, 3 lakh 76 is the year of transfer. 254 is the year in which this cost of acquisition, this cost of indexation was done. You can see that in the question. 254, it would be that particular year. You have got the solution. Now subtract cost of indexation, cost of improvement, you will get long-term capital loss. Okay. You have another option that is 12.5% without doing any indexation. Full value of consideration, I've already explained 39 lakh. Cost of acquisition, there is nothing called as indexation calculation and all. We have already calculated how we got this 9,59,000, 9,59 minus 3,90 long-term capital gain. If someone would have given you the option to either take 12.5% with indexation, without indexation, or 20% with indexation, obviously I would have taken this because this is resulting in loss and this is resulting in capital gain of 25 lakh. Right? Now, option 1. On long-term capital loss so much, so there is no taxability. In option 2, you have so much into 12.5% is the tax rate that we calculate plus 4% HAC, you'll pay 3,27,666. Okay, this is your question number 7. A very, very good question. If you want to practice it, pause the video and practice. If you're good to go, please let's continue with the next question. Mrs. Yuvika, she bought a land for 80 lakh. Registration and other expenses, 10% of the cost of land. That is nothing but 80 lakh plus 8 lakh. It is going to be how much? 88 lakh will be her cost of land. Very well. She constructed residential house on the said land for 100 lakh. That is basically for 1 crore during 7-8. She entered into an agreement for sale of the above and said for the said residential house with Mr. Joner in April 2015. Sale consideration was fixed at 700 lakh. Received 20 lakh as advance. However, this said negotiation could not materialize and the amount was forfeited. When this has happened in April 2005, it means it is on or after 1/4/2014, which means this 20 lakh will be forfeited and will be considered as income from other sources in the year 15-16. Does it have any impact in the current year? No, this doesn't have any impact in the relevant PY. Mrs. Yuvika entered again on 1/5/2025 in this relevant PY for sale for 810 lakh. It is 8.1 crore. Okay. She received 80 lakh as advance through RTGS. Stamp duty value as on the date of agreement is 890. The sale deed was executed on 14/7/2025 and the stamp duty valuation on the date is so much. Yuvika paid 1% brokerage. If you can observe something over here, there are two different dates. Date of agreement, date of registration are different. SDVs are different. 800 and 890 year and 900 year. Okay. Which SDV will you take for the purpose of calculation? As the advance has been paid through account pay check, account pay draft or any other electronic clearance mode, RTGS being a part of it, you will take the date of agreement 890 lakh as your calculation for the purpose of SDV calculation. Okay. See, SDV is 890, 80 lakh paid through RTGS. So you will take the date of agreement only 890 or 810. Now you will take the calculation of 110% of 110% of your calculation. 110% of your sale consideration. That is nothing but 810 lakh. Okay. So do the calculation from your end also. 810 lakh into 110% is resulting in 891. What is your STV? STV is 890. Your STV is less than or up to, I can say less than, your SDV is less than 110% of your sale consideration. So what you will do, you will consider your actual sale consideration as your full value of consideration for the purpose of taxability. Okay, 810 lakh you will take. Brokerage of 1% already given in the question. On your sale consideration, remember on your sale consideration 8110 you will provide. You got the answer. Clear? It's a very simple question. If you have understood question number 7, Mr. Shiva question properly, you will understand this question easily. Okay. Acquired 2 residential house at Delhi, Chandigarh for 130 lakhs and for 50 lakhs respectively on 31/1/2026 on and 15/5/2026. Acquired a residential house at UK for 180 lakh on 23/3/2026. Subscribed NHI capital gain bonds 54 EC 40 lakh rupees. Have to calculate. Okay. So now if you go for your, I'll come to the exemption part later. Cost of acquisition, I told you 88 lakh. You will take 88 lakh. Cost of construction is already given. This is 12.5% without indexation. Okay. First option 12.5% without indexation, you will get LTCG. If you can observe something in the exemption, 2 residential houses were acquired at Delhi for 130 lakh and 50 lakh respectively. If your capital gain is up to 2 crore rupees, then you can purchase 2 different residential houses and you will get exemption for both. If your capital gain is more than 2 crore, then you will get exemption for only one. Purchase, you can purchase 10 properties also. Exemption is given for one property over here. How much is the capital gain? Capital gain is 6 crore 13 lakh. 6.613.9 means it is 613 lakh means it means 6 crore is your capital gain. Right? So now what you will do, under section 54 you will get out of these two any one only you will get. Obviously you will take the higher one. Higher the exemption is, lower your capital gain is. So you will take 130 close. Okay. You should have purchased the residential property in India, not at UK. So this is out of the exemption category only. You can't take it. NHI bonds, you can take a maximum of 50, but here 50 lakh on this date they have you have applied for. That is, you have bought the bonds for, and 40 lakh over here. Both can't. Excuse me. Both can't happen. So what you will do is that 50 lakh you will take. 50 lakh is the maximum exemption available under section 54 EC. You will take minus and you will get the answer. 613.9 minus 130 minus 50, you will get long-term capital gain of 433.9. Okay. Option 2, 20% on LTCG with indexation. What you will do is that whatever calculation you have done is that it will remain same up to net sale consideration. But here you will get your indexation benefit. That is 80 plus 80 lakh plus 8 lakh. That is 88 lakh divided by 170. In the numerator, it is 360. Year of transfer and the year of purchase that you have done, you have got the calculation. This is also same. Concept revolves around same. So you have got so much 554 minus 801. You got long-term capital gain of 247. Whatever the understanding we had for section 54 and 54 EC remains same. 130 and 50. LTCG is going to be 64, 67 lakh 47,000. Okay. I hope you have understood this question number 6. If you have done question number 7 properly once, twice, 3 times practice it, then question number 6 and question number 5 will be a cakewalk. You can do it like this. I believe you people, you will do it, I know. So Mr. Satak entered into an agreement. Question number 5. To sell his residential house located at Kanpur on 16/8/2025 for how much? 1,50,000. The sale proceeds were to be paid in the following manner: 20% through account pay check, 60% balance. Okay, balance on inquiry. Very well. This fellow handed over the possession of the property on 15/12/2025. Registration process was completed on 14/1/2026. He paid the sale proceeds as per the agreement. Stamp duty, three different stamp duty value has been given to confuse you people. There is nothing hard here. Okay. Question, simple question. Mr. Satak acquired the residential house at Kanpur on 1/4/2001 for 30 lakh. After recovering sale proceeds, he purchased two residential houses, one in Kanpur and one in Delhi. Compute the income chargeable under the capital gain. Assessment year information is given. See, this question has nothing complicated over here. Okay. See here, you have three different dates given in the question. This fellow sells on 16/8/2025 for 1.5. Stamp duty value as on that date is 170. Okay. And hands over the possession. The stamp duty value as on the point B. This is of no use at all. Okay. It's just given to confuse you. 14.1. The registration process was completed. There are two different dates which has entered into. Okay. Date of agreement, date registration. Two different stamp duties given. You will consider advance is given through account pay check on the date of agreement. So you will consider the date of agreements STV. Okay. 1,70,000. Out of this 1,70,000, 110% of the sale consideration. 1.5 crores is sale consideration. On that 110% is 1.65. Can I say 1.65 crore is less than the HDV? So, sorry, 1.65 crore, that is 110% of the consideration, is less than the SDV. That is, your SDV is more than 110% of the consideration. It means SDV only becomes your full value of consideration. Clear? And indexed cost of acquisition is already given in the question. What is the cost of acquisition? When your purchase on 1/4/2001 is 30 lakh. So now you can take indexation 12.5% without indexation and 20% with indexation. So the year of transfer, you had purchased it prior to that, so 100. Sorry, your purchase on that date, so it is going to be 100. And the year of transfer is 363. You do the indexation, you will get the answer. I'm not doing the indexation calculation and all because I assume that you guys have already done and you guys are better than me. So you have already done that. Okay, exemption under section 54. If you can observe something here, he purchased two residential house out of whatever money he got, that is 20 lakh and 35 lakh. What is the capital gain he has got? It is just 61 lakh 10,000. So you will get the exemption for both the houses, 35 lakh and 20 lakh houses. LTCG is so much. Okay. Or you can pay the tax at the rate of 12.5% without indexation. Your cost of your full value of consideration is same. Cost of acquisition is 30 lakh, no indexation recorded. You can take the exemption for both, that is 55 lakh. Your LTCG is going to be 85 lakh. Then you're going to charge the tax at 12.5% of 85 lakh, and then you're going to charge 20% of the 6.10 lakh. Whichever is you feel comfortable, you'll go and pay the this fellow, that is Mr. Sarthak, will consider that. They have not given you the suggestion. They have not asked you for the suggestion. They've just asked you to calculate capital gain. Remember, three conditions you need to satisfy. Okay. One is individual. And second, the property should have been purchased prior to 23/7/2024. It should have been land or building. And the sale should have happened after 23/7/2024. All the four conditions satisfied. You should do under both the option, 112.5% without indexation and 120% with indexation for all the capital gain questions. Remember those 4 points which I told you. Okay. Question number 8. Test your knowledge. Determine the capital gain or loss for this listed equity shares. STT paid both at the time of the acquisition and at the date of transfer. And the units of equity oriented mutual fund, STT paid at the time of transfer of funds. For AY 26/27, they want you to basically find the capital gain for this two situations. Okay, two independent situations. Mr. Shagun purchased 300 shares in A Limited on 25/2017 at a cost of 400 per share. So cost price is 300 per share into 400. he sold all the shares of 300. Basically, he sold all the 300 shares for 1200. This becomes a sale consideration. And as on 31/1/2018, 3 points were provided. That is, as on 31/1/2018, the fair market value of highest traded price, average traded price, and lowest traded price is given. Okay, this is a simple information. The only crux over here is we need to find which is the fair market value that you will consider for the listed stock exchange. Is it highest, average, or lowest? Remember, the fair market value is on 31/1/2018. For the recognized stock exchange, what you're going to consider is the highest trading price. Okay, this is decided. This is the fair market value. In order to understand, if you're looking into this question directly, it is recommended for you to look into question number 1 of your test your knowledge. Then come to this question so that your understanding is much easier. Okay. See now, if you can observe, sale consideration is 1200 into 300 units done. Cost of acquisition is already given. That is, the 400 is what he has paid out of his pocket. Fair market value is 700 rupees into 300 300 shares. You get 2,10,000. Actual cost of consideration you have already calculated. Lower of the following is what you will consider. That is up to 2,10,000 rupees. You will not pay any capital gain tax for. Then higher of the following, that is 2,10,000 or 1,20,000, whichever is higher. 2,10,000 is what you will consider, and then you will get your long term capital gain of 1,50,000. However, all of us know under section 112, excess of 1,25,000 will be taxable at the rate of 12.5%. So it's going to be 1,50,000 is your LTCG minus 1,25,000 you are not going to pay tax for, multiplied by 12.5%, you will get your tax liability, and you will get 4% of your HEC. That is, your tax liability is 3,250 over here. The second part of the question is very simple. Mr. Raj purchased 200 units on 1/2/2017 at a cost of 550 per units. The units were not listed at the time of purchase, but later on the funds were listed on 1/1/2018 on stock exchange. Mr. Raj sold all the 3 units, that is 3/4/2025, for 900 each. See, as on 31/1/2018, what is that you're going to consider? If it is a listed in the stock exchange, you're going to consider the highest price. If it is not listed, you're going to consider the net asset value. So if we can observe something over here, it is listed as on the fair market date. So let's do the computation. Sale consideration is 900 into 200 units. What I've done over here, I've just taken the price. I did not multiply it by unit. You can do it in either ways. However, you're going to multiply the unit at the final consideration. So the first part of the question was done taking the final picture. The second part of the question, I'm just taking here the 1 unit price to calculate the cost of acquisition. Okay. Actual cost given in the question is 550, and fair market value, if you can see here, it might not be listed as on the date he has purchased, but as on 31/1/2018 it is listed. So you have to take the highest trading price, that is 750 only. Okay, it's all conceptual based, nothing else. No technicality here, all conceptual based. 750 is what you will consider as whichever is lower, 750. And 750 or 550, whichever is higher, you will take 750. 750 into 200 units, you will get it. 30,000. All of us know up to 1,25,000, you have no long-term capital gain taxability. So, since the long-term capital gain on sale is 30,000, which is less than 1,25,000, the same is is not chargeable to tax under section 112A. Okay. So now let's do the illustration. How will you calculate the period of holding in case of the following assets? For the shares held in company in liquidation, how do you calculate the period of holding? Will be right from the date of acquisition till the company gets into liquidation. That is what the holding period is, right? Bonus shares you will take right from the date of allotment till the date of transfer. Flat in society, right from the time where the allotment of shares in the society happen until the date it is transferred, you will consider that. Okay. The illustration to a very simple question. Mr. A is the owner of the car. He starts the business of purchase and the sale of motor cars. He treats the above car as a part of stock in trade as his business. He sells the same on 31/1/2018 and gets the profit of 1 lakh. What is the taxability over here? Since car is a personal asset, it will not be coming under the provisions of section 45(2). Hence, A is not liable to any capital gain for that matter, because capital asset, personal asset doesn't get into the concept of conversion or treatment of same as stock in trade. Hence, we are not going to do where it is not taxable under the head capital gains. See, this fellow, Mr. X, converts his capital asset, the point which we have seen in a very much substantiation over there in test your knowledge. Question number 3 is a similar concept. Into stock in trade on March 10, the fair market values on the date of conversion is 5 lakh 50 and subsequently sells. So converted 5 lakh in June, 6 lakh on June 10, 2025. Discuss the year of chargeability of capital gain and business income year. If you can see something, this has been converted into capital asset from stock in trade in PY 24-25. Okay. The fair market value of the above conversion is 5,50,000. So for the purpose of capital gain, what you will take, 5,50,000 minus 60,000 is what you will do in the initial phase. And then you will do 6 lakh minus 5,50,000 and close. Year of chargeability of tax would be in the year in which the sale of that stock in trade happens, right? Because under section, because under this particular provision wherein you are going to convert the capital asset into stock in trade, it is going to be taxable in the year of not the transfer it, but in the year when the actual sales has happened. That's when you have received the actual money. So the profits from the above conversion will be taxable stock in trade only on the June 10, 2025. That is 25-26 is the year in which the taxable, that is nothing but P by 25-26 means A by 26-27. No, this is the year of taxability, and it is taxability for both capital gain and business income will be taxable at that one particular year only. That is in A by 26-27. M held 2000 shares in the company ABC Limited, an Indian company. This company amalgamated with another company. See, this concept of amalgamation, what is this concept speaking about? Is the concept of amalgamation here, right? When one company shares is being taken over and another company shares, that is a new company shares, is being given to you, remember, that is covered by the exemption, so it is never going to be taxable. Illustration 5. In which of the following situation capital gain tax liability does not arise? Mr. A purchases gold in 1970 for 25,000. In PY 24-25, he gifted it to his son at the time of marriage. Fair market value of the gold as on the date was made was 1 lakh. So if you can observe something over here, he had purchased gold and he gifted it to his sons at the time of marriage. So this doesn't regard as transfer. Okay, for the purpose of capital gain. So there is no capital gain liability that arises over there. Okay. A house property is purchased by Indo undivided family in 1945 for 20,000. It is given to one of the family members in PY 25-26 at the time of the partition of the family. Fair market value on the date of the partition was 12 lakh. See, basically, whenever there is a distribution of capital asset by an Indo undivided family, and it is not regarded as transfer for the purpose of the capital gain, please remember. Therefore, the capital gain tax liability does not arise in this respective situation. Mr. B purchased 50 convertible debentures for rupees 40,000 in 1995, which are converted into 500 shares worth of rupees 85,000 in November by this company. See, whenever there is a conversion of debenture that happens, conversion of bonds or debentures, it is not regarded as transfer. Therefore, there is no capital gain liability that arises over here. Clear? Illustration 6. Mr. Abhishek is a senior citizen. Basically, he has mortgaged his residential house under the notified reverse mortgage scheme, and he was getting the loan in the monthly installments for that matter. Mr. Abhishek did not pay the loan on maturity and hence gave the possession of the house to the bank to discharge his loan. However, how will you consider this treatment in the long term capital gain for such reverse mortgage transactions for that matter? The section 47 clause 16 provides whatever the transfer of the capital asset that happens in these transactions of the reverse mortgage. Remember, it shall not be considered as a transfer. It doesn't come under the definition of transfer. So, whatever the loan given and wherein which he was not able to discharge and he has given the house for that matter would be exempt from the income tax and Mr. Abhishek would not be taxable. Clear? Examine with reasons whether the following statements are true or false. Alienation of residential house in the transactions of the reverse mortgage under the scheme made is treated as transfer for the purpose of capital gain? See, the answer is for such alienation, such takeover of that property in the transaction of a reverse mortgage shall does not result in transfer. Okay. Zero coupon bonds of eligible corporation held for 14 months will be a long-term capital asset. See, zero coupon bond, if it is held for a period of more than 12 months, long-term capital asset. Less than 12 months or equal to 12 months, short-term capital asset. So, in this transaction, yes, it is right. Held for a period more than 12 months, long-term capital asset. Zero coupon bonds means a bond on which no payments and the benefits are received or receivable before the maturity. The answer is true. See, as per section 2 subsection 48, zero coupon bond means for which the no payment and benefit is receivable before maturity by the central government may notify in this behalf. So, it is going to be true. Illustration 8. Mr. X converts his capital asset into stock in trade in November 2024. He had acquired it for 50,000. Fair market value as on the date of conversion is 4 lakh 50. Stock in trade was sold for 6 lakh 50. You need to do the calculation. This is the concept which comes under wherein conversion of capital asset into stock in trade. The solution for this is very, very simple. First, you take PGBP. 6 lakh 50,000 is what your final sales is. Out of that date of conversion, we have already considered 4 lakh 50,000. You will get 2 lakh. And as on the full long-term capital gains, full value of consideration 4 lakh 50,000, cost of acquisition is 50,000. You will get 4 lakh. It's a very simple question. If you have done question number 3 of your test your knowledge properly, then this would have been a cakewalk for you. Okay. Illustration 9. Singhania and Co., a sole proprietorship, owns 6 machines put in use for business in March 2024. Depreciation on this machine is charged at 15%. The opening balance of these machines after providing depreciation is so much, 8 lakh 50. 3 of the old machines were sold on 10th June. A second-hand plant was bought on 8 lakh 50,000 on 30th November. You are required to calculate depreciation for AY 26-27. What's the capital gain liability for AY 26-27? And in the place of the sales that has happened for wherein 3 of the old machines were sold for 11 lakh instead of 11 lakh if the sales was happened for 21 lakh, would your working change? So let's do one by one. Okay. So what is the opening balance of the asset given in the question? 8 lakh 50,000 is the opening balance given. How much is the 3 of the old machines were sold? Before the sales, we have to add the purchase. 8 lakh 50,000 is the purchase. Then you will subtract 11 lakh as per the format which we already know. Now, if you can observe something, the WDV exists. That is, the block does not cease to exist. The block is existing and the WDV of that machinery is how much? 6 lakh. Okay. So, the depreciation, how would you calculate the depreciation over here? So, whatever the 6 lakh is there, on the 6 lakh rupees, you are going to take 15%. But, however, if you can observe something, this second-hand machinery was bought on 30th of November. It means only 50% of the allowable depreciation rate is available. That is 7.5%. If you can observe something or use your common sense over here, 11 lakh is the sale consideration that you have received. When is the sales happened? The sales happened on 10th June. Ideally speaking, for this 8 lakh 50,000 rupees is what this 11 lakh is paid for. But as per the calculation as income tax, you are getting the WDV closing. Can I say first this 11 lakh should be adjusted against this opening balance. Then that remaining will be adjusted here. So the 6 lakh is nothing but the left out portion of the purchases only. It means that 6 lakh into 7.5% is the ideal depreciation rate that you need to take. Okay, that's the catch here. Very well. Next. Compute the capital gain liable to tax for AY 26-27. Here, in the above point, the WTV does not cease to exist. The WTV is existing and hence there is no concept of capital gain coming over here. The block should not be there for you to calculate the capital gain. Only then you will calculate. Otherwise, you will not. In this case, the block is existing. The WTV value is there. So in this case, the block exceeds the sale consideration. Resultant will be coming up to short-term capital gain. In the given case, capital gain will not arise because the block is existing. The block is still there. You still have opening balance for the next year of that machinery. Okay. The third situation states that instead of 11 lakh, just replace your solution with 21 lakh. Now, if you observe, this 21 lakh is even greater than both the purchases you have made, which is resulting in your sale consideration is more than the WDV. It means you are getting for the whole block some 4 lakh rupees more. That is resulting in short-term capital gain. Clear? This is your question number 9. Illustration 10. Mr. A, this fellow is an proprietor of Akash Enterprises. He's having 2 units. Okay, he transferred unit 1 by way of slum sale for total consideration of 25 lakh. However, the fair market of the capital asset of unit 1 alone was 30 lakh. Unit 1 was started in the year 2005 and 6. The expenses incurred for this transfer were 28,000. And what else information you have? You have own capital, revaluation reserve. For the land of unit 1, for this land you have revaluation reserve. Very important point. You have bank loan 70% for unit 1. You have trade creditors 25% for unit 1. You have land, building, debtors and other assets. Revaluation reserve is created for upward revaluation of unit 1. Very well. No individual lands were transferred, considered separate and transferred in. Other units of unit 1, other assets of unit 1 include patent which is acquired for 50,000, where for which you have not charged the depreciation. You have not considered that patent. You have not charged the depreciation from 1/7/2023 separately. Okay. Now you have to give the depreciation charge and you have to find what is the closing balance as on the date of sale. That is lump sale. The value of machinery represents the written down value as per the Income Tax Act 1961. Compute the capital gain for the AY 26/27. See, this is the concept which speaks about section 50B speaks about slum sale. Okay. You have to consider how will your calculation flow is that first you will have full value of consideration minus the cost of acquisition, that is nothing but the net worth. Net worth is asset minus liability. You will get your long capital gain. Clear? As usual, you will give the expenses minus. How would you calculate the full value of consideration is that fair market value 1, fair market value 2, whichever is higher. What is fair market value 1? Fair market value of capital asset. Fair market value 2 definition is fair market value of whatever the money which you have received. In this case, the money which you have received is 25 lakh. For the property 1, that is for the unit 1, fair market value unit 1 of the capital asset, you have received 30 lakh. Whichever is higher would be considered for the purpose of calculation, that is 30 lakh. And then you have expenses given which is allowed is 28,000. You will get 29 lakh 72,000. How do you calculate the net worth is asset minus liability. How would you calculate asset? See, you are going to take all the unit 1 assets here and then you are going to subtract liability, that is bank loan and the trade creditors. There are two information that you need to consider. One is the revaluation reserve and one is the other assets. Okay. See, try to understand one thing. The revaluation reserve over year, which is revalued against land, will never be considered over year in this land. I'll tell you the reason why. Okay, with a simple concept understanding, let's try to understand why why revaluation reserve is never considered in your slum sale. Okay, see, always remember revaluation reserve is created just for the purpose of you balancing your balance sheet. I'll tell you how. Okay. Let's consider in year 1, you have a property. Okay, you have got a land that is worth a 10. You have taken loan and you have got this property. Okay, your balance sheet matched. Year 10, what happened? You took the property here, no, in year 1. That has a very good valuation now. Now, the actual valuation of this land is 1 crore, not 10 lakh anymore. It is 1 crore. Okay, it's not 10 lakh, it's 1 crore. So now what you will do, you want to bring your asset to the fair market value. Can you do that? Absolutely, yes, you can do that. So what you will do, land you will take, you want to increase this 10 lakh to 1 crore. Okay. How will you do that? By just adding 90 lakh, right? You will do this in math. If you do that, how will your balance sheet match? Your balance sheet will not tally. Here it is showing 1 crore, here it is just showing 10 lakh, which is not correct. So what you will do is that you will pass an journal entry, that is Land is asset. Asset has debit balance. No. So when your land is increasing, your land was valued at how much? 10 lakh. Now your land should be valued at 90 lakh. As soon as you do that, it will get added over here as 90 lakh. Fine. But you should do something in credit, right? Can you add bank? Bank is your asset. And only the bank should come into picture only when you are actually making the payment. Asset decreasing. So bank should not be considered. What am I stating is that, see, simple accounting knowledge I'll give you. Land, bank, all these are asset. Or asset always have debit balance. No. If you are debiting in your journal entry, it means you are increasing the value. What about if you credit your bank account? What does it mean? It means that 90 lakh rupees money is moving out of your bank account. Are you are not doing this for your information, right? Are you paying any amount over here? No, you just want to bring in the fair market valuation. So you're not paying anyone anything, just increasing your books of accounts. So what you will do is that you will record something called as revaluation reserve, and then once you do that, revaluation reserve get added to 90 lakh in your balance sheet, in your liability side of the balance sheet, and closed, and it will be 1 crore. Okay. So can I say whatever the revaluation of 90 lakh rupees which you have done for the land, that is not the actual money which moved out of your pocket. It was just an entry which was recorded so that your balance sheet tallies and you have recorded your asset at your fair market value. Hence, the revaluation reserve is never an actual money which you paid. That is the reason why you will not consider that in income tax under section 50B as your land value. Hence, we'll subtract 3 lakh out of that 12 lakh and we'll record only 9 lakh as our land value. Revaluation reserve is never considered. I hope you understood the logic. Okay. Machinery 3 lakh, debtor 1 lakh. And now the next calculation comes with the patent. Okay. The patent over here, if you can observe, on 1/7/2023 is 50,000. You bought it. Okay. Depreciation, it is used for a period more than 180 days. So full rate of depreciation is given, that is 25%, 12,500. Balance as on 1/4/2024 is given. So that is, if you subtract this from this, you will get so much. Again, depreciation for PY 24/25. How much is it? That is again 25% you will take. You got it. Balance as on 1/4/2025, which is the opening balance, is 28,125. That is what you've recorded. And out of the other asset, 1,50,000, 50,000 you've already considered here separately in patent. So remaining 1 lakh you'll record here. What else? The total asset will be 14,28,000. And creditors, it has been specified 70% for unit 1, that is 2 lakh into 70%, and 25% for unit 1, 1,50,000 into 25%, you will record, and then the net worth you will get. This net worth is nothing but the cost of acquisition. And then this is your long-term capital gain, 17,21,370. Now let's move to illustration 11. Mr. C purchased a residential house on July 20, 2023 for 10 lakh and made some additions to the house incurring 2 lakh in August 2023. He sold the house property in April 2025 for 20 lakh. Out of the sale proceeds, he spent 5 lakh to purchase another property. A simple, understandable question only, not day before the exam calculation question. See what has happened. This fellow purchased a residential house on June 20th, 2023 for 10 lakh, and he made some additions to the house, and he sold the house in April 2025. Okay. And he spent rupees 5 lakh to the purchase of another residential house. The house is sold before 24 months from the date of purchase, hence the house is a short-term capital asset and no benefit of indexation is provided. Sale consideration is how much? 20 lakh. Cost of acquisition is 10 lakh. And cost of improvement over here is 2 lakh. You will get short-term capital gain of 8 lakh. You will not get any 54 section available only in case of long-term capital asset. As this is a short-term capital asset, there is no such benefit which is available for you. Okay. So next question, illustration 12. Long-term capital gain of 75 lakh arising from the transfer of building on 1/5/2025 will be exempt from tax in case of it is issued by any NHAI under section 54 EC. You have to see this statement. Remember, under Section 54 EC, you are going to get a long-term capital gain exemption only up to maximum of 50 lakh where such investment is made during the previous year or subsequent year, whatever it is. Okay, within 6 months, you have to make the, you have to buy it. To the extent of 50 lakh only it's available, not to the extent of 75 lakh. So the statement, whatever they have given is false. Illustration 13. Calculate the income tax liability for the assessment year 26-27 in the following cases. See, there are four situations given. Okay. One is Mr. A being a non-resident, Mrs. B being a non-resident, Mr. C being a resident, and Mr. D being a non-resident. So basically here, three non-residents are there and only Mr. C is a resident. That too is the age of 81 years. Total income other than LTCG is given and LTCG information is given. They have asked you to calculate the tax which is to be paid by this four category individual under default tax regime and under normal provisions who's opting out of default tax regime. First, if you consider under default tax regime, there is no resident, non-resident age criteria differences in the basic exemption limit. For everyone, the basic exemption limit is uniform, that is 4 lakh. Okay. So now if you consider the calculation, that is LTCG over year, other total income is 2 lakh 40 and the long-term capital gain is how much? 85,000. See, LTCG on sale of the above assets for that matter, it is taxable at the rate of 12.5% and this benefit 12.5% for that matter. However, this taxable under section 112, now if you calculate 2 lakh 85,000 into 12.5%, you will get 10 lakh 65, 6,000, 10,625. See, if you can observe, out of 4 lakh, you will get the entire exemption of 2 lakh 40,000. However, for non-resident, the LTCG exemption can't be set it off against this basic exemption limit. See, up to 4 lakh, if you observe, you need not pay tax. But LTCG, whatever you have calculated it at 12.5%, this is available as the exemption. That is, you need not pay tax more than whatever that is within your basic exemption limit. That provision is there only for residents. For non-resident, other than the special rates of tax, you can set off against this 4 lakh rupees minus 2 lakh 50,000 and rupees you can close. See, suppose if there was other income of to the extent of 60,000 over a year, total it was 3 lakh. The entire 3 lakh you could have set it off against 4 lakh if you observe. But here, LTCG can't be set it off against this because it's available only for resident and it's not available for non-resident. So what you will do is that 85,000 into 12.5% you will calculate, you will add HEC and you will get your total tax liability. What in case of non-resident over year also the similar situation, but remember this exemption of 112 of 10,000 rupees which you have got from the sale of shares, it's available to resident, non-resident uniformly. So 1,25,000 is available as your exemption. Up to 1,25,000 is available. So the entire 10,000 is exempted, no taxable at all. So the other income which this non-resident has is 4,10,000. To the extent of basic exemption limit, you need not pay the tax. So on the remaining 10,000, you pay 5% as per the slab. You will get 500 rupees as the tax liability. You will pay HEC of 4% and you will pay close. Okay. In the third situation is a resident. This fellow 60,000 rupees, which is a rural agricultural land for that matter, it is exempted. It doesn't come under the capital gain concept. The other income which he has is 5,90,000. He will get exemption of how much? Up to 4 lakh. So for the remaining 1,90,000, how much is the tax rate that he will get? How much is the tax liability that is supposed to pay? 5% as per the new tax slab rate. So it is going to be 9,500. However, there is a rebate which is applicable for residents if the total income is up to 7 lakh, if the total income is up to 12 lakh in case of new provision. So rebate is available and yes, no tax need to be paid. But in case of the non-resident final fellow, 4,80,000 is other income. You set off this 4 lakh against it and remaining 80,000 rupees you pay at the rate of 5%. You will get 4,000. There is no rebate available. Remember, no rebate available for non-residents. Rebate under section 87A is available only for residents. Then you will add HEC and close. However, in the second situation, that is in optional tax regime, for non-residents, the basic exemption limit is 2,50,000, and for resident super senior citizen, that is above 80 years, senior citizen for that matter, not super senior, it is senior citizen for that matter, it is going to be how much? 5 lakh is the basic exemption limit available. Non-residents, 2,50,000 is available. See, in this case, long-term capital gain, we all know 85,000 into 12.5%, it will be taxable. And other income is how much? 2,40,000. However, this is within this limit, no? So, only this will become taxable here. And in case of non-residents, 2,50,000 rupees is the basic exemption limit. All of us know 10,000, within 10,000, that is under section 112A, it is available. So, remaining 4,10,000 rupees, whatever you have, 2,50,000 will be set it off against it. And on the remaining amount, 2 lakh, 4 lakh 10,000 minus, do the calculation, 4 lakh 10 minus 2 lakh 10, that is 1 lakh 60,000 into 5%. If you do, how much would you get? 8,000, no? So 1 lakh 60,000 into 5%. How did you get this 1 lakh 60,000? 4 lakh 10,000 minus 2.5 lakh, right? You will get so much. And for residents, you will do the calculation 5 lakh. This is, however, not taxable. 5 lakh minus 5 lakh 90,000, 90,000 you will have. But it will be taxable at the rate of how much? 20%. You will get the total tax liability of so much, because 18 in this case of the total tax liability, you have got this. See, you would have got the rebate under section 87A, but under the normal provision, rebate is available only to income to the extent of 5 lakh. Your income has crossed 5 lakh. No, so there is no rebate that will be applicable for you. And in the case of Mr. D, non-resident, 2 lakh 50,000. Other income is how much? 4 lakh 80,000. On STCG and on other income, it is going to be uh, the total income that you're going to make it as taxable is 11 lakh 50,000. See, in this case of non-resident, 2 lakh 50,000, you're going to set off against the 4 lakh 80,000. On the remaining, you're going to apply as per the slab rate of 5%. You will add HEC to it, and this is your tax liability. So these are the questions from your chapter capital gain. This is from chapter income from other sources, illustration 1. Rahul is a resident Indian. He is having 28% of the equity shareholding in a company. Okay. And he took a loan of how much? 5 lakh from the same company. And on the date of granting loan, the company had accumulated profit of 4 lakh, and the company is engaged in some manufacturing activity. So now we need to answer the question, whatever the loan which is taken, is it taxable as deemed dividend? If the company is substantially interested, and what if, will your answer change, or what would be your answer if the lending company, this company which is lending is a company in which the publics are substantially not interested? First of all, try to understand what is public. Public are substantially interested means the government is holding more than 40% of the shares in the company. Okay, that is what public are substantially interested means. Try to understand one thing here. Okay, here there's a company that is lender company, wherein public are substantially interested. Okay, let's remove that term, public are substantially interested. Let's consider this company as a public is not financial, not uh, substantially interested. This is a private limited company for that matter, not a lending company, not a company in which the public are substantially interested. And here's the shareholder. This person has more than 20% of the shareholding. That is basically has 28%. No, that is more than 20%. So what loan or the advance which is given to the shareholder up to a maximum amount of the accumulated profit would be considered or deemed to be a dividend under section 2 subsection 22E. Okay. So now you can see here Rahul has taken 5 lakh, but only accumulated profit is 4 lakh. No. So we are going to take up to how much? 4 lakh rupees. When are you going to take that 4 lakh rupees? When it is not substantially, when the public are not substantially interested, right? When the public are substantially interested for that matter, this provision will not apply. Section 2 subsection 22E provision will not apply in such case. the company in which public are not substantially interested, yes, this provision would be applicable. And again, if this company was a lending company, what if the lending company is a private limited company in this case? Okay, if the lending company is not a company in which where lending of money is a substantial part of the business, that is, my business is only to give the loan. If that is the case, again, to subsection 22E will not be applicable. This is a manufacturing company here. If you can observe, this is a manufacturing company and is holding more than 10% of the shares in the company. So what happens? Provision of 2 subsection 22E would be attracted. Okay. How much would be the accumulated profit that would be taxable? 4 lakh. To that extent, it would be considered as deemed dividend and not the entire 5 lakh rupees for that matter. Okay. Illustration 2. Mr. A dealer in shares, received the following without consideration. Very well, cash gift of 75,000 on his anniversary. Bullion, fair market value of 60,000 on his birthday. A plot of land on Faridabad, the stamp duty value of that property is 5 lakh. Mr. B had purchased the land in April 29. Okay. See, if you can observe, Mr. A purchased from his friend Mr. C, who's also dealer in shares. 1,000 shares he has purchased at 400 on 19th June, and fair market value was 600 on that day. Mr. A sold those shares. Further, on 1st April 2025, he took a possession of the property booked by him 2 years back at 20 lakh. SDV is 32 lakh. On the date of booking, 2 years prior to that was 23 lakh. And he had paid 1 lakh through account payee check, remember. On 1st March 2026, he sold the plot at the Faridabad. Whatever he has purchased over a year in Faridabad, he has sold. Compute the income of Mr. A chargeable under the income from the other sources, capital gains for AY 26 and 27. Okay. It's a very simple question. See, first thing, whatever the cash gifts which they have spoken over here, the cash gift which is received, this is not received for his marriage. Remember, it is received for anniversary. So it is not going to make any exceptions. So 75,000, this is excess of 50,000. So entire 75,000 is taxable now. Okay. Entire 75,000 is taxable. Very well. Bullion, the fair market value 60,000. He has received it as gift without consideration. So whatever amount he has received, it is going to be considered as taxable. And the value what is received is excess of 50,000. No, so it is going to be fully taxable. A plot at Faridabad, stamp duty value is 5 lakh. Again, this entire amount of 5 lakh would be taxable. Okay. You have already charged that plot, whatever you have got, the fair market value, you have charged it to tax. You have shown it as your income. So this will be eligible for the purpose of considering it as cost when you're doing the deduction, right? You have sold this plot no for 7 lakh. You can see here the last line. He sold this plot. So 7 lakh he has sold. 5 lakh rupees, I am considering it as cost of acquisition. That is nothing but the stamp duty value which I have considered for tax for the under section 56 subsection 2 clause 10. Right. So 7 lakh minus 5 lakh, 2 lakh will be considered as short-term capital gains. Now we have another point, 2 points which we need to discuss here. One is shares and one is this particular point. This fellow is dealer in shares, okay. As this fellow is dealing in shares, this will be considered as stock in trade. It will not be considered as other sources, or it will not be considered as capital gain. It will be considered in PGBP. So it is not taxable here in income from other sources. So the last point over here is that this fellow had purchased, that is, purchased a property wherein is booked by him 20 years earlier. Okay. Further, on 1st November 2025, Mr. A took possession of the property. 2 years earlier only he has booked it. Stamp duty value has changed. Okay. If you can observe something under section 43 CA or section 50 C, if you apply, whenever there is two stamp duty date given in the question, you need to check on the date of agreement or whenever the advance was being paid. Is it paid for account pay check, account pay draft, or any other electronic clearance mode? If the answer is yes, the stamp duty value on the date of agreement will be considered for the purpose of calculation. If not, date of registration SDB would be considered. Right. If you can see here, this is paid in account pay check. So stamp duty value as on the date of agreement, that is original agreement, or the initial one would be considered. So 23 lakh is what we consider it as the difference between the stamp duty value on the date of booking and the actual consideration. The actual consideration which I have given some 2 years back is 20 lakh. SDV was 23 lakh. So whatever the difference which you have, right, paid is taxable since the difference exceeds 2 lakh rupees. Being how much? This is a provision which is there under section 56 subsection 2 clause 10. What does the provision state? See, whenever there is a sale of, or whenever there is a property which is not received for adequate consideration, you are going to take in the sale consideration value. 10% of that sale consideration you are going to take, and this 50,000 out of these two, whichever is higher will be considered as the limit. So in this case 2 lakh will be considered as limit, and whatever the difference between we have this between these two, 23 and 20, the difference between these two is 3 lakh, which is higher than the whatever the limit which we have got here, hence the entire 3 lakh would be taxable. What if this is not 23 lakh? Suppose, just an example, it is 25 or 21.1 lakh. Whatever the difference which we have got here is 2 lakh. And the difference between the 20 lakh minus 21.5 lakh in my example is going to be 1.5 lakh. This is less than this 2 lakh rupees which we can consider here. Hence, this would not become taxable. Right? So, that is the point which you need to understand over here. Okay? Done. This is illustration. So illustration 3, discuss the taxability. Okay. Akil, HUF, received 75,000 in cash from niece of Akil, daughter of Akil's sister. Akil is the Karta of the HUF, CA. It is going to be taxable because whatever this 50,000 rupees which you have received, this is without consideration, and this is from a non-relative. This relationship, the daughter of Akil's sister, niece, is not covered under the relationship over here, and hence it's a non-relative taxable. Daughter of Akil's sister is a non-relative for Akil HUF, since she is not a member of the Akil HUF. Hence, it is going to be what? Taxable. Nitisha, a member of the father's HUF, transferred a house property to the HUF without consideration. SDV is 9 lakh. Whenever there is a property, immovable property which has been transferred from without consideration, that is from his relative, it is not going to be taxable. Okay, it is not taxable. Mr. Akshat received 100 shares of Mr. A from his friend as a gift on occasion of his 25th marriage anniversary. The fair market value as on that date is rupees 100. He also received jewelry worth rupees 45,000 fair market value from his nephew on the same day. See, what is this going to be? Mr. Akshat received. This is going to be taxable. Whatever the aggregate fair market value, for that matter, under section 56 subsection 2 clause 10, whenever there is a in case of the aggregate fair market value which is other than the immovable property which is received in excess of 50,000 for that matter, the whole of the aggregate value which will become taxable. And here in this case, if you can observe, how much is it? 45,000 is the fair market value. He received the jewelry worth 45,000, and he also received what? He also received the shares of worth 100 into 100. So that is coming up to 10,000, and 45,000 is the worth of jewelry. The total amount or the total gift which he has received is exceeding 50,000, and the entire 55,000 becomes taxable. Okay. Kishan HUF gifted a car to a son of Karta for achieving good marks. The fair market value of the car is 5,25,000. See here, whatever the car which you have called it as, that is not included under the definition of property. So it is not going to be considered as taxable. It is not taxable. Okay. Illustration 4. Mr. Hari, a property dealer, this fellow sold the building to his friend, Mr. Rajesh. This fellow is dealer in automobiles for 90 lakhs on 1/1/2026. When the SDV was 150 lakh. The agreement was, however, entered into 1/9/2025, where the stamp duty value was 140 lakh. Mr. Hari had received a down payment of rupees 15 lakh by a cross check from Rajesh on the date of agreement. Discuss the tax implication in the hands of Hari and Rajesh, assuming that Mr. Hari had purchased the building for 75 lakh on 12th July 2024. Would your answer be different if Hari was a share broker instead of property dealer? See here, what has happened? The point is, they have asked two perspective. One being a property dealer, and instead of property dealer, this fellow is a share broker. Hari was a share broker for that matter. What has happened? This fellow sold the building to Mr. Rajesh. Okay, for 90 lakh. When the SDV was 150 lakh. The agreement was entered on 1/9/2025, that is some 4 5 months prior to it, where the stamp duty value was 140 lakh. There is a difference in the stamp duty value. And Hari has received a down payment of 15 lakh by cross check. Remember, whenever the advance is being received, the advance should have been received through account pay check, account pay draft, or any other electronic clearance mode, which includes the credit card, the debit card, RTGS, NEFT, whatever the online banking you can call it as. Cross check is not covered under that definition. It means when the cross check is being received as an advance, it is equivalent to you receiving cash. It means other than account pay check, cross check is covered. Other than account pay check. Now, you are not going to take the date of agreements SDB for the purpose of calculation. You are going to take the stamp duty value as on the date of registration for the calculation. Okay. So, what is the tax implication? Assuming Mr. Hari had purchased the building for 75 lakh on 12th July 2024. This fellow had originally purchased for 75 lakh. He sold it for 90 lakh to Mr. Rajesh is the point. Okay. So now let's take the tax implication for Mr. Hari. This fellow is a property dealer. The section 43 CA would be attracted since this building for this fellow is a property dealer only, no? So whatever the property which is selling now, that will be called under stock in trade, and section 43 CA would be applicable. Whatever the point which I told, the same point is applicable, as he has, as this fellow has made the down payment in cross check, which is not an account pay check. So what happened? The stamp duty value or as on the date of agreement cannot be exercised. He has to take the stamp duty value on the date of registration or the date of transfer, that is 170 lakh. Okay, sorry, 150 lakh. 150 lakh minus whatever the purchase price which he has done, 75 lakh given in the question. Difference between these two, 75 lakh, will be considered as his business income since the stamp duty value exceeds 110 lakh. See now the sale consideration with value is 90 lakh and your stamp duty value is 150 lakh. The comparison over there, what you need to do is that for the purpose of taking the full value of consideration for the taxability purpose, you need to see whether my consideration is 110% of my whether the SDV is 110% of consideration or more than that. 110% of 90 lakh is going to be 99 lakh, right? But here SDV is 150 lakh. So your full value of consideration will now be SDV because your SDV is more than 110% of your consideration. So 150 lakh minus your purchase price, whatever the difference is, that will be considered as his business income. For whom? For Mr. Hari. Now consider this in the hands of Mr. Rajesh. See, this fellow is a dealer in automobile parts, and whatever the asset which is receiving, that will be considered as capital asset in his hand. And whatever he is getting in, that difference between the stamp duty value and difference between whatever consideration of 90 lakh which is getting in, that will be considered or coming under the property without the adequate consideration under section 56 subsection 2 clause 10. Okay, what is the provision state? The difference between the stamp duty value and the consideration, whatever is that, you take it and keep it aside. Okay, whatever the difference is. In this case, it is going to be 150 lakh and 90 lakh. I paid out of my pocket 90 lakh. No. So 150 lakh is the SDV which I need to take minus 90 lakh. This 60 lakh will be the difference. Now take a comparison between 10% of the consideration, which is 9 lakh, or 50,000, whichever is higher. 9 lakh will be the point. Now, whatever the difference which you have, is this difference more than 9 lakh or less than 9 lakh? If it is less than 9 lakh, you will ignore, you will not consider it for the purpose of taxability. If it is more than 9 lakh, yes, you will consider the entire difference as your income from other sources under the concept of under section 56 subsection 2 clause 10. I hope you have understood it. Clear? Yeah. Now, what would be the difference in case if Mr. Hari is a share broker? See, if Mr. Hari is a share broker here, instead of stock in trade, we would have called it as capital asset, and section 50C would be applicable, which is exactly the same, like almost similar like 43CA, right? Whatever the concept we discussed, the date of agreement, the date of registration, two different SDVs you have. If you have paid the advance to account pay check, account pay draft, and any other electronic clearance mode, then SDV as on the date of agreement would be considered. If not, you paid through account pay check, if you paid through if you paid through cross check, if you paid through cash, then other than the stamp value, not the agreement date SDV, you would consider the date of transfer or the date of registration SDB over here. So the same calculation, whatever over there we have done in the part A, similarly you will do it for this part B also. And here there would be no difference at all. Whatever understanding which you had here, the same understanding is over here. Okay. Now, see this question, you have to read some 2 to 3 times for you to get a hold of it. The concept is very simple. Here you will apply section 43 CA. Here you will apply section 56 subsection 2 clause 10. Here you will apply section 50C, which is similar like that of the earlier one. Here it is the copy paste provision of whatever you have seen in the previous point here. Okay. Now let's move to illustration 5. Compensation on account of disaster from a local authority by an individual is taxable. See, you have to give the correctness. Remember one thing, it is not correct. It is not taxable because they have given an exemption. Under section 10, subsection 10 BC, if you don't remember the section number, totally fine. Just remember the provision. Any amount which is received as a compensation by an individual in case of any disaster for that matter from state government or central government or local authority, anywhere from that matter, remember it is exempted from tax. It is not taxable. Okay, illustration 6. Interest on enhanced compensation. Whenever the concept of enhanced compensation comes into picture, always remember you have deduction at the rate of 50% for the entire interest. Whatever is your interest is, you will get the entire 50% as your deduction. Remember that. Okay, interest on enhanced compensation during previous year 25-26 is 5 lakh. Out of this, 1,50,000 pertains to the relevant year. So much, so much, and so much, so much. Discuss the tax implications, if any. Remember, interest on enhanced compensation will be taxable in the year in which you receive it, not accrual year. In the year when you receive it, it is going to be taxable. So, if that is the case, whatever you have received, 5 lakh will be taxable in the PY 25-26. But however, you will get 50% of the amount as deduction. So, it is 2 lakh 50. Okay. Now let's get into the TYK questions, test your knowledge questions, the simple questions. Examine under the following heads, the following income are taxable. Rental income in case of property held as stock in trade for 3 years, income from house property. Salary by partner from his partnership firm, it will be considered as PGBP, never your salary income, because you don't have employee-employee relationship with them. You just have partner and partnership relationship over there here. Hence, it is considered as PGPP. Only when there is employee-employee relationship come into picture, only then you will consider it as salary. Rental income of machinery, PGBP. Winnings from lotteries from the person, income from other sources. Salaries payable to member of parliament, remember income from other sources. Salary is paid to member of parliament. This member of parliament is not an employee of government. He is a servant. He is providing service. He is a service oriented person as per the provision. So it is going to be calculated under income from other sources. Whatever the receipts which you had without the consideration, income from other sources. In case of retirement, interest on employees' contribution of the provident fund is unrecognized as income from other sources. However, interest on employers' contribution is salary only. It comes under the concept of income from salary. Remember, employees' contribution interest is income from other sources. Rental income in case of the person engaged in the business of letting out of commercial properties, PGP. Clear? Now, next question. Examine whether the following are chargeable to tax and the amount is liable to tax. The sum of 1,20,000 was received as gift from a non-relative Raj on the occasion of marriage of his son Praveen. Remember, your marriage only, it's going to be considered as not taxable. It is not taxable under section 56 subsection 2 clause 10, not your son's marriage and all. So the entire 1,20,000 is taxable. Interest on enhanced compensation is 96,000. You might have received for this, of which 40 relates to previous year. Whatever year it might relate to. It is taxable in the year in which you receive. However, 50% of the standard deduction you are going to get. So, out of that 96,000, 50% deduction you will get. 48,000 is what the taxable amount is. You can write all these provisions on your own. See, I'll tell you something. If you make some efforts to remember some good sections, okay, which are repeated in the exams, like section 56, 56 subsection 2 clause 10 over here. Some similar sections you try to, very important sections you remember. If you don't remember the section number, totally fine. Please don't quote the wrong section number in your exam. If you're 100% confident that section number I know, 10 subsection 13A, it is HRA only. If you're so confident for life only, then you write. If you're 99% confident, I know the HRA section comes like somewhere under section 10 subsection 13, don't write this and come. Okay. Please don't quote wrong sections. If you're not confident, don't quote the section at all. Just write the provision and come. At least you will get very, very good marks. Okay. There is no particular amount, sorry, there is no particular marks which is specifically allocated for sections. See, if they want to deduct marks also, let them deduct the half marks here. Out of 4 marks, half marks if they deduct also fine. Okay, they'll not deduct for section numbers. They might have deducted for some your whatever the mistakes which you have done, or your might be some totaling mistakes, or might be some provisions you might have not written. Okay, for sections and all, I have not seen any marks being deducted so far. So if you have not written section and you're worried about not writing section, okay, you fix in your mind half marks, you leave, no problem. You will get at least another 3.5 marks proper marks, no, if you have written the provision. So please do some good deeds in life. Don't quote the wrong section numbers. Okay. Question number 3. On 10/10/2025, Mr. Govind, the bank employee, received 5 lakh towards interest on enhanced compensation in respect of compulsory acquisition 17/18. Out of this interest, 1,50,000, it relates to 18/19, 1,65,000 19/20, 1,85,000 20/21. He incurred 50,000 by way of legal expenses to receive the interest on such enhanced compensation. How much of interest on enhanced compensation would be chargeable to tax in the AY 26/27? Okay. So if you remember something, I have already told you 50% of the compensation will be considered as the standard deduction is available under section 57. Okay. So that is what the provision is. Interest on enhanced compensation is going to be taxable in the year in which you have received it. You might have received it relating to the previous period and all. Don't worry. This year you have received, take it and throw it under your taxable computation for the relevant period. Make sure that you are providing standard deduction of 50%. Okay. Taxable interest on enhanced compensation is 2,50,000 a year. Question number 4. The following details have been furnished by Mistress Hemali pertaining to the year ended 31st March 2026. Cash gift of rupees 51,000 received from her friend on the occasion of her Sashtipata Purti, a wedding function celebrated on her husband completing 60 years of age. This was also her 25th wedding anniversary. See, whatever the sum of money which she has received on the occasion of this marriage of individual is exempted. However, this is completion of 60 years of marriage. No. So the entire 51,000 is going to be what? Taxable. On the above occasion, diamond necklace worth of 2 lakh was presented by her sister living in Dubai. Remember, whatever gift which is given from a relative, it's not taxable, even though jewelry falls under the definition of property, but still it is not going to be taxable since it is not attracted, because the gift of necklace is from her sister who's a relative. Remember? Okay. When she celebrated her daughter's wedding on 21/2/2026, her friend, assigned in Hemali's favor a quick FD for by the said friend in the schedule bank. See, such a type of good friends we have. This, sorry, not me, Hemali has. And the value of the FD and the accrued interest on the said date was 52,000. See, remember, this, whatever the section of section 52, subsection 2, clause 10 would be exempted in case of whatever the amount which you received in case of marriage of the individual. Okay, not the marriage of the individual son or daughter. Therefore, this exemption is not attracted. Whatever the 50,000 which she has received it without any consideration, whatever 52,000 which she has received as the interest for that matter would be taxable. Aggregate exceeds 50 lakh in a year and has not been defined. So, therefore, there are two possible ways for that. In the first view, the FD does not fall in the meaning of sum of money. Therefore, the deposits are not attracted. It may be noted that the FD is not included in the definition of the property. There are two outcomes coming here. However, possible outcome is that FD assigned in the favor of Mrs. Sevali falling in the meaning of this one. So, in the first view, the amount which is taken will be taxable under the under this particular point, and only this 51,000 becomes taxable here. See here, I'll repeat this third point again. What are they stating is that they, in order for your whatever the amount which you have received as a gift to be taxable for that matter, it should come under the definition of property. See, to be exempted under Section 56 subsection 2 clause 10, the property should be received on the occasion of the marriage of the individual, not son or daughter. Exemption is not attracted very well. Whatever the sum of money which you have received is without a consideration by an individual in chargeable to tax if the aggregate value exceeds 50 lakh in a year. Sum of money has, however, not been defined under Section 56 subsection 2 clause 10. Here, now, there are two possible views that is coming with this Hemali point. One, if you're considering the sum of money in the definition of the property, then it will become enter 52,000 becomes taxable. If the sum of money is not being defined under, if you don't consider FD under the sum of money, sorry, if you don't consider the sum of money under the definition of the property, then you will not make it as taxable. If it comes under the definition of property, then you will make it as taxable. So both the alternatives are there. In similar questions are given in the exam, please write both the alternatives. Okay. Examine the following transaction in the context of the Income Tax Act 1961. Mr. B transferred 500 shares of R Limited to B Limited on 10/10/2025 for 3 lakh when the fair market value was how much? When the fair market value was 5 lakh. The indexed cost of acquisition of shares for Mr. B was computed at 4,45,000. The transfer was not subject to securities transaction tax. Determine the income chargeable to tax in the hands of Mr. B and also B Co Limited because of the above transactions. So, in this case, wherein they are asking about the taxability of Mr. B and Miss B Co Private Limited. Okay, so if you can observe here, what is the transaction? B has transferred the shares to B Co Private Limited. How much? The RP Limited point for that matter. Okay, B has transferred the shares of RP Co Limited to B Co Limited. Now these people is receiving and this fellow is actually selling. The fair market value of the shares were 5 lakh. The fair market value of the shares were how much? 5 lakh. And the index cost of acquisition, the index cost of acquisition is 4,45,000 for this fellow. See, you can clearly see this is a capital gain for Mr. B. 5 lakh is the fair value of the consideration. 5 lakh is fair value of consideration minus 4.45 lakh is the index cost of acquisition. So whatever 55,000 is there, this will be taxable as capital gain for Mr. B. So Mr. B's tax capital gain is completed, right? So now, if you can see the point over here, why are we considering 5 lakh, not 3 lakh? 3 lakh is the actual sales for, but the fair market value is 5 lakh. See, if you can observe under section 50 CA, when the consideration is less than the fair market value for this unquoted shares, this is private limited, no? So they have assumed it to be the unquoted shares. Whenever there is an unquoted shares which is being sold, when the consideration is less than the fair market value, we should consider the full value of consideration as your fair market value. Hence, I've considered this and calculated, right? Now, let's speak about B Co Limited. The B Co Limited fair market value is 5 lakh, but however, the transfer is happening at 3 lakh. So, can I say there's a transfer of shares? There is a transfer of property for you. Transfer of property under the property definition, asset is also included. Transfer of property for inadequate consideration, that is 5 lakh minus 2 lakh, whatever you're getting, the difference of 2 lakh is more than 50,000. Hence, the entire 2 lakh will be considered as taxable income, that is income from other sources as for B Co Private Limited. Okay, I hope you have understood. For Mr. B, it is a capital gain. You're considering 55,000. B Co Limited, it is 5 lakh minus 3 lakh, so it is going to be 2 lakh. So it's all mentioned here. Okay. Shazian is employed in a company with the taxable income of 5 lakh. He received a sum of 1 lakh from Atma Charitable Trust by account payee check in December 2024 for meeting his medical expense. So what about the sum of money which is received from the trust chargeable to tax in the hands of Mr. Shazian for that matter? Remember, whenever there is a there is any sum of money which is being received from trust or institution which is registered under section 12b, whatever money which you have received will not be chargeable to tax, because this comes under the point section 56 subsection 2 clause 10 would not be applicable for this particular point. These are the exemptions which is available for this. So whenever you are receiving any money from trust or institutions which is registered under section 12ab, whatever the money which you are receiving, it would not be taxable, because it would be exempted under the section. It would be exempted from the section applicability of the section 56 subsection 2 clause 10. Thank you so much for watching.